remember I gave you democratization alone also.
We also can use switch. So they have the entire
Settle down. We are about to start our conclave today. As we know that over a few last years, microfinance has gone through a lot of turmoil, and product diversification is not only a strategy, it's a sustainable growth strategy for us. So that's why we wanted to discuss today and brainstorm on what are the products which microfinance can go on beyond, and with the idea is relaxation on the non-qualifying asset. We have a leverage of 40% which we can use for the retail loans as well. So, not taking your time more, I'll ask our Executive Director and CEO, Mr. Gigi Mamen, to come us and on the dais for the inaugural session. And I will request Mr. P.N. Vasudevan sir to join sir on the dais for the inaugural session. Before we officially begin, I just request one thing to everyone. Please keep your phone on silent so that the interactions are not interrupted. Now I will ask Gigi sir to deliver his welcome speech.
Thank you, Sri, and good morning to all.
Good morning.
Vanakkam. So let me welcome each one of you for today's workshop on product diversification. First of all, thank you all for being here. And let me tell you, this program, this product diversification workshop was a huge response. We had to literally stop the registration 3 days back, 3-4 days back. And thereafter also I was getting a lot of calls and a request for people to join. So I really feel happy that we could take up a program which is really relevant and useful to them, because that's the reason why so much response people get. And seeing the response, I also feel that probably we should also be doing one or two more such workshops in other regions, because here I find most of the people are mostly from this region, and maybe we can also get similar kind of participation from other regions if we are in east or west. So, having said this, let me welcome each one of you for this workshop of product diversification. And as Sri mentioned in the beginning, microfinance sector had been going through some stressful time in the last 2-3 years, or maybe a little more beyond that also, I would say, because from the days of COVID, we have been facing some trouble or other. Although the COVID was a problem across the world, across the globe, and every sector, every person had suffered. Microfinance suffered a little more than many other sectors because of the sector we cater to, the segment we cater to. The vulnerable people who are basically affected badly because of the health economy and other reasons that have impacted our performance also. So you could suddenly see the NPAs, which used to be below 1%, suddenly shot up to nearly 20%. And since then, things were not really in good shape. Although after the 2 years of COVID, we could come back, but then things wasn't that good. In fact, the economy did not come back to its old shape. I don't think even today it has come back. The professor will be able to give us some more insight on that. But I feel that the economy is still not come back to the old shape. So that has impacted every one of us. Secondly, I also found that we have been having a huge competition in the field. Or there were large number of players who have come to the microfinance sector. Maybe it has happened over the last few years. See, initially, if you see, there was only, Basa all knows, they are the original microfinance players. It was only a group of, it started with the NGOs basically. A few NGOs started the microfinance program. Slowly, some of them became NBFCs, and mostly it was confined to the NBFCs and NGO sector MFIs. But then subsequent to the formation of the banks, small finance bank, we could see that small finance banks also, because they were part of the microfinance system only, they became small finance banks, so they continued. So small finance became a player in that sector. Other NBFCs started coming into the sector. Private sector banks started coming into the sector. So you have a lot of new players and other players, which made this please come. Sorry. Good morning and welcome. So more number of players started coming into the field. Probably that also caused a problem, and we could see that supply became little more than the demand side. And recently, and because of that, the over leverage happened, I would say. And definitely there was a demand also from the people's side, because as I said, COVID impacted everyone, so the economy had also affected. So to get the position better, people started borrowing more, and supply was there, and there were more players willing to give. All created this over leverage, and that was the reason why in the last 2-3 years we had a little difficult time, and now things are looking much better. The guardrails which also could have been diligently worked or adopted by the institutions, and we can see the difference. So now things are in much better position. We are in a position where we can now really grow further, move forward. And thankfully, the funding also will become a little more better because of the credit guarantee scheme which the government has brought in. And as I see that things are, there is a need to some kind of an improvement in the scheme or tweaking of the scheme, because of the existing scheme is supposed to over by 30th June. We had a discussion with the other day secretary and joint secretary, and I think they are also contemplating extension of that program. Even today I saw one circular which says that the cap for the larger institutions have been now increased from 20% of AUM or maximum of 1,000 from the 300. We have been also requesting for increasing the AUM cap for the smaller and mid segments, because 20% sometimes may not be sufficient for the smaller ones. So that also we have been working on. Extension of the time also we are working on. So I am sure that government is also very responsive to our request, and most probably things will change, and we will be able to see once again the uptake of microfinance. But then the best thing which has happened in the recent days is that RBI, realizing that microfinance sector cannot be a single product I would say financial institution, because right now if you see, or earlier we used to see that 85% of the products were the same, microfinance only, and mostly it's group loans. we just brought down to 75%, but then 75% did not make much difference because of the definitional change. Definition earlier it was net asset, which was changed to gross asset. So that change did not make that difference of the percentage did not make much difference. Change in the percentage did not make much difference. So we had been requesting RBI, and finally RBI also realized now 60% of the total assets are only to be microfinance, and the remaining 40% can be non-microfinance, that is other kind of thing. So it's a huge opportunity for the microfinance institutions, especially to, as I said, diversify their lending assets, diversify their products, and also get some better quality assets. So it's an opportunity. So how do we go forward? Although that circular came in somewhere in June 2025, I don't see much movement happening in the sector in this regards, mainly because the sector wasn't in a good shape, because funding was not available, or the financial position wasn't that good. So things were not looking good that time. That's the reason probably that 40% relaxation which RBI gave for non-qualified assets has not been fully utilized or not been completely made use of. So, but when now things are looking better, as I said, things can now go better only. So this is a time we thought that this is the right time to have this kind of a workshop where we can give some kind of insights about what are the possibilities, what are the opportunities for us to move into other segments other than the microfinance segments. So today's workshop is based for that purpose only we are organized, and I am sure everyone here will be benefited because of today's workshop. We have got some very good speakers, and that is also one of the reasons probably I said, a huge response we have. So we have NSG is here, Vasjani is there, all big names are there. So we will be able to have better good discussions today. So I would request everyone to make use of this workshop the best and ensure that we also bring out some kind of a products, newer products, which will help your institution better, which will help the sector better, and we can grow forward. So with this, I once again welcome each one of you and thank each one of you, especially Azul sir for sparing his time, and Ganesh is here. We have other speakers. Everyone is there. I don't want to take the names of you. So thank you so much, and I hope today's deliberations will be useful to all of us. All the best to you. Thank you.
Thank you, sir. Now I will request Mr. P.N. Vasudevan, sir, to deliver the inaugural speech. Sir is a well-known figure in microfinance and don't need an introduction. But still I will introduce sir. Sir is currently the Managing Director of Equitas Small Finance Bank. Sir.
You can be here also. Yeah. Microfinance. For the first time, I have been in microfinance for about 20 years now. In fact, I met some people in the audience from Smile, Mahasemam, or Smile Microfinance. I learned what is microfinance from them, long time back, and they were the ones who actually took me to the field. The first group meeting that I have ever attended in my life was Smile's group meeting, and Dr. Sa-Dhan, who was the MD of that company, was a very nice gentleman. And I told him that I want to start a microfinance company. And suppose you go to, let's say Sundaram Finance goes to Cholamandalam and says that, I want to do something which you guys are doing, what will be the response of Chola? He'll call security and say, why did you leave this guy inside? Right? But I went and told Dr. Sa-Dhan that I want to start a microfinance company, and he said, welcome. And then he called his people and said, no, we tell you what microfinance is all about. And he took a full session. And then he called his people and said, take sir and go to the field, show him what is happening on the field. That used to be microfinance. Today we can't expect that. I assume so. I assume that we can't expect that today. Today, if I am running a microfinance company and you come and say that you want to start a microfinance company, I'll try to dodge you and try not to give you any information because I don't want competition. Right? So when we started in 2007, I did a lot of reading of materials. And Professor Sriram, who is here, was in IMA in those days. He is in IMB today, but he was in A in those days. So I had gone there and met him in his university campus. And so much of research used to be written on microfinance. And in fact, his paper was all about urban versus rural poverty, and why is microfinance relevant for urban as much as for rural? Because in those days, microfinance now first thought is that okay, you have to go to that faraway village, because financial inclusion is only, financial exclusion is only in villages was the concept, which he broke by doing some research and publishing articles. And everybody used to write about the impact of microfinance on the lives of the low-income people. There used to be so much of articles. And I remember reading one article in particular, which was very interesting. So the article says that, here is a family which is from an income level of some level and below. And microfinance is supposed to target only people with some income and below, right? So here is a family which is having an income less than certain amount. And so this microfinance company goes and gives them a loan and also supports them, handles them in some other activities. And slowly the family income starts going up. When any family's income goes up, what goes up along with that? Aspirations. Right. Your aspirations go up along with your income level. And you always want to aspire for that one little bit more than what you can afford today, right? We take a holiday, we take a loan. We buy a car, we take a loan. We always aspire that one thing extra more than what we can afford today and saying that someone will meet it tomorrow. And so this family's aspiration goes up. And so they borrow more. And the microfinance company is happy to give more. And the family is doing very well. And then now the income of that family has come to some level, and suddenly the microfinance company says, oh my God, now this family's income level has come to that ceiling. I should not lend to this guy anymore because he is no more a MFI eligible client. And so the MFI withdraws lending to that family. But the aspiration has gone up already. Schools, they have put the children in probably a better kind of schools. They have bought some TV and sofa and all that on loans, all kind of stuff. Their commitments have gone up. And the MFI withdraws. They can't give any more loan because you are now become rich. You are not poor any longer. And now not able to meet the aspiration and not getting a loan from MFI, naturally you start out and keep borrowing from wherever is possible, and probably on terms which are not as good. And over time, that family gets into severe financial stress, not able to meet those high cost debt, and finally their income starts coming down. And once it comes down, this MFI jumps up and says, now you have become poor, I can lend you again. Right? So these were some of the philosophical dichotomy that people are talking about, and it was a very intense debate in those days that what is the role of microfinance in society and what is the real impact it creates and things like that. But today, those kind of dialogues are not even happening. Those kind of articles are not being written, those kind of research is not being done, and there's no dialogue on those kind of stuff. It's all about how much money you put, what is the ROE you get, what's the valuation at your next round of investment. It's all about that. Okay. So in a way you can say it's sad, in a way you can say it's becoming mature, right? All that initial youthful enthusiasm of microfinance has now become more of a older, mature person's play today, which is fine. We can't go back and reverse history and get back to that old position any longer. So all that, some of the people who have been in the industry for a longer time may have this kind of feeling, but anyway, we have to overcome that. Now the question is about how to compete in the market and how to ensure that our company does well compared to someone else. And that is where organizations like Sa-Dhan really come in very, very useful, very handy, because unlike any other lending model, microfinance is tied to what our Prime Minister says. Hindi lesson,
Viksit Bharat. Viksit Bharat.
huh?
Viksit
No, not that. Sabka Vikas,
Sabka Saath,
Sabka Saath, Sabka Vikas, right? So microfinance is like that. You do car finance, right? Suppose there are 10 people doing car finance and 9 people are doing bad in terms of selecting a wrong customer and giving wrong type of loans, but you are doing correct client selection, you are giving correct LTV, you are charging the correct rate, and you have a good collection process. The other 9 companies will fail over time, but your company won't fail. In any other business, if you do well, you will succeed. You are not bothered about what others do. But microfinance is sabka saath, sabka vikas. If 9 people do badly and I am doing very well and I am doing perfect, I am following all the rules and regulations, I lose all my money also, along with everyone.
Not even 9, even 5 people do.
Yeah, even, I mean, it's not 9, it's even 1, 2, 3, any number of people who do bad, everybody gets affected. So microfinance is like that. So while we compete and we have to compete and we have to protect our institution and all kind of stuff, but at the end of the day, it is a community-based lending, community-based organizations, and we got to follow certain norms and disciplines, only then we will all survive. And why I am saying this is because we had so many crises in microfinance. The first crisis was the Krishna Godavari crisis we had in 2005. 2005 we had the Krishna Godavari issue, and then came the Kolar issue. 2006-07 was the Kolar issue and all that. And then in Maharashtra we had the Nanded, that was in 2007-08. And then came the big blowout which brought microfinance to the attention of the entire country, which was the Andhra and whatever, and so on and on, right? Then the demon, then the COVID. But if you look at all this crisis in microfinance, they were all triggered by an external event. They were all triggered by some external event. Something happened externally and it impacted the industry. 2024 to 26, the crisis that we have all gone through, and mostly I am assuming we are out of it probably now. First time in the industry, a crisis was triggered internally, not by external factors, but by internal factor. So we ran up to 4.5 lakh crores in no time flat, and all kind of over leveraging, and finally all across the country we had faced issues. Now we are down to 3.5 lakh crores, and things look to be much better. Which means that somewhere the absorption capacity of the client is at a certain level, and when we go and lend more than that, then the trouble is only going to be around the corner. And so when this happened, of course people were trying to figure out, okay, this time I have lost money, now next time when again a crisis happens, what should I do, how much money should I lose? And so that is where this whole concept of diversification becomes very critical, very relevant, as to what you do to diversify, so that microfinance, now we are kind of given up, right? Every 2 years, 3 years, 4 years, something like that, something or the other will keep happening. We don't know what issue will come, or we don't know what type of crisis will come, but something is coming all the time. So we are kind of reconciled to the fact that MFI will have its up and down all the time. And if I still, as an institution, I want to perform on a steady basis, then what do? Then diversification does become a very critical choice making for all of us. And so in that context, this program, what is organized by Sa-Dhan, is very timely, and I'm hoping that a lot of dialogues will happen and insights will come to all of us, so that we go back and try and see how do we make our organizations a lot more resilient. and more robust and more stable than what we are today, probably. So coming to the diversification part of it, yes. So there's a lot of products that an MFI can actually look at offering. There's a lot of studies in the government which indicates a kind of unmet demand from low-income people for various type of products. So if you take small business loans, which is for small businesses running a kirana shop or a restaurant, a eatery or something like that, there's a government data to show that there are about 45 million small businesses, 45 million households who are into small businesses in India. Out of there are 60 million households who are into small business in India. Out of 60 million households, 45 million households have a house property. Okay, so it's not exactly like you have to lend unsecured. No, not really. 45 million out of 60 million families in India own a house property and running a small business. Out of that 45 million families owning house property and doing small business, only about 1 million of them are linked to credit, formal credit. Just 1 million, that's all, right? 44 million households are there in the country who own a house property, who can give a security to the lender and still not getting loans for a variety of reasons. Okay. And the government study also goes on to say that the average credit requirement per household average is about 5 lakh rupees. So if you just multiply that, you are coming to 22 lakh crores. So there is a 22 lakh crore secured small business loan unmet demand in the country today, secured. And then there's other government reports on the affordable housing. Affordable housing is another mega story of a huge credit demand gap, and the total unmet credit demand in the affordable housing is estimated to be around 25 lakh crores. Okay, talking of 25 lakh crores on affordable, 22 lakh crore on small business loan, all of them are secured. It's not like you have to take a high risk and do unsecured. No, you can go and ask for your security and still have a huge potential to lend. And we are not even talking of consumer loans. These are only productive loans or housing loans. And surely there will be a equally large amount of unmet credit demand on the consumer loans, education loan or a two-wheeler loan or a consumer durable loan, whatever it is. So there may be an equal large amount of requirement on those kind of loans also. And gold loan though, anyway, I think gold loan is probably the only one which is reasonably penetrated across all income strata of India. So gold loan probably is already quite accessible to people. But there are a lot of other areas with a huge amount of unmet credit demand. So now how do we do that? And if I am an MFI, how do I start getting into all of this thing? And as Gigi was saying, now it is 60% eligible criteria. So 40% we have the leeway to do what we want. So first question is that can we have a clear target to say out of that 40% how much will be secured in a space of certain amount of time? How do I get into that? And second thing is for each one of us to take a call whether I am okay with 60% unsecured MFI. If you are okay with 60% unsecured MFI, then you can try and see what to do with the balance 40% space and trying to create some secured loans. But if you say that even 60% unsecured MFI is a risk for me on a long-term basis, then you'll have to see what to do to address that issue, right? Then you have to get into more structural solutions of creating subsidiaries which will do secured loans. The subsidiary can be a wholly owned subsidiary of your MFI. The subsidiary can do secured loans of whatever types, so that on a consolidated basis, on an overall basis, your unsecured can be at a lower level than even 60%. So there are various ways in which we can work at it based on our own comfort and risk appetite. We can do that. But clearly the time has come, I think, for people to seriously consider and take their calls on what they want to do on the diversification. There's a cost involved in diversification. It's not easy. Any new product you launch, It will take you not less than 2 to 3 years to break even and start making money, and 4 or 5 years before it becomes really profitable. And for that length of time, you will have to feed that product with capital support, right, to manage the losses. So there is a definite element of cost involved in diversification, but it's okay. I mean, in the long term, it's always going to be beneficial for us. So that's a cost that we have to bear. So what I'm saying is that it may be difficult for us to try and say that I will diversify into 4 new products all at a time. It may be very difficult. One is the cost, second is the capability, talent, attracting people with those kind of talents, and then managing those talents. At the top, whoever is at the top, that person should have some idea of what business he is getting into. If I don't know, let's say I don't know affordable housing at all, but I take some professional to run it for me, very often it runs into difficulty, right? The man at the top should have some feel of the different type of businesses, so that when you recruit people, you are also able to guide them, though they are professionals, but they still need some level of guidance and control from us. And so we should be a little careful in diversification, not jump too hard, take on too many things, and then maybe land into any kind of trouble based on that. So each of us, I think we should go back to the drawing board and see what kind of diversification we want to do, and at what speed, and what time frame. And once we have a clarity on that, of course we have to sell it to our boards, we have to sell it to our investors, assuming that we may have some investors also on the board. We may have to sell it to all of them. And once we sell it to everybody and all of us sign off, then we are okay. Then it's only a question of execution monitoring from there on. But the first step is clearly to have a plan and then get everybody on board onto that plan. And that is one thing. The other thing is, Gigi, I have a point for you, for Sa-Dhan, basically. MFI by definition is an unsecured loan, am I right?
Yes.
By definition it's unsecured loan, right? So it has to be less than 3 lakh rupee family income, correct? And it has to be an unsecured loan. Now, what is an unsecured loan versus a secured loan? There is some amount of generically understood definition of that. When you say secured, largely it reflects collateral security, right? There's a CGT-MSE guarantee scheme from the government. Under that CGT-MSE guarantee scheme, you can only get loans which are given to MSMEs guaranteed if you don't have a collateral security, right? But they don't provide primary security, right? Suppose I am giving a person, let's say 5 lakh rupees to buy a lathe machine, and he is buying a lathe machine. That lathe machine is, let's say, hypothecated to me, because it's created out of my loan. It's hypothecated to me. This transaction I can get it guaranteed under the CGT-MSE scheme, because the government does not consider it as a secured loan. Because the security is not a collateral, it's primary. So it's allowed. Okay. So now the question is, applying the same principle or the same logic to MFI. I give a loan to a customer with less than 3 lakh rupee income. She is using this loan for education purpose, health purpose, buying a TV, going out and spending money in a beach or a cinema theatre, whatever, right? It's a MFI. Clearly it's a MFI loan, qualifying under the 60%. Suppose I give this money to the same client, less than 3 lakh rupee loan, less than 3 lakh rupee family income person, and I tell her, go and use this money to buy a two-wheeler. Right? And naturally, when I give money for a two-wheeler, it will get hypothecated to me. So it's hypothecated to me. Does this qualify for the 60% or not? And at this point in time, the immediate answer may be that it doesn't, because you have taken the security.
But it's only a primary security.
But it's only a primary security. It's not a collateral security. So I think we have to see whether we can dialogue with RBI.
That should be possible.
Principally it should be possible, But we would obviously need a guidance or a circular from RBI clearly saying that primary securities are also accepted within the MFI definition. Then what happens is that, our 60% MFI need not be all unsecured. They can also be secured because we can also give a loan for a two-wheeler purchase or a TV purchase, and the TV can be hypothecated to us. Anyway, TV is a slightly more complex animal, but two-wheeler is a much simpler product to deal with. So definitely we can see whether we can give a two-wheeler loan and get it hypothecated.
Even a business establishment. Even a business establishment.
Even a business establishment where, let's say they are, it's a kirana shop, let's say, then I can get the entire stocks hypothecated to me. Because it's generated out of my loan, it's a primary security again. So anything which is created out of the loan I give, any asset created out of the loan that we give, if that is secured to me, at least philosophically,
I think that's possible.
it looks possible. So what happens, our 60% also, we can over time see how do we say how much of that can be in a secured form and the remaining can be the only one which is the unsecured form. So that's something that I'm sure maybe Sa-Dhan can help us talk to RBI and get some clarification that then will further help us in strengthening the balance sheet of NBFCs. Okay, so these are the few thoughts I thought I will share with you, and so it's the old order, the old world has all gone. Kalpana madam is here. I mean, the amount of time people like her have spent on the field, where microfinance used to maybe occupy 20% of their time, 80% used to be social activities. How to create better impact on the community, how to get them to manage their own life better, come together as a group, as a village group, and then demand from the government better service. And I mean, 80% of our time would have been spent on that, 20% would have been spent on microfinance. Those were the times, but today, obviously today times have changed. Anyway, we can't help it. So we'll now do whatever is possible today, and we'll try to strengthen our own balance sheets. And as I said, sabka saath, sabka vikas. So all of us have to be disciplined if we want all of us to survive. As simple as that. Thank you.
Thank you, sir.
Thank you, sir, for your thoughts, insightful thoughts, which will help us also to think in those directions. Now, I will request Jesus, sir, there is a small token of appreciation for sir, if sir can please. We want to set the context for today's further session. So, in the inaugural session, G.V. sir and Vasudevan sir have discussed around the current situation and what microfinance true meaning was and is. We want to throw some light on the opportunities which are there and the new enablers for a microfinance to go in the retail space. So first, we'll start with the regulatory enablers. How that regulators have given us some very progressive regulation which can help microfinance to go into the other direction. One is we all know, relaxation in the qualifying asset norms from 75% to 60%. Then collateral free MSME loan limit doubled to 20 lakhs. Unified lending interface. This is one thing RBI Innovation Hub is working on, and this has huge scope in microfinance and individual loan space. Then there is a co-lending direction in 2025 which allows NBFC MFIs to co-originate retail and MSME loans with banks. This also taps a cheaper bank capital for microfinance.
Any regulated entity.
Any regulated entities. Then there is a cut in the repo rate. The current repo rate stood at 5.25, which is also a good sign to generate more funds for the microfinance. Then also SRO guardrails, which we have the SROs have issued in April 2024 for better underwriting and client protection at the field. Opportunities for a microfinance in this current scenario. There is a massive credit gap, and according to RBI basic statistics, there is only 9.5% of total banking credit is from the rural segment, and this includes small finance banks, all commercial, scheduled commercial banks. And in a recent SIDBI report, it has been shared that there is a around 30 lakh gap in MSME funding credit. So this space could be an opportunity for microfinance. Then there is 80% of the microfinance customers are from rural areas, and they are women. And as Sir Vasudevan sir mentioning that PM's very well-known tag that Sabke Saath Sabka Vikas, one of the key agenda of government is also to have more women entrepreneurs. Lakpati Didi and other schemes they have introduced. So this also gives support to microfinance to graduate their clients to a MSME women entrepreneurs. Currently, microfinance is around 790 odd districts out of 800 districts, and there are 10,000 pin codes where microfinance is serving. There is also retail also gives the microfinance to product diversification, which reduce their risk on the microfinance portfolio, because microfinance, we know every 2 years there is a shock to the microfinance portfolio, which we have seen from 2016 onwards. In every 2 years there has been a shock and there is a loss of portfolio. So diversification will also secure the growth of the microfinance entities. Then there is access to new funding pool. This will also help us in different pool fund to gather. There is an underpenetrated customer base, as I mentioned. There is 80% of the microfinance in rural areas, and 97% of the microfinance borrowers are women. So largely there is an untapped demand in the Tier 2 and Tier 3 districts where we can go. Government infrastructure has also pushed in the rural areas in form of DPI's ecosystem. And also there is a support of MSME formalizing, where SIDBI is also working in for a portal and other things, which will help microfinance to go to the MSME segment as well. Then there is microfinance. Now I think we have reached in, we have covered half a century in India microfinance sector, and there are an improved borrower's lifetime. We have a lot of graduated borrowers which are not yet linked with the formal banking system, and they need working capital. So this could be an opportunity for microfinance to give them a higher ticket size loan, secured loans, which will help them as a working capital. There is, as I mentioned in the previous slide, that there is a circular on co-lending, which also strengthens microfinance prospect as business correspondent model and co-lending model. Currently, there are a few products which different microfinance are offering. In individual space, there are, for the graduating borrowers, they have retail or business loan, individual loans, then MSME and enterprise loans, small business loans, solar and clean energy loans. There is also clean energy agricultural product loans, some of the MFIs are providing. Two-wheeler loan, which is very common, and sir also said that this could be also included in the maybe qualifying asset. Gold loans and affordable housing loans. Though there are some challenges currently, one is that cash flow and underwriting gap. we all know that microfinance borrowers don't have a formal household income. So household income assessment will be for the individual also. Since it's an individual loan, there is no social collateral as such, there will be a getter risk. So that could be a critical aspect while you are giving an individual loan. Skilled staff, either upscaling the current microfinance staff or the field staff, or recruiting the needed field staff will be a great challenge. Conducting discipline that is also at the field level, so that it could be a challenge because we know there is a pressure of repayment. Economy is not actually working well currently, and that is a global phenomena, not only in India. Getting a geography district with better infrastructure, that could be a challenge, and also resource mobilization. So these are the few challenges we are forcing right now. During our discussion in different sessions, we'll understand how these challenges can be resolved, or is there any other challenges, and how this we can navigate in retail space. Now we'll move on to the next panel discussion. Our next panel discussion is on product diversification. Before we start our panel discussion, I'll request Manu Vatayan and Dolly Mishra from TransUnion Civil to give a presentation for a little context setting. And request to the civil team, the time is 10 minutes, so please keep it.
And commercial space, how the growth has happened. In March 20, like total portfolio outstanding balance, if you see, was around 133 lakh crores, out of which microfinance was contributing to nearly 1%. So portfolio was, I think, around 1.3 lakh crore or so, which we have also considered one interim time period of May 21, because that was immediately after COVID, and then February 26. So today, again, in between, microfinance has grown and it has gone up to the portfolio up to 4.2 lakh crores or so. But if you see last 15 to 18 months, it had de-grown by 15% or so. And today, portfolio would be around 3.2 to 3.3 lakh crores. So it is again contributing to 1% to the total portfolio outstanding balance, which currently is 296 lakh crores. So this is what, and overall growth, if you see for last 6 years, it had grown by 1.4 times around that. In retail space, if we see, so in retail space, if we see, like in March 20, the contribution was 43%, which today is to the tune of 53%. So in growth terms, if we see, retail portfolio had grown by 2.7 times. Accordingly, commercial space 2.2x and up to above 100 crores outstanding 1.8x. So primarily in this slide, what we can infer is the growth, credit market growth, that's primarily in India has been driven by the retail loans over the last 6 years, as we can see. So now further we have seen like how retail itself has grown, and then deep dive further into the retail. How is the industry and retail portfolio has changed over the last 6 years. So we had taken a couple of business lines, which are the significant business lines in the retail space, which is one, mortgages, business loans, others we have considered Kisan credit card, agri and allied loans, plus tractor loans, consumption and gold loans. So if we see the trend, like again, 3 timelines we have considered here, which is March 20, May, and then February 26. So if you see the contribution of mortgages, that has de-grown from 43%, which used to be in the March 20, to 37% today. So this majorly because of the merger we are aware of, like HDFC Bank plus HDFC Limited. So HDFC Limited was contributing the most to this space mortgages, and that has impacted the industry as a whole. So that's how it has come down as well. If we see other businesses like business loans, others, and consumption loan, so it has been growing steadily. I mean, it has remained more or less the same. It has, of course, not increased. But one noticeable difference, of course, as we all know, that gold loan space, if we see, it has grown from 4%, what it was in 2020, to 12%. So In value terms also, if you see, in March 20, gold loan portfolio used to be around 2.3 lakh crores, which today is 18 lakh crores. So this is 8 times growth which we have seen, which is very significant across all the retail segment. This is the fastest growth. So this is how it is. This is the retail landscape, if we see. Now, coming to how is the stress profile of retail space, as we talked about. So industry level, if you see 90 plus of all these 5 business segments which we talked about across 3 timelines, which is 2021 and 26. The delinquency has, in March 20 was overall, if you see, of course, business-wise also we can certainly we have highlighted. So it's 3.2%, which in May 21 has grown because of the impact of COVID after that stress was there, 4.4%, and now today it is around 1.6%. So it's clearly it's showing that delinquency is all-time low at this point in time. And this can also be substantiated by, if you see, the distribution of borrowers across all the civil score bureau segment, score buckets. So how this is distributed. So if you see, in the category of subprime and near prime, in February we had considered 2 timelines, Feb 23 and Feb 26. So it was 21 and 12%, which had come down to 9 and 19%. So certainly the bad borrowers have knocked out from the system and good underwriting is happening. So in the prime and above prime segment, 6% increase is there, which shows that there is significant improvement in the portfolio quality. And this establishes, it gets directly correlated with the delinquency which is coming down. So this is an overview of the stress profile of retail. And we'll now move on to the microfinance and retail overlap. So this is a very interesting story to look at, like how this overlap between microfinance and retail borrowers are increasing year on year. So there is a growing trend, and I would request my colleague Manu to take us through a couple of more slides on this story. Over to you.
Thanks, Dolly, for setting up the context of the retail segment. We have seen 3 basic inferences. The retail segment is growing faster than the other segments. The delinquency is at the lowest points, plus the composition of the portfolio has been the best, right? Now, on the overlap side, what we are saying is what is the convergence of MFI borrowers and the retail borrowers. So if you see live MFI borrowers as on September 25, they are close to 8 crore borrowers. That is 100% on the left hand side. What we have done, we have checked the presence in our retail bureau, the consumer bureau. So where we see 48%, so basically 1 out of the 2 borrowers have a presence in the retail, be it through an inquiry or be it through a trade line. Then we go to the second layer where we see borrowers with either a live or a closed trade line in the consumer segment. So 100% live MFI borrowers having a consumer trade line active or a closed trade line, that is 35%. Then we go on to the third layer, which is borrowers with live consumer trade lines. So in both the bureaus, the borrower has an active trade line in the consumer and the MFI space. That number is 25%. So basically here, 1 in 4 active MFI borrowers, we see that an active retail trade line is also there on the retail side. On the right hand side, so this is as on September 25, we have also checked the trend across 18 months from March 2024, then we checked on December 24 and in September 25. You can see that trend has been growing. So what was 25% in September 25 was 18% in March 24, the only live segment. This overlap has increased in the 18 months by 10%, substantiating the fact that the graduating borrowers on the MFI side are moving towards the retail side. Now, deep diving on the second part, the overlap segment, the 25% borrowers, we have checked how many retail loans and what is the total sanctioned amount on the retail side. So you can see across here, the count of retail loans is in the columns 1 to greater than 5. and the total sanctioned amount. This sanctioned amount is on the retail side. So you can see such borrowers, 61% of the overlap borrowers have only single live retail loan. Considering that the number of retail loans is still less, we are by this data on the retail side we see that they are not getting over leveraged. More than 5 retail trades, you can see there is only 6% population, so quite less population there. By total amount, if you see, 54% of the borrowers right now have more than 1 lakh sanctioned amount. 60,000, 65,000 is the average ticket size on the microfinance side, and on the retail side we can see it is majority of the population is between 50 to 1.5 lakh ticket size on the retail side. So high retail leverage again is limited to just 6% of the borrowers, so still giving us a substantial room to expand into the retail side.
This is in addition to the existing MFI loans.
No, this is only retail side.
No, the overlap, you're talking about overlap.
Yeah,
So this 6% you're talking is in addition to the existing
MFI, yes. 25%. So these are all 100% basically here is 25% overlapping borrowers in the previous line.
So Manu, can we say this is dominated by the gold loans, which is what we...
I'll come to that. Yeah, so on that point, what are the types of loan which retail are getting originated? So we have selected top 6 products here. These are the top 6 products which are contributing to the overlap. Here you can see business loans. So we have categorized unsecured, secured business loans, and that overlap is the maximum. 7.3% of the total 25% is coming from the business loan. Then we have gold loan, 5.5%. This is the type of product which has consistently grown across 3 time periods, what we had seen earlier. And then we have personal loan. So contrary to what we have on the MFI side, the unsecured, again it is kind of a consumption personal loan side. Here also we can see personal loan 5.1%. Again top 3 almost contributes to 18% of the 25%. Then we have agri, KCC, PSL and consumer loans, the consumer durables segment which we have on the retail side. Then what we have done, we have compared the delinquencies. So such same borrower, what is the delinquency on the retail side and what is the delinquency on the MFI side. So overall if you see on the retail side, this population, the 25% population has 2.3% 90 plus on the retail side. Same population on the microfinance side is having 3.7% population. So basically this on the MFI side we have seen 1.6x higher delinquency than the retail side.
And when you say secured loans, it's collateral security loans?
Business loans, yeah, on the collateral security.
This is unit based or is it live?
Sorry?
Is it unit based or is it live?
This is borrower based. So this is
Number of counts.
yes. Yes, delinquency is on the balances. The overlap number is on the borrowers. So how many borrowers out of the 100 borrowers, how many have a business loan? That is the number.
And housing is part of this and it's less than 1.5.
Yes.
So that's why it's not.
That's why it's not there in the chart. So housing, what we had seen, most of the women borrowers were part as a co-applicant and not as a primary applicant, and hence the overlap amount, the overlap number was very less on the housing side.
Manu, delinquency is higher on the MFI side. It includes unsecured loans also, the micro SMEs and all.
No, this is only microfinance loans, which are JLG in one.
Mentioned the MFI group.
Yeah, so retail base with MFI footprint, same borrowers on the retail side, and on the retail side, whatever submission is happening, be it secured, unsecured, this is not, does not include commercial MSME loans. Moving on to the next slide. Now we have understood how the borrowers are getting how the convergence is growing. Now we try to understand how to separate the riskier customers and how we can find out the opportunity in the borrower base. So here is an approach to identify.
One question on the earlier slide. Because MFIs we consider it as a household, right?
Yeah.
So for the housing key that you just mentioned, when you said you just consider only the applicant, then this data changes, right? Because MFI we consider the household income.
Yeah.
It's not an individual income that we consider, right? And when we try to overlap just with the applicant, co-applicant, wouldn't these figures change then?
So we have not considered, these are all individual borrowers. So
question is that if you take the co-applicant also, you can also as part of it.
It might look
yeah,
different.
it might look different. Yes, we have not included co-applicants as well. These are all primary borrowers, both submitted in the retail part and on the MFI part. So what we were looking on to the next step is how to approach and identify such borrowers who have, who can show a potential for a cross-selling retail loans. So we have an honest MFI portfolio base with us, the lender. Then on the MFI score, what it distinguishes a bad customer, a long tail customer with high risk, with a low risk, good potential customer. MFI score along with microfinance credit vision algorithms, which are the risk algorithms, these both help you assess the risk of the customers, providing with a lower credit cost. Then we have the affordability indicator, which helps with the household income, which is submitted, I guess, since March 2022. After that, all the disbursals have an household income in the bureau, along with an EMI to compute the obligation ratio for it. Then we have the propensity score, specifically establishing the need and the borrower's requirement to a specific retail product. That will help you, along with the affordability indicator, lower your acquisition cost and marketing cost, indicating a specific borrower segment or a specific borrower base from a 100% overall base to a basically low risk segment and a potential borrower part to cross sell on the retail side. This you can specifically on the lenders, for the lenders, for specific business needs, we can create custom scorecards basically based on the risk appetite of that lender and what are the business growth segments. So here this is the MFI score. What we have done, this is industry originations from July 24 to December 24. We have taken 6 months of data originating in this period. What we have done from December 24 to the next 12 months, we have seen how the borrower has behaved on their repayments. So on the axis, you can see 300 to 650, that is the high risk segment, and then 650 to 720, then 720 to 900. The last segment, the 300 to 650, the 10% of the population you can see has a bad rate of 23.4%, while the lowest risk segment has a bad rate of 6%. So this is almost a differentiation of 4x from the low risk segment to the high risk segment, providing you an opportunity to shaft out the highest risk segment or have an additional set of checks on that side. The average bad rate for this population was 12.4%, and from there also the low risk segment gives you a 2x of the almost 2x difference on the industry average from the low risk segment. So this is how MFI score helps you on the underwriting acquisition part. Then we have specifically risk algorithms. So we have utilized multiple algorithms. We have almost 150 plus set of algorithms which can be created custom scorecards based on your specific lender's portfolio, MFI portfolio. We have also introduced the guardrails cohort. This as a cohort can provide you in the CIR the additional whatever rules has been built by the SRO guardrails. So such as live lenders. So count of live lenders while doing a credit assessment, you can see up to 2 live lenders, the delinquency is 4.2% as on September 25. That number, once the number of lender crosses 4, that number goes to 10.6%. So again, 2.5x delinquency jump we can see on the live lender segment. Similarly, on the outstanding balance, if the amount crosses 2 lakh, we can see again the delinquency going upwards.
Excuse me, the MFI score that you talked about,
Yeah.
have you really changed the parameters in calculating the MFI score over the years?
Yeah, so we have currently now it is second version of the score. We had launched the first version.
You remember you showed 300 to 540. Let's say the 300 to 540 in 2022, right?
Yeah.
Same as 300 to 540, right?
So it would differentiate that way. So in the next one,
parameters,
the variables in going into the model
is the same.
No, it has also, so a new version of an MFI score always comes with a new set of variables which gives a distinguished risk on the previous score.
I mean, in fact, this is one of the problems of the industry. I mean, I keep highlighting this. I think the credit bureau agencies can play a huge role because, you know, the individual institutions have only their own data, right? The credit bureaus have huge data. You have a pan-India data, you have vantage point, right? Okay, the risk flagging, okay, has to be much more really dynamic, okay, in that sense, right? I think. See, now that's what I'm asking. Is 700 okay in the current context? Maybe 700, even 600 okay was okay in 2021, for example, or just before COVID. Okay, so I think, are we moving the parameters dynamically, okay, based on the data set that we have, right? And in fact, you need to keep raising the flag. Okay, come on, guys. 600 last time, okay, is not even good. With 700 right now. Do you understand?
Yeah.
So I think that scoring also has to be moved in tandem with the algo score that you talked about.
So on that note, so basically a specific 700 score would be different for a X lender or a Y lender. So probably one lender.
That's what I'm saying, because everybody is having this unique really score, right? MFI score.
Yes.
You take IMARC, you take TransUnion or really Equifax, right? Everybody goes, per the score card. Is it the constant scoring method or have you changed? I think we should change this. The message.
And we keep on coming up with different versions depending upon what weightages to be given to the
that needs to be
parameter.
communicated, I think, to all Gigi sir. I think that's one thing that we need to work with all the credit bureau agencies, right? Are they really
Everyone may
changed?
not be using the same set of parameters, they also have their own way.
No, because the data set is the same for all the.
Should have been better, but only it doesn't happen. I mean, every rating agency have their own set of.
That I understand.
But he's
But
talking
I mean,
about communication part, like if the score is changing or some new version has come up.
No, that's not my point. My point is, have we moved, okay, the parameters dynamically over the years? Or have we kept the same parameters to come with the
The parameters keep changing.
Yeah, the variables keep changing. With the newer version of a score, so let's say MFI score 1.0 is there since April 23.
Is it changing across the industry? Is the point? I think we need
That we'll have to find out.
We need to
We'll look
engage
at
with the
it.
credit bureaus to see they have to move dynamically the scoring. Otherwise, we'll keep coming back to the crisis. Because this industry has become crisis proof, right? Okay, that's the nature of the thing. But how do we get out of the curve and try to really flag the issues? I think the credit bureaus can play a huge role.
I understand. I get
Thank
it.
you.
I just want to on this stage. Our next session is on product diversification in microfinance institutions, strategies, risk and scale up. So moderating the session, we have Professor M.S. Sriram from IIM Bangalore. The eminent speakers of the panel is Ganesh Narayanan, MD and CEO of Credit Access Grameen, K.S. Raman, Executive Director, Jana Small Finance Bank, Kalpana Shankar, MD and CEO, Varashakti Housing Finance, Muthukrishnan N, Head Emerging Financial Institution, Sundaram Finance. I'll request our moderator and the speakers please join us on the dais.
Thanks a lot. I think we are running a little late, but we'll try and that's my job to moderate the time. So let's see how we can do it. So very briefly, as I was listening through all the presentations and what Vasu spoke, Gigi spoke in the morning, 2 or 3 things which I'd like to flag, and obviously I'm known to be controversial, so I'll continue to be controversial. One is, have we really mainstream microfinance? Think about it. Does the microfinance customer deal like any other customer with the institution? No. Have we mainstream microfinance? Are we lending differently? We made a little bit of tweaks here and there, changed a little bit here and there, but ultimately there are 2 forms of group loans. The borrowers are taking group loans, and MFIs are lending as a group. You go to a village, there are 8 MFIs or 10 MFIs lending, so that's also a group loan in a way. The supply is also group. So what are we mainstream in microfinance? We only mainstream the investments and the returns to the investors. That's the only thing that has been mainstream. So let me park that there. Second, is there a growth possibility in microfinance? We have referred to multiple crises starting from Krishna, Kolar, AP, Nanded, Assam. You can keep going on, Amravati, you can keep going on. And then now the national crisis. Vasu said this was externally triggered. My submission is, if it was not externally triggered, 6 months later it would have been internally triggered in those places. The crisis was building up. I mean, politicians don't come unless there is a little bit of fire to fan much more. If there is no fire, whatever fanning they do doesn't happen, right? So let's keep that in mind. So in a way, I think there is no significant growth prospect for the markets that we are in. The growth prospect is possibly 5 to 6% CAGR as a sector and not 25-30% because we have saturated the market in a way. Now, when we say diversification, we are actually looking at different sort of clients and not the clients that we are working with. So you are now acknowledging the fact that we have saturated the market, but you're not saying that we have saturated the market. You're saying, okay, let's look at new clients, new products, new ways of doing business. Can we, within those clients, can we see an overlap and things like that? So I guess that's where we are, and I think it's a good thing that we are looking at it because please remember the appetite for growth of a microfinance institution or an NBFC working there is far higher and much more burning than the appetite or the rate at which the customer herself or himself is growing. So this is sort of acknowledging what Deepti's colleagues are saying, Dojiraj and others, who are saying that look, it's not a supply side problem any longer. It's not about funding not available and so on. And for some strange reason, we have said that we will transfer our problems to transusual guardrails, credit scores and things like that. We need to look inside, right? One more thing that I sort of make this point and then hand over. Even within the banks, where the banks have acquired microfinance institutions and taken them in, please remember the only the portfolio has gone to the balance sheet. The people have not gone to the balance sheet. Right? So obviously there is something that we are not reading structurally in this business, and we are constantly saying, okay, business as usual, green shoots, every 2 years this is a crisis, we get over this crisis, next 2 years we'll prepare for the crisis, we'll get over that crisis as well. Life is no longer that, right? Okay, I'll I'll stop my rant here and go to Ganesh and say, with this rant, Ganesh, how do you see your own diversification plans? Obviously, your original strategy, from what I understand from Uday, was that there would be a geographical spread on a blotting paper style that you would go from district to district, and the only inorganic growth you had was the takeover of Madura. So, in a way, have you reached the saturation as far as your geography is concerned? And are you deepening with your existing clients, or are you looking at different client groups? And how do you look at it?
Okay, thank you for the question. I'll spend 2 minutes to probably speak something generic. Since morning, what we've heard, I think there is not much more sense that we as a panel can add between Vasu, Gigi, Sriram sir, and the bureaus. You've covered it all. We will only probably be deliberate a little more around it. But my first thought always, even when I speak to my team or anybody outside, is somewhere in the process of growing microfinance. Like he said, from the earlier times, I've seen microfinance for the last 30 years now. The first time we started lending to microfinance institutions, they were doing 5,000 rupees loans. From there to 10, 11, 12, we are around 50, 55,000 at this point of time, right? But I think in this entire journey, what I heartfully feel is microfinance in its process, it goes through cycles, everybody understands, we go through pain, we make mistakes like anybody else, we learn, we correct ourselves. But I think the purpose that it serves, there is no match. I would humbly submit that I've not seen any segment willing to put that extra effort to take that money to that person today who is wanting to do everything in life, but just does not have access to money. Right? I can narrate a million stories. I travel extensively across the country. My heart does not agree, to a wrong narrative around microfinance, in the sense that, be it pricing, be it over-leveraging, everything happens in every sector. Real estate goes through cycles, power goes through cycles. Any sector you take, we all go through cycles. But I think the purpose that this business serves is unparalleled when it comes to financial inclusion in India. I'm sure Professor Sa-Dhan seconds it. He has highlighted certain risks and issues, but I think this narrative somewhere, people as they grow bigger have even lost within institutions. See, when I speak to my teams today in branches and fields, the first thing we try and talk to them is just see how we change lives. Right? Simple stories. One handloom, I saw one customer in Odisha, one handloom, she's just a jobber, 350 rupees per 2 days is all that she makes. 50,000 rupees doubles her income, 100%. None of us have the liberty to double our income like that. Another example, daily, you invest 50,000 to 1 lakh, 10,000 to 15,000. It can range, right? So we're talking about a hybrid curve. I'm sure there are experts here, but ballpark figure, what I understand, if somebody has 1 cow, they can make 10,000 bucks. If they have 2, you can double. But if they have to save and buy the second one, it's going to take ages for them. It's not going to work. So that's the gap that we're filling. I've literally seen customers graduate from microfinance into retail and even bigger. Like last month, I met a customer in Karnataka who had 2 cattle. Now she has 12. She's making 1.2 lakhs minimum per month. Right? She's already taken a loan in his property from us. She wants to pre-close the loan. Now in mortgage, we don't allow pre-closure, right? So what happens if somebody pre-closes? You expected the loan to be 7 years. Now if she pre-closes in 2 years, then you have a problem, right? But then we thought through, when I saw this customer's house, it is still a tile house, very simple house. They've been living in this house for 20 plus years, right? If you see the cattle shed, it's top notch. It has better living standards than their own home, right? So my thought at that point of time, if I create a product for this customer, where she borrows, she increases income, but she actually closes the loan quickly, doesn't matter. The next thing she's going to do is work on her home, because everybody wants your income goes up. You work on improving your home, you work on your children's education. I think if we keep our focus like that, to build products that suits our customers, we will do well. So clearly, microfinance, I feel, will still continue to be an entry point for everybody trying to enter the formal microfinance, unless there is a strong alternative. Today, in spite of 30 years, in spite of so many crises we've seen, after every crisis it grows because the need is so strong, the need is so big. I think whatever numbers we're talking, it's much smaller, right? So I think that will remain to grow, that will remain an attraction, that will remain as a business. But in my view, what's going to change is today, like all of us aspire from a simple savings account to wealth to private, your microfinance customers also got choices today, right? So if you see 48% overlap in retail, it's a clear story, right? Because the customers are moving up, institutions are held back. So that's the transition that's going to happen in my view. And if we play it well, it's a wonderful opportunity. For example, in case of credit access itself, where we geographically spread out, we are in 450 districts of 700 and odd in the country. We're the largest, whatever we call it, large is relative, right? We have only 7% of the customer share in the industry. We look at it that way now, right? So very small. We can't just go out saying I'm the largest. Nothing's going to happen to us. Many things would happen for us. So things are changing, right? So we will spread out. We will continue to grow microfinance. We still feel opportunity potential. The new potential could be lower. Like Sir said, it's possible. The new potential is lower. It will be a lower rate. But there is still growth potential. There are still areas we can grow. There are still areas, as an institution, we can actually do better to get customers from others. Definitely there's competition. Definitely there's pressure on pricing. There is definitely efficiency issues. But I think all of this we can figure out with the right approach, with the right strategies around it. So microfinance is here to grow. The customers are changing. Customers may not be with you. For example, when I go in Karnataka today, last month I met a customer who said, "Sir, I retired from your company. My daughter-in-law is your customer now." Right? So we will not have that liberty going forward. So that's over. So 3 years, 4 years, the moment they're able to get a credit history, they're able to borrow from retail. They want to move up, right? So either you give it or they want to go out. So once you keep acquiring, with guardrails, your approval rates have come down. So you're going to start leaking very heavily. So you have to start working on acquiring more customers. You have to start working on retaining customers timely. You also have to work on graduating yourself to the next need of the customer segment, which is improved. Right? So clearly, what we are seeing over a long period of time, microfinance customers directly don't jump to banks. That's a very small portion of customers who directly go to banks. There's a very long period of travel they take from microfinance probably to an NBFC and then to a bank. Right? So that is a natural course. Some of them who are misfit will jump directly into banks. But I also do appreciate one of the earlier discussions that happened, that these impact stories I'm talking about, these narratives, those have slowed down in the industry, right? So the impact is not felt. But I can feel it as a practitioner, I can feel it as somebody who meets at least 100 customers every month. It's so strong and the demand is so high, right? And the moment they move from microfinance into retail, we will have to step up how we do business. We cannot just do how we do microfinance, so that means we need to add skill sets. But I just think that that's a wonderful opportunity for a microfinance company. I would still not think diversification as the first objective for de-risking. For us, we are looking at diversification purely as a path of following a customer, right? So when customers are moving, say for example, they quoted about Smile, right? So Vasu has quoted about Smile. So we were one of the first lenders to Smile. So when I used to go do center meetings in Smile, the groups were homogeneous at that point of time. 20 years back, the groups were homogeneous. 20 years of microfinance also. Since the graduating path was not clear, a lot of customers who could not access bank finance, not necessarily 3 lakh income, still continue in microfinance, right? So my argument is that if somebody is coming to microfinance, irrespective of the income, we should accommodate. The regulation is different because somebody is coming to microfinance because they are not able to access finance elsewhere. So why stop them is one thought that comes to my mind. So just a thought, but we'll have to play with regulation. But if we create products, we can actually bridge the gap between microfinance and bank very very, very nicely. And it's a good win-win for everybody, right? So say every year, around 8% of our customers are moving to retail finance. Every month, 5,000 customers, 300 crores of mortgage loans is getting booked from my own customers. We are not touching that so far, right? So we are doing only 30 crores. The last point I want to say, opportunity is very, very high. We pick up products well, we build for it. Like the earlier speaker said, you have to invest capital, you have to bring in talent, you have to think about it. You have to have controlled pilots, you have to scale up with a lot of balance and sense. But the future looks brighter because microfinance can be your entry point strategy, like how Bajaj grew from 1 or 2 product to such a large institution over a period of time. Microfinance, in my view, is an entry level. When you have large base of customers and a certain portion of them are moving up, if you actually work on it well, it can play out really, really well for the institution as well as industry. And that is the direction which we are working on. So we will penetrate further into more geographies, more villages, more districts as we operate. But we'll also keep an eye on what's happening in our customer segment. We build products, we retain with us longer. One important reason why we took this journey, Shriyam, of 3-4 years back is what we saw. While I lent microfinance loan at a certain rate, which probably is one of the lowest in the country, my customer, as she graduates, she creates a credit history. She goes and takes a mortgage loan from another NBFC at least 3% higher than my microfinance rate. It just doesn't make sense for us to lose that customer. So what we are trying to do is retain that customer, make it interesting for her. She gets cheaper. I get longer lifetime value. As a process, I retain customer longer and have larger lifetime value. So this is broadly the direction that we are moving on. I hope I answered your question. Yeah, to an extent, but anyway. Let me sort of, there are others as well. Yeah, I mean, basically the takeaway for me is that you're going to grow with your current client base and diversify their income sources, which is a fairly interesting way, and saying that their own vulnerability is also taken care of because you're doing additional financing. Yeah. Just one point here. Yeah. Just one point here. Sorry to block you. Just to give you a demonstration of what we're saying. There is another narrative, right? So if you're not acquiring new set of customers, then you probably are doing the same microfinance in a different way. But if you choose your customer well, it behaves well. For example, for the last 3 years, we've built the graduation product for our own microfinance products who moved up, in cash flows. When we went through such a severe credit cycle in microfinance, this 2,500 crores book, which is roughly around 3 years old, did not have an impact like microfinance in credit cycle. Right? Our overall PAR in that book was less than 2%. So that means that, assuming that all microfinance customers are microfinance customers, and as long as you're going to do more things with them, probably I'm not able to agree to that theory. That if there is definitely a certain portion of one, not everybody will move up, but there is definitely a certain portion of them. People are moving up, right? So in one of the recent studies I saw that almost half the country is going to move up to middle income in a few years from now. Right? So things are changing, people are changing, but if you actually do it well, even within your own segment, you can identify customers who are better off and do this. What comes to mind? Thanks. Yeah, I mean, it's an interesting proposition, as long as you have identified those who are moving up well. Also, it is also important to identify that some people don't move. For example, I mean, since you give anecdotal evidence, I also give anecdotal evidence. Like the 12 cow example, I have my newspaper wala who is intergenerationally supplying newspapers. He's not true. My vegetable wala is not true. Okay. So there is a large part of it which doesn't grow, and there is a small part of it which grows. That's point taken. So, but your approach is largely to be with the clients and grow. I mean, that's your diversification strategy. Fair enough. Let me go to Mr. Raman. One question I would like to ask is how has life changed as a bank for Jenna from being a microfinance institution vis-a-vis this set of clients? I mean, obviously, as soon as I came in and I said hello to Vasu said microfinance is only 10% of my portfolio. So life as a bank has changed. But
has the Vasu being a bank, has the life changed for the customer is a question that
First thing, Professor Sriram, is I think I agree with your assessment that the segment in some ways is saturated. And then one of our philosophies was there's going to be a lot of asset correlation if we lend to those same segment in a different form. And therefore, and then just two things, from a overall asset standpoint, we were 95% microfinance when we launched the bank. We're today about 27% microfinance. So that is the first point. Second point is from the same set of clients, we haven't really grown a lot more. Although in some ways, I'm also agreeing with Ganesh that there are some segments where there is opportunity outside. We've scrubbed our microfinance book against the bureau. There's a lot of people with gold loans outside or mortgages outside. So there is definitely potential to grow, but you need to choose them. Otherwise, you're going to have the contagion effect affecting the portfolio. So what we did was we looked at affordable housing as the first engine of growth. And technically, it is not the same segment. We're looking at an average ticket size of about 10 to 12 lakhs, which clearly is a different segment as compared to the typical microfinance segment. And then that was our first engine of growth, and today that's contributing about, other than microfinance, that's probably the second largest asset class in our segment. In parallel, then we looked at MSME. These were business loans with loan against property. Technically still part of financial inclusion because they're not necessarily getting good banking elsewhere, but different segment, obviously different segment because you're looking at average ticket size of 60 lakhs. So that's really how we grew our book because we said that diversification is not just product. There is clearly asset correlation and therefore we need to get out of that. And these were some elements that I joined as the founding chief risk officer about 7-8 years ago. And this was one of the first pieces that we said we agreed with the board that these are the elements of diversification we look at, both in terms of product, geography, as well as the kind of customers. I don't know if I've answered your question.
I have a supplementary. Since you're a bank, is there anything that you've done on the liability side? In terms of the inclusive customers, the ones who are borrowing with you for microfinance?
Answer is yes. I mean, has it been a resounding success? The answer is no, not yet. But what we've done is we've done a few things. We looked at every microfinance customer, we encourage them to open a savings account with us. We encourage them to keep a balance with us, and we encourage them to try and make the payment through standing instructions on the savings account. It succeeds substantially on the individual loans, not necessarily on the group loans. The group loan, the other fear we have is that we will break the group discipline as well. The number two is direct benefit transfer is really an engine of getting more and more people getting their DBT money transferred into Jana Bank. And at the time of acquisition, we try and get this DBT account transferred. It has had relatively modest success, I would say. And I do believe that there is a lot more room to grow. I just came back from a conference with my team. And all you need is one EMI in each account. I mean, we have some 15 lakh customers who are standard assets. One EMI can contribute a reasonable sum of money in terms of CASA balances. So that's really how I would look at the whole liability piece.
I mean, since you're the only bank, let me ask one more supplementary question. I mean, would you look at the liability side involvement of the customers as a de-risking strategy, that they have a greater skin in the game in terms of deposit, and therefore even, I know one of the reasons why banks don't go to small customers, it's extremely costly to manage these deposits because they are small deposits. You can't do variable pricing on deposits while you can do premium pricing on loans and so on. I understand the economics of it. But do you think you can use this as a de-risking strategy? And have any of the small finance banks beyond Jana thought about it as a de-risking strategy?
To answer your last part, I would imagine people would have thought of this. And I do believe it's a great de-risking strategy. We did our own portfolio assessment. We compared people who have standing instructions on their savings account with Jana versus a NASH with another bank versus people made of field collection. And clearly the portfolio delinquencies are starkly different. It's like chalk and cheese in terms of the kind of delinquency that we see. So I do really believe that it's a huge ability to de-risk if you go more and more towards the liability side. So
let me move to Kalpana. Kalpana, you've had a fairly interesting journey from SHGs to Belstar, which went into sort of MFI type of lending, now to housing. How's the journey been? I mean, you moved from small tenor, possibly high interest rate regime to somewhere where you need to be patient, and obviously because of the compound effect, you can't have a very high interest rate in the segment that you're in. So tell us.
It's always very interesting listening to you, Professor, and your panelists. Thank you, Sa-Dhan, for this opportunity. According to me, once I took over as MD of Varashakti, I saw the overlap with MF clients. I'm also very passionate about microfinance like Ganesh, but the reality is depends upon the state where you're operating. Because of the ordinance in Karnataka and Tamil Nadu, the overlap was significantly high at Varashakti, leading to delinquency. So the first step which I had to take is moving away from the microfinance segmentation and focusing on higher ticket loans and higher incomes. To answer your question, yes, microfinance is a high velocity game where we focus on numbers, but the real problem I would like to talk about the sector, especially about microfinance, the 2 to 3 points which I would like to highlight. One, the income has not risen to the extent we have increased the loan sizes, because I'm talking about 2012, 2013. The typical loan size used to be 15,000, 20,000. They were very honest, and repayment above 99% was the norm. Now, if you go to the villages, I also travel to most of the villages in TN, the income has not increased because of alcoholism. The family, the income is actually, they're in a debt trap. So, but we have continuously, we have been increasing the loan cycle. I think that is one thing which I felt, if I have to reflect on what we could have done better, was in the increase in loan cycle. And also government coming up with the same 3 lakh norm for all the states. I think the income is very high in Karnataka, Tamil Nadu, Telangana. We cannot have the standards of a Jharkhand or a Chhattisgarh for a Tamil Nadu and Karnataka. So the income level assessment and the ceiling itself was a problem. Third, I would say, like even to talk about housing, what we did was, once I took over, I said only the 15% overlap with the microfinance clients, either the client or the spouse. We want to go away from that sector, basically because any ordinance or anything, it affects both the businesses, so we had to be careful, and we went up the ticket pricing and also the family income. So it is interesting to pursue microfinance, but now we have to rely on alternate data, digital technology, because only with that we are able to handpick good customers. But all that is becoming, and even if you talk about CGF, everything, the profit margins are not like before. That is, most of the investors are not confident. I feel institutions like Sa-Dhan, at least once a year, you should facilitate meeting with all the CMDs of banks and even investors, because investors' morale actually echoes in the boardroom. And with 40% diversification, another problem which I foresee now is not all the boards are equipped to handle multiple products, because they set the tone for how the management should behave and how should the progress be, because each one's So their thought process is very restricted because, as Mr. Vasudevan said, it takes 4 or 5 years for you to specialize in one domain, get work out of the management, and also steer the company in the right direction. These are some of the things I feel we should address. There is scope for microfinance, but it has reached, we have to accept that it has reached some saturation, and we have to be very careful because they are not having the income, then they opt for suicides and other things which becomes a media news. And one small incident like that, the ordinance is given to police to manage, not the legal people to take charge. So all that becomes a huge problem for the practitioners.
Thank you, Professor. Going beyond the remit of this, you seem to indicate that the boards are powerful. Recently, there was a CEO who said there might be disagreements with the board and we agree to disagree, rather than comply with what the board says. So, in a way, I'm very happy that, having been a helpless board member, I'm happy to see that somebody says that the boards are powerful. But nevertheless, one thing is, are you forget about the returns profitability? Of course, as the tenor keeps going up, you know that the profitability goes down, the compound effect goes down, your ticket, your sticker price for the interest rate will obviously have to be lesser and so on. Be that as it may, are you in a more comfortable zone because there is a collateral which is a house, and that is not only important but it's also sentimental, and therefore it's a safe zone to be in, and of course it creates this shelter for people, particularly if you're looking at the inclusive this thing, which is sentimentally also very fulfilling in one sense.
Definitely, it's not about the ROE. Basically, the investor community, I want to reiterate, they feel a company can either do group loans or microfinance or secure product. They think very few management have capability to do both the products. That is a fundamental problem. It's we can deliver both the products. Second, if talking about microfinance clients and inclusiveness, I feel we should not trust them with more loan products when they don't have the actual income increase. Home improvement loan, like building an extra room or a washroom or a compound wall, which brings safety to the family, all those things are important, and it is an emotional product, but only they cannot be treated on par with the housing finance segment, because it is a different market segmentation according to me altogether, and they can be given only loans up to 1.5 lakhs, because we appraise them in microfinance for a loan of 50,000 or 1 lakh. Suddenly exposing them to 5 lakh, 7 lakh, 10 lakh, we are increasing the risk for the organization.
Yeah, in fact, 2005 when we did a study in Dungarpur district in Sa-Dhan, we found the same thing, that a housing loan is typically 3-year loan. 1 year of build-up of savings and 2 years, then borrowing and 2 years of wind down, and they add a room or a cow shed or improve the roof or improve the flooring or something like that. Yeah, this segment behaves differently from this. Let me go to Mr. Muthukrishnan. You are, in a way, you're an outsider to this room. So how does it look? कैसे दिखता है वहाँ से? As Mrs. Gandhi asked Rakesh Sharma, how does the Bharat look from the space? How does microfinance look from where you are? And is this a segment that you would like to enter aggressively or no? Having listened to all of us.
Thank you. Thank you for the opportunity. I hope I am audible to you all. अभी मुझे एक ही बताना है सर, being an ex-banker, अभी picture अभी भी बाकी है. So that is the way I would like to believe. And hailing from or representing Sundaram Finance, like Vasu sir said, our leadership believes that everyone in the company, irrespective of their position, should have a ear to the trench. So that way, I'm not an outsider really. We started partnering the NBFC business since the last 10 years, and that coincided with some cycles which microfinance also went through. And typically, like we operate in Sundaram, I myself was part of a group which travels the length and breadth of UP, Rajasthan, Madhya Pradesh, Tamil Nadu, and to understand the voice of the customer, the pulse of the market. And we submitted a very detailed report to the board. So two noble objectives I still recall. One, women empowerment. It is more than what vocally we see these days through celebrations. And number two, financial inclusion. At a broader level, when I speak about Vasu sir, Ganesh, Sriram yourself, you spoke about that. So I'll be lot of my conversation will be overlapping. So what I feel is that we are as a country looking at Amrit Kal, Viksit Bharat, and financial inclusion will be a key part. So microfinance definitely has contributed to it, and it should contribute. Now, what are the strategies to grow this is something separate. So having said that, when we started looking at microfinance, we in our company, this is a separate business. We are partnering NBFCs, and we have almost 30% of our book was microfinance. So that much, all the who's who, all the names we am associated with. I have been part of conversations with very senior people and at the ground level people in microfinance. So this has been our role. So that way, I'm not. I don't want to be called as an outsider, and I'm looking forward to it. Sorry if I have. So coming back to the topic, diversification. So being an ex-banker, when I started working, we always believed that lending is only for income generating purpose. No lending should be done for anything, for any asset which does not generate income. So diversification should not be restricted to product. So when you look at, specifically look at the RBI guidelines regarding the microfinance, 40% of the disposable income towards the diversification of product. When you look at that, is there any, the end use is very critical. Whether it's a gold loan, whether it is a two-wheeler. Now, gold loans, one of the areas we grew last year was in gold loans. Gold loan is no more a sentimental product. It is not the Mangal Sutra bech ke mein paisa nahi. That concept has gone. Gold is used more as a working capital product today. So, and across, earlier it was only the south which dominated the gold purchases. Now across jewelry shops, across north, south, east, west, you have a good number of customers, walk-ins every day. So this way, whether it is a two-wheeler, and two-wheeler is moved depending on different geographies we operate. Two-wheeler is also used as a transportation vehicle, right? So I have seen that. So I would feel that diversification should also ensure that the product should earn some income. Then only that will be justified. And how much to penetrate in that 40% is something we should reflect. So this is my view on the product diversification cycle. Then coming back to the geography. Geography, somebody said 10,000 pin codes. So only 50% is penetrated. Around 19,000 pin codes are there in this country. So much as we have spent a lot of energy in acquiring the existing customers, as Mr. Ganesh said, we should definitely deepen the customers. And if you look at the customer life cycle in microfinance, the first cycle, the second cycle customers, the third cycle, these are the set of customers who migrate to banks to satisfy the PSL requirement. So NBFCs with their last mile reach should ensure that the acquisition in the existing geographies happen. And coincided with that, look at India's demography, 35 years of age or 40 years, young population. So there's an opportunity there. So this is something we should look at. And the remaining pin codes, mapping, whatever we do, we should focus our, there is a lot of opportunity there. And I feel microfinance should be treated in a different way. And again, coming back to boardrooms and investors, how much investors have impacted this business in a positive way is something we should reflect. whether I want 2x or 3x from my investment in microfinance, or whether I have deep pockets and patience to stand the test of time and stay invested. So these are all some of the objectives which we should reflect very deeply. So product diversification is just one side of the coin. So this is my view. Thank you for that.
Before you sort of lay your mic down, let me ask a supplementary. I mean, with the current financial crisis that may be looming, we don't know. I mean, there's a lot of murmur about it that we'll have a forex crisis, we'll have very high inflation and so on. Do you think that is going to affect the sector in any way, like for instance, the 2008 financial crisis did not really affect the inclusive finance customers because they are sort of insulated and they're not completely integrated into the financial system. So what do you think if there is a crisis, what do you think is going to happen? Can we have a crystal ball? I'll ask the same question to others also, so I'm not sure.
So I hope you get better answers there. Coming back to Sriramji, I was part of the banking system in the 2008 subprime crisis.
Right.
So yes, the impact, one of the favorite answers was that the Indian financial system had a parallel economy operating. So it was not much affected. Whereas in the European and the US economy, it was different. So then coming back to the present thing, again, who are the microfinance beneficiaries? If they are addressing the essential commodities, they are supplying into the supply of essential commodities and supplying to the market and contributing to the economy, then I don't think it should affect much. We require them. For example, the impact of buffalo loans or milk production in the country, I don't think it's going to change. In fact, a lot of these, being a banker, I know a lot of things get exported outside India, and it's a huge market.
So you think it's an insulated?
It is insulated from the demand side. From the supply side, how the financial system, the bankers, the NBFCs support them is something which we need.
Kalpana, do you think you are facing a subprime crisis in the housing segment?
I don't think it's a crisis, but some families repay the loan through remittances. So, Vellore, Salem district in Tamil Nadu, we have to be over cautious with those clients, have early warning signals and look at them very closely. That is one thing. More afraid of government restrictions because ours is because high touch field job, we have to have that field connect. Increase in petrol prices also will affect our type of business where the margins are very thin.
I thought your current government was working in your favor by closing down alcohol shops. But anyway, because that is what you said was the big risk. But anyway, unless you want to have a supplementary point.
No, it's a very good thing because I used to feel so helpless going to the meetings and small boy, 5 years, 6 years, actually drinking alcohol and even threatening. All those things were happening. So it was really a welcome move for all this.
Thank you. Ganesh, how do you see the crisis? I mean, Shubhashri during her presentation said repo rate 5.6, it's very good and so on. Is it going to be good?
Right. Okay. I'm actually quite tempted to appreciate how Mr. Muthuji has spoken. Tempted to see if he can come to the microfinance sector. Speak quite well.
He says he's already in. So why are we making him an outsider? He's constantly saying I'm an insider.
No, in the sense, say for example, the point that he spoke when the Bureau presented about overlap, we do a further breakdown of it in our own country. When you actually break down this, the number of years in microfinance, it significantly changes. Customers less than 2 years microfinance experience, 80% of them have only a microfinance loan in our customer base. If you move to 4, if you move to 6, it goes up as high as 80%. So it's a clear path that we are working on, right? Customers come in microfinance, create a credit history, experiment a little bit about retail. Whoever is enterprising moves up, right? So once again, I'm just reiterating the point. Not everybody moves up, very clear, but at least 6 to 7 to 8% is clearly moving up in life. And that is a segment that we should target. We should not make everybody individual. We are dead against it. We will not move towards converting microfinance loan into an individual loan. We've laid out that over the next 5 years, every year, a max of around 8% is what we will move as customers, right? So that's the clear direction to cherry pick and grow that book well. Otherwise, whatever is in microfinance, the next crisis in 3-4 years is going to be an individual loan. So there's no second thought about it, right? So that's the direction we need to move. Second part on what was happening in the world, probably is now when being in this Trump effect, we don't know when it will end. Things are going, but exactly like what Mr. Muthukrishnan said, what we've seen in our entire history, we seem to have a negative correlation with inflation. So we do this correlation every year. Whenever inflation goes up, we seem to be performing better. Right? So it kind of does not sink well when you think like that. For the same reason that he said, as long as your profile of customers are into essentials, which is milk, meat, bread, rice, higher inflation typically helps them at many points of time, and that is why we are able to see that, right? So if price goes up, I don't see a challenge for the segment. But if supply gets cut for 2 months, if supply gets cut for 3 months, I don't know anybody in the world has an answer, right? So probably we'll handle it like how we handled COVID. Government has to step up. We need to give more act. We need to give probably additional support. We don't know what will happen. But temporary supply gaps, no problem, because digitization has got up really high from 0% digital collections. Today we're doing 20 to 23% every month digital collections. Every family has a smartphone. UPI is like catching up like very fast. So if say why I'm saying this compared to COVID crisis we did not have this digital needs at that point of time. At that point of time, when we actually offered moratorium to customers, 60% of our customers refused to take moratorium. Right? So they wanted to pay, but we could not go and collect. So it was a big challenge. Right? So you don't have that problem today. If a person wants to pay, they can pay. But the economy gets cut out because of lack of supply. So so first ones are getting affected are your small eateries. Those kind of profiles get affected. Your non-essentials get affected, etc. Right? But the essential services, which is majority, especially if you are a little rural focused, generally is largely insulated around price rises, which gets passed on. We should be able to tide over. But if it's pertinent, full supply cut, I mean, as a country, we'll have to solve for all sectors.
Then it's not the problem of just the poor, it's the problem of the country as a whole. Yeah.
That's a very nuanced segmentation. Bread, meat, milk, etc. For a setup like ours, which used to be largely an urban microfinance, that's not necessarily so relevant. I'm a bit of a Cassandra when it comes to the outlook for the segment. I think the problem is just beginning to bite. It's probably going to embed itself much deeper. Imported inflation will really go through the roof. Oil prices go through the roof, then there will certainly be inability to pursue livelihood in some scenarios, unless this war ends right now. Otherwise, to my mind, it's going to be pretty deep-rooted, and bottom of the pyramid is usually the most vulnerable. Cycles, and we've heard Vasu talk about it as well. Cycles have been repeatedly getting shorter. We had, apart from all those microfinance crises, we went on to demonetization, then we went on to COVID-1, we went on to COVID-2, we went on to the self-inflicted, as you were saying, the microfinance crisis. And now we are staring down the barrel of another gun. So, clearly there is going to be a lot of vulnerability. And this segment in particular is extremely vulnerable. And we've seen that. Even COVID, they had mortality rates much higher than the rest of the segment. So, I think we are in for a tough fight now.
Let me end with a slightly positive note, because I started with a negative note. So let me make it up for it and try to sort of put a balm on what on the pain that Raman has inflicted on us. So two or three things. I completely agree with Ganesh that it is important for us to look at the faces of the people. It's certainly important to see the fulfillment, and obviously one thing we need to remember that what microfinance did was nothing less than sort of tectonic when it first did it, in the sense that one, in a largely area, particularly in rural areas where the cash flows were bipolar peaks every year along with the harvesting, you came out with a product which had a weekly repayment. So obviously it increased the movement of cash, and obviously if the cash is regularly moving, it may not reduce poverty, it certainly reduces vulnerability because there is cash moving around. So that's one thing, and it increases the confidence of people, and that is what you call empowerment. Empowerment is not wife going and beating the husband, but empowerment is basically having an agency. I think that's one positive contribution of microfinance. Because it was also women focused and so on, it sort of patched up that part of it. So, second thing I agree with you is that as long as we have a look at the cow and lend, we are fine. We are constantly looking at credit scores and guardrails and lending, there's a problem. Please see whether there's a cow there or not. That is the only way in which we can keep our client diversification intact. On the global financial crisis, on the looming crisis, actually, in the 2008 crisis, it did not hit us very badly because it was a sort of a supply side crisis. It did not create it, it was the financial system had shaken, but the client system was quite okay. And therefore, it was easy for us because we were not completely integrated with the global economy. It was easy for us to get over it or manage it. But I sort of tend to agree with you that it may hit the client system badly this time. And we need to brace up. And therefore, the question is, how do we look at if you want to continue to see happiness in your client's faces, how do we look at how we deal with the changing household economy of the client? Now, the guardrails are not going to help us, the credit scores are not going to help us, and particularly with Natarajan Bro saying that he doesn't believe in credit score because the parameters are constantly changing and he doesn't understand it. So, I'm not taking your business away. I'm sure it's you have very strong, solid business, but I think it's more important for us to go back to the drawing board and constantly engage with the clients, and that's the only way in which the clients can be safe and we can be safe, and as long as the clients are safe, we are safe. I think. Okay, if the master of all these is because I don't want to be treated as a guy who overshot the time too much. Yeah, I already overshot. Karthik gave it 2 times. I've overshot the outer limit also. It said 11:30 first, and then yeah. Any questions? Yeah. The moment mic comes with you, there's a walker.
Switched off. You can ask.
You can just ask. Ganesh can give.
Okay. I think interesting points that were made, right? I think Ganesh made a point that microfinance can always be used as an entry strategy for a company. That's a very good point, right? Okay. And then how do you take the customer to a graduation process? I think Ganesh, what we're talking about is how are we behaving? How is our company behaving? How is the industry behaving on a relative terms? I think that's what we're talking about. How are we doing right now versus like now, let's say 3-4 years ago, right? Okay, that's my first point. Maybe okay. The second point is we're talking about product diversification. I think there's a very good example right in front of us, right? From an NBFC MFI to a SFB. That's already look at from 95% to 27%. That they have gone through the curve already. Okay, now what we're discussing about is
what are the lessons that we can learn from SFB model, from MFI to the SFB, gone through the product diversification, like, so what are the lessons? I think there's a point being made, very good point, and there is a really example that the other is.
First question, I'm still not understanding.
No,
how are we doing differently?
No, I'm saying, we continue to believe in the MFM model, very good point, right, okay. The point is, it's a very, very high touch point intensive business, right, okay. I mean, with the complexity increasing, right, with the customer behavior, 15 to 20% of the customers really like, becoming delinquent in the industry, okay, not necessarily for you, right, the landscape keeps changing, right, okay, so on a relative basis, is it not becoming a difficult business to really manage, right? In that sense, okay, is it still attractive? I think that's the point you were making.
I think in our thought process,
Can you use the mic, I suppose?
yeah, so it is a slightly complex business, right? So there's no second thought about it. The customer segment is vulnerable. But like I said, there is demand, there is good amount of supply. We need to work on choosing the right ones, right? Whatever we do, sometimes we'll go wrong, right? So we'll have to build it in such a way that you're efficient, your cost structure is efficient, your models are in such a way that you can absorb some of these risks, right? So you say, when we all started microfinance, we know the collection rates. Where are the collection rates now? We know that it is already probably a 3% kind of credit cost in a normal scenario, probably 5-6% credit cost in an abnormal scenario. So you'll have to work on a blend to kind of see. What we should focus on, in my view, is on a cross-cycle basis, how this industry behaves, because we cannot perform like mortgage. We cannot be something which is less than 1% for majority period of your life, right? So it's not possible. But even in mortgage, when you go to the lower segment, while you will still think I have a collateral, the ordinance had an impact on mortgage also significantly in Kannada, right? People were really scared to do mortgage in Kannada. As long as the segment is vulnerable, is the bottom of the pyramid, is the masses, whatever businesses we do, be it retail or microfinance or unsecured business loans, we have to be careful of what we are deciding, we have to be careful of pricing, we have to be careful of how we are exercising security. For example, in the earlier discussion we spoke about mortgaging everything in a grocery store. In my view, that cannot be security because you cannot enforce it. If you go and enforce it in a village, forget it. Right? You're not coming out of the village. It's going to be very crazy for you to operate in that geography. So as long as you put your strategies into having a long-term sustainable model, it is something which is manageable in a certain range, and that's something as an institution we've demonstrated and we try to hold it as we move forward. That's what I can say. I cannot say it's become simpler or complex. It is, in my view, the next few years it will become a little more simpler. We will go through probably a cycle. The reason why I'm saying is that, in my belief, I touched this point earlier too. Microfinance used to be a homogeneous group earlier. It is not homogeneous today. Right? If you take a 10-member group today, you can't say everybody is like the same person. People kept moving up. They were force-fitted into microfinance for a long period of time, and they became power centers. They are becoming a problem which we call as ringleader today. Right? So that, in my view, through this natural graduation model, we can slow it down. We can avoid those customers motivating others to borrow and give it to them. Right? So these customers can legibly go up till a certain extent. You can actually avoid certain risks which are happening because of the lack of homogeneity. So that's how I look at it. Second point, I think SFPs very clearly have understood there is no liability in microfinance. Right? So that is why everyone is moving in from microfinance because banking is a liability business. You need deposits. You're moving away from microfinance. Everybody is reducing the microfinance concentration because they need to actually diversify asset classes to sustain themselves as a bank also. Plus, there is no liabilities. Right? So that's not a model that we are right now looking at. We're not moving towards that. We want to remain what we are. Probably not necessarily restrict ourselves to microfinance. In our assumption, the 60-40 that RBI is confident probably allows to do 50 over some period of time as things move up. So we don't know. We'll manage how we grow. But we will grow microfinance. We will also grow retail finance. The vehicle may not be a bank.
What's the mix right now?
We're around 18% retail. The rest is microfinance.
Right.
All right, thank you.
Thank you.
Yes.
Okay, thank you. Gigi is, one more question? Okay. Yeah.
Just an extension of what you said. Actually, in real sense, I am an outsider for this role. I actually, we are not dealt with the MF at all. It was an awesome discussion, not an insightful factor which I could have made. Just an extension to the closure what you were actually making. I take this situation as very promising. Why I say that it's normally inflation adjusted returns over a period of time people actually get into. In that kind of situation, the disruption of this sort actually brings in a lot of innovations. So, having said that, all what we are talking about diversification and all, it's again because of certain amount of disruption which has happened. And this we see actually now as we are getting into, because thing is for me, this segment being totally new, 30,000 odd branches actually delivering the numbers and all, it's something which we have never heard of, being an outsider from this room. So this is a place which we are trying to explore and get into, and I think the collaboration between the non-MFI and the MFI should really build in a promising.
Thank you. Thank you. I'll just make one point about SMBs, before I close. In a sense, the route that SFBs have taken, they might believe that it was their choice that they moved into that but there is no choice. Because, look, you're a listed entity. Every quarter you have to go back. Everybody will ask, what is your unsecured portfolio? Reserve Bank will say, why are you the same? So, I mean, you get what you design for. You don't get what you intend to get. You should design for what you're getting. SFBs are designed to be banks. They're not designed to be MFIs. The day they got the SFB license, it was very clear that they will be mini universal banks, and the day they get their universal bank license, they will be like Kotak. They won't be any significantly different from Kotak in terms of the overall portfolio. I mean, there might be a little bit of oomph that each bank has, but ultimately it's a design. Look at Bandhan Bank. Should we say, array, why they are not doing so much of microfinance any longer? No, they are a bank. They are dealing with public deposits. So that's something that we need to keep in mind. So the structural change will come because of the 60-40. The diversification, earlier that was not possible, now it is possible. So therefore, it will come because of the 60-40. I guess that's the only evolutionary way for the ecosystem also to respond to all these guys. Thank you very much. You've been a wonderful.
Sir, look here.
No point in cracking Hindi jokes in Chennai.
Sir, look here, sir.
We'll request Dolly and Manu also, please come on the stage.
Ready, sir?
And I
Ready?
request everyone to please come back by 12:05 so that we can start our next session immediately. The tea will be served in the next room. It will go out of this hall on the left hand side.
Good afternoon, everyone. Over next few minutes, I just want to make a single argument. Progression to business loans from a group loan is not something that we call our strategic. It's just the natural transition. Imagine 3 borrowers in your portfolio. One with Kirana store owner, he took first 20,000 rupees JV tranche. Today she has around 5x of the SKUs. She has a refrigerator in her shop, and her business has clearly grown. A tailor who started with one machine inside her home, today she has 3 weeks of order backlog. Maybe she is now going for 2 new machines. She is hiring her first employees, expanding out of her home. A vegetable vendor who used to push carts, and now she got a rented shop, fixed address, fixed customers, growing income. I'm sure there are thousands of such stories inside your portfolios, and just we need to find a methodology how to find these gems. I think we have discussed this couple of cycles in JV loans. Who have some business, vintage business, who have family income, household income more than 3 lakh rupees, that where we are classifying them as graduating borrowers, and the ticket sizes will simply jump on 10x, but probably the quantum of such customers, how many customers would there be, is something that we all need to find out with Conclave 2.0 norms rolling out. Not just these filters, but we also need to do some bureau scrubs and find out who all fits into those norms, and nobody will say no to a hair loan. So we need to really be careful on pick and choose whom do we pick. And the clear signs will be there. Somebody whose business is growing, somebody whose lifestyle has seen an improvement. And I'll also add my 2 cents. When you are pitching for a higher loan, higher ticket size loans, try to do it not at mid-cycle but at the renewals, otherwise you might end up jeoparding your future repayments of your existing loans. But what loans we are talking about here in my presentation is unsecured business loans and secured business loans. This is typically targeting to the businesses. Some of the product contours are there, but I would further slice it out. For unsecured loans, when we are talking in rural India, Bharat, the average ticket size will be somewhere around 1.5 lakh rupees. When we grow up to semi-urban, peri-urban, it may go up to 3.5 lakh rupees. Above that, it will be secured business loans where it's not just unsecured, but we also want to cover it with a collateral. And in micro LAP or secured business loan segment, there are probably a few more slices we can do. Someone who is around 5 lakh to 6 lakh ticket size. That's one segment. The another segment you will find who is at 10 to 12 lakh rupees average ticket size, and the next segment in micro lab will be someone who is with 20 lakh plus ticket size, right? And tenure for these loans will also vary from 4 years to 7 years to 10 years respectively. I'm not touching about the pricing right now because I'll open it to the August audience and the panel members. But the key here is when we talk about unsecured business loans, right? When somebody have all the revenues coming in banking, they have some ITR filing, or family members who have a formal salary income, that is the bank segment. That is not something that as an MFI, as a group, will be going and touching it, right? The opportunity is someone who is not today bankable, right? And there the concept of assessed income underwriting comes in, right? What do I mean by assessed income is hard on-ground touch and fill with multiple visits, multiple reference points, and backed with some of the alternate data or documented incomes. The assessed income, what we are essentially saying is UPI transaction patterns, kacha paka bills when we are going at the shop, inventory levels and restock frequencies, the locality, the target customer whom the business is servicing, and the target customers' purchasing habits. Electricity bills as the appliances in the household is a proxy to the lifestyle and family demographics. But all this raw data will be need to be careful to rationalize when we capture this raw data with probably 2 to 3 factors. One, industry data. Somebody who says, okay, I have 50% gross margins, what is the industry, and rationalize it. Right. The confidence score. How much of this story is backed by some of the alternate data that we could verify, and based on that, the adjustments has to be done, and this is what we are saying is assessed income program. This is a core skill that our team has to build. Right. And it's not just a skill which is income assessment, but also a cash flow assessment. Right. What I mean by cash flow is your expenses, household expenses, education expenses, medical expenses, whether there is an insurance cover, the fixed investments, chits, all that, right? That gets you a free cash flow, whether the person is able to service or not. The next point when we talk about the underwriting is, and in my opinion, it's the most important point, is end-use monitoring. At the time of underwriting, the cross-questioning, the quantum of the loan amount we ask for, and post disbursal through multiple visits over the life cycle, capturing the progress. This will not just restrict your portfolio, but also helps you in terms of monitoring, for capturing the monitoring data for SDG metrics, and it will also help you when you go down the DFI journey. And why I say it is most important is because diversion of the fund is the single biggest factor of early NPAs in this sector. Next will be a digital collection, a habit of paying digitally through NACH, through UPI mandates. Right, it's not something that our teams has to learn, but it is something also we need to inculcate a habit into our customers to pay digitally. And the elephant in the room when we talk about the collaterals, the collateral and MODD processes, documentation, original document handling, legal, technical vendors, empanelment, handholding them through case to case, mortgage registration, so on and so forth. I'll take few 30 to 40 seconds just to take you through what a policy would look like. But a typical policy and SOP document, when you are venturing into this products, you will have to create a detailed policies, SOPs, and a state level collateral documentations, what type of title documents will come in, and all that. You need to create it, invest times, and keep revising it over and over. Right. For UBAs, I would say there are 4 pillars. You check the bureau, you check the FOIR and free cash flow, you check the borrowing to turnover ratio, number of live loans, and another important factor here, you check the banking habits. Right, what Kalpana used to say. From banking, you will get those clues whether somebody is paying at a theka. Right, somebody is making online payments on gambling apps. Right, so those are primarily for unsecured, but when you come to unsecured, probably the assessment norms for eligibility will remain same. Maybe it may go little bit, the thresholds can be a little bit flexible based on the end use, maybe new expansion of the business or debt consolidation. But again, here will be the 50% of the task will be handling, driving LTV and handling volatile processes. Who all are currently in this space, whom we are going to compete with? Fintechs, NBFCs, HFCs, cooperative banks, and small finance banks. I would say it looks like a crowded space, but we have strong advantages. We have emotional connect with the borrower. We have deep last mile distribution, which no application can overnight build. But there are structural challenges, and I would request August panel members to touch upon these points in detail. For HFCs, there is NHB who will come and refinance, so their ALM problem is not there. Right. Here, when we talk about longer tenor loans, the ALM is a spiral going down, right? So maybe the only way out currently is co-lending partnership, right? You partner with the current existing players who are there, SFBs, HFCs, to manage that well. And the next, when you get into it and you'll realize that technology will be your biggest hurdle. The existing LOS systems may not be evolved enough yet to handle the nitty-gritties of assessed incomes, vendor managements, and all that. So be ready, keep your teams ready for the change management. Unit economics is something which Karthik sir asked me to touch upon, but I'll also let the panel members deep dive into it. I'll just say what at the unit economics level, at the board presentation, what you need to present is how you are controlling your OPEX. Second, what is the break-even ECL levels? And third, what are the different mitigation strategies such as CGTMSE or co-lending? The pathway forward is fairly simple. Start with unsecured business loans. Get the teams acquainted, be comfortable with the processes. There is no ALM mismatches, and get CGTMSE covers so that it's easy on the credit cost. Then slightly move forward to SBL. Started with your own book because no partner will come in on the day zero, but started with the own book and swiftly move forward to partnership lending, because again, in this particular space, partnership will be a structural and not a strategy. Thank you so much.
Great.
Thank you, Moses.
Conclave, especially on product diversification, which is something we've been working with Sa-Dhan, especially in the housing space for the last 2 years intensively, to see how we can help MFIs graduate, diversify loans, and when we say graduate, we are talking about secured lending. So we all here are impact-driven organizations, right? So this is the kind of impact which we can create if we are focusing upon housing. So 3 billion people lack access to adequate housing. 300 million people are experiencing homelessness. And housing is one of the sectors which is emitting highest amount of GHG gas emissions. So, to put everything into perspective, it is like making 96,000 homes per day if we actually have to solve for this. And we all know that making homes is not that easy.
It's a global data.
It's a global data, and majority of this is low-income housing. So, I mean, what we are saying is that low-income housing is up for innovation, And you know, we all are here to play a significant role. I think I'll take it from the previous panel that it is, as Sushant mentioned, right, it is about taking that lead, doing 1%, 2%, starting with those kind of, like, exposing your portfolio to newer products, experiencing and experimenting, because it is not easy. And I'll come to the other points on capital also. I was asked to rush a bit. So, yeah, let me. So, Turbillager Center is a part of Habitat for Humanity International, and we are a not-for-profit based out of US, present in 70 countries. But as TCIS, we are working with the market players. We don't work with the communities directly. So basically helping different actors in the value chain of housing to develop products and services so that low-income households can build better homes. So that's kind of our agenda, and we have been working with Sa-Dhan specifically on this low-income housing finance product. Now, from microcredit to microasset, this is what, you know, is the notion which we are carrying, that we have done enough of enterprise loan. Is there a possibility to help these low-income families create resilient, good assets? This is broadly talked about, that why MFIs are the right channel. Definitely we have higher rural penetration. There are graduating clients, and by graduating we do mean that a segment of clients have, you know, come out of that 3 lakh income segment. And there are ways, and if we go to the field staff, they can very well assess that. And they also have aspirations, there are needs. In fact, I mean, in the room, people must be aware that 25 to 30% of the microcredit loans are actually diverted for home improvement purposes. I mean, that's very well known, but it's not recorded very well. In fact, the presentation we had from the Credit Bureau, we were amazed, because this is not how housing is represented, right? We will definitely talk about this with the credit bureaus. There is also challenge of reporting. As microfinance lenders, you can only either report individual loans or you can report microfinance group loans. There are deviations and differences in how we are reporting loans. Plus, we are not capturing the use cases in a correct manner, or our MIS is not currently capturing all the different use cases. The diversions are not captured. If we have that kind of pool of data, we can do a great analysis on understanding which portfolio is performing better, and that can help us get with relations with investors. We can get good kind. I mean, we were in talks with National Housing Bank, and they asked us only one thing: that how can I say that MFIs are actually lending to housing? What is the evidence? So how do we create that kind of data if we are not capturing the use cases completely? Yeah, and one thing which is very important is that housing also opens the door to, you know, getting climate resilient portfolios, green impact funds, investors. So once you have, I mean, it's definitely a long leap. But if we start with small ticket size, secured loan, helping low-income households build homes, simple adjustments, cross ventilations, simple design techniques, we can upgrade homes in a very sustainable manner, and that can become one of the that can create your portfolio as green portfolios, again attracting investors. Just quickly a glimpse that the segment which we are talking is your segment. We've known them very well. This is low income, and they have not, I mean, it's the informal income segment. Generally, they do not have good collaterals, but that is where the real need is. And if I have to quickly take Pradhan Mantri Awas Yojana as a proxy to the market segment, and I have to take it as a proxy because we don't have enough data on rural low-income housing. So if we take that proxy, that the target is 30 million units to be built by 2029, and if you see the value of these units is 266 billion, like the amount which is required to build such homes. Just taking 21% as a figure, that 21% of the houses will be built using credit. That demand is 56 billion. And if we continue the way we are working, like only selected housing finance companies are offering this low income segment, like, which is under 15 lakhs, under 10 lakh. We are only catering to 18% of the housing market, and this is just PMAY data, which is talking about new homes built. So there are like, what about home improvements, extensions, renovations? These are different needs. If we take all of them together, this market could be more than 3x, 4x the number which we are showing here. As I said, that housing finance is not it's right. The definition of affordable housing in India in itself triggers that the companies who are serving this need, they move towards serving higher ticket size loans, and the low income segment, which is like who have a genuine demand of, say, a ticket size of 5 lakhs, 6 lakhs. If we see the composition, it is just under 7%. So basically, under 10 lakh ticket value is served by very few financial institutions in our country. So this is exactly why MFIs can play an important role, because this is the segment which is well understood by MFI players. So this is just to show this is the missing middle in the housing space, and there is enough opportunity. It's the matter of time that we take our first steps and start working towards creating this portfolio, diversify into this product. And it's not easy. As said by many of the panelists here, it's not easy, but we have to be patient. We have dealt with many MFIs sitting here in the room, worked with them for more than 12 months sometimes, just figuring out the right process. Because yes, capacity is an issue, capital comes in again and again, and most of all, the current branches or the current network may not be, capable of taking such kind of or doing such kind of products. But as I was talking about Sa-Dhan, we have already seen that Sa-Dhan has worked in the wash sector as well, and got the PSL for it. Similarly, we are working on we are trying to see if we can get such kind of categorization for under 10 lakh, so that refinance, credit guarantee, etc., where MFIs are considered as primary lending institutions, we get benefits out of it. So we are working towards that. But what should institutions like you do or can do? Because we are trying to solve the macro problem. What can be done for you and to help us is that start creating that portfolio so that we can have the data. In next 2 years, we can go back to RBI, we can go back to National Housing Bank and say that this is what MFIs are able to do. This is a proven portfolio, the repayments are happening good. And we have, at a global level as Turvelager Center, I have enough data. But at India level, we don't have that data. That's the problem. I can very well say that, as Turvelager Center, we have also invested in around 66 institutions globally, and in a span of 12 years, we have seen that the housing portfolios have performed way far much better than any other portfolio in that institution. So that's definitely sentimental, that we can add any reason to that, but that's the reality, and that would be same here in India as well. So how MFIs can solve for the sub 10 lakh housing finance? Okay, this is the text may not be visible, but the essence or the meaning is that how can we start? The phase 1 could be start reporting at least your unsecured loans, whether it is going for home improvement, extension or something. If you can start having that record built. Going forward, see, the aspirations are increasing, and the real sense of financial inclusion is when a family is able to actually start thinking about owning an asset, whether it is vehicle, home, gold, whatever. So if we are able to make these households be able to actually own an asset, that's actually the meaning of financial inclusion. So when an MFI client, this was well said by Credit Access Grameen, cherry picking the best customers who have served, whose repayment is very good. Can we pick those customers and see if these loans can perform well? We can start as a piloting phase. Not all institutions will be able to do all products as we have discussed today. But those who have the intent, those who think that housing is one of the needs which is very prominent in their areas of operation, can we solve that? And as your customers would graduate, could be open source market or your existing customers, who we have also seen that they are taking loans from other segments, like as retail, they are taking loans for gold, for vehicle, for housing as well. So if we have those kind of customers, definitely the collateral graduation will also happen. From unsecured to just taking some kind of documents for them, just to establish that they have been residing in this in that house for a very long time. And going ahead, it could be actual mortgages, right? Registered mortgages. At the same time, the formality in income is also changing, right? That's what is expected. So this is like a ideal graduation diagram. And yeah, what we are saying is that we can start with a small ticket size, 1 to 2 lakh, 2 lakh to 5 lakh, and it can run up to 10 years. Now again, asset liability mismatch, all of these issues would be there. But if we are beginning small, we can manage with our own portfolios as well. 1% exposure, less than 1% exposure can be done. But what is very critical is building of capacity. So if we can build this capacity now, so when the opportunity comes, for example, if we have some refinancing schemes specifically for MFIs, for housing, are we prepared to take it up? Have we done? Have we experienced it? No. If we have not done, we will not be able to. It is a similar case of green financing in housing as well. Some of these smaller housing finance companies do not get exposure to that, and they miss out on the impact investors who are actually interested in only financing green housing. So if we can be prepared for that. I'm not covering this, but I'm talking about taking action first. And Sa-Dhan and Habitat, we are already working, so any MLI or MFI who's interested can, we can talk about partnership and definitely help you build the portfolio. So just leaving with one thought that, informal income, lack of formal collateral has always been there. And we have seen this, but there is a need for innovation. When we say VC, when we say co-lending, when we say investors, what we have experienced so far was a typical setting before 60-40, right? And they are tuned to that kind of mindset. To change that mindset will take some time, and we can take some steps towards it. There could be even, we can engage into soft collaterals or things like that. Yeah. Thanks, everyone.
Thank you. Thank you.
Thank you, Nupu. Thanks a lot. Now I'll introduce the moderator and the panelists for the session. The moderator for the session is Mr. Nakshraj from. He is the chairman and MD of South India Findex. The speakers who will join us today is Mr. Amit Sharma, MD and CEO of Sa-Dhan Housing Finance, Ms. Alfina Josh, DMD of Bauda Finance, Mr. Manikanand KP, Senior Advisor, TCIS. He is also from Habitat of Humanity International. Yeah. I request the panelists to be on the stage.
9 to 12 months. Then there is also, that's on a steady state, but there are business cycle risks. So whatever good work you do, and at some time it gets evaporated with one black swan event, and then the credit cost shorts up. So that's the positive, and on the risk side of pure play microfinance. In order to de-risk microfinance cyclicality, then probably diversification would be one thing that immediately comes to everybody's mind. While microfinance is a high need product, and but PSL is easily available. There is a like sometime government announces that like different schemes around it. Doing microfinance makes sense for the smaller player, but as far as the de-risking strategy comes, can a small or a medium-sized microfinance, say like 500 crore to say for example 2,500 crore, can straight away jump into the bandwagon of doing secured loan or individual business loan, enterprise loan, where the cash flow from that particular activity, it does not break even at 9 months, 12 months. It has to be have that kind of capital deployment for a period of 3 to 5 years that will make you profitable. So that kind of time span, that kind of capital availability must be there with the promoting institutions. So not everyone is like Muthoot or Trade Access Grameen, where they can easily scale up from their retained earnings, from their capital, and create a secured book by themselves. For these kind of small and medium enterprises, I would suggest that take the co-lending route, less upon the competency of the partner who is stronger on technology, understand the secured business more. And once you are comfortable in your financials, then probably independently you can start thinking of building a secured book loan or a book which is from the assessed income program. That is the thing which would be critical and determining. And there are a lot of partnership opportunities are available. ALM is one thing. Everybody should keep in mind that capital will be locked if you don't manage it well.
Thank you. I think if I were to just summarize the group's view, panelist view, the transition is very much possible. But you need to build these skills. You have to build the credit underwriting skills specifically, not just transfer somebody from operations into credit, but actually build skills. That's probably what I'm seeing. Technology is available. You need to build the technology capabilities, but it's not very difficult. It's available in the market, and you have various ways of going through the ALM mismatches by various co-lending and partnership models. There are challenges, but you have solutions. And I think you need also to have set aside patient capital, because it is not going to be easy to build a profitable portfolio overnight. So you need to be patient, and that's the message that's coming out. So I think there are 3 key points which came out, and I just will pass on. We'll ask the panelists to specifically in a very short 1 minute time tell us about the solutions for this. Basically, if you have to scale profitably, I think 3 things you identified. 1, you identified co-lending. 2nd, you identified DC models from the partnership perspective. And the 3rd, I think the presentation talked about trade guarantee cover as a way to minimize the transition risk. So I will specifically pose questions on each of this. Krishna, can you please tell us about the co-lending model? How does that work? Is it something just small MFI wanting to get into this can get in easily? What are the challenges there?
Co-lending, rather than co-lending, I believe the smaller MFIs could get into these new products through the VC channel. Why co-lending could be difficult is because a larger entity, like our team also manages the co-lending VC business at Muthoot. So what we were looking at is whether that particular partner who comes in, because there we trust that partner to do a lot of work for us. And only at the lending stage, actually, our portion will go to the customer. Most of the legwork, etc., is done by them. We believe they have the expertise to manage that. So, at co-lending, when we look at that, and the new entities coming, a smaller entity is saying that we would like to start this business, whether you would be interested to partner with us, it would be a slightly risky proposition from a lender's perspective, where they do not have the full system control. But BC it is different. They have system controls also. But I will add a twist here. So the strength of the entities, the smaller entities, is the microfinance book they have built. So why don't they get into a co-lending partnership for microfinance with a larger entity? use that capital, whatever they defreeze from that deal, for building these new capabilities, and then get into co-lending later when they have that expertise in-house, or otherwise look for BC.
Shraddha, can you suggest how the BC model would be smart? I think you mentioned BC model
Yeah,
would be
so just to
a better way. So, your thoughts on that?
Yeah, so BC model, very quickly just answering, it gives you advantage of learning from the bank or over the partner how the model works, right? Because you don't have expertise, so they will pitch in the underwriting, everything. That's a greater advantage. Other than the ALM mismatch and you don't have the capital and all that. So that way it will be helpful other than the other.
It also solves the ALM problem.
Yeah, ALM problem also.
Suresh, at Piramal, do you use the credit guarantee cover? Or your previous organizations anywhere, have you used the credit guarantee cover? What's your experience with that? Will that also help? It's a risky transition into business loans. Will that help us in terms of making the transition easier?
It does a lot impact. In my previous this thing when like microfinance was not undergoing through the last year's business cycle raise, the organization I was working with, I contemplated upon reporting to CGFMU on the credit guarantee scheme, where 70% of your book is protected. And one quarter, I accept the crime of thinking so much for January 24 to March 24, the pool which we created and the growth we accelerated. Like what was like a typical boardroom discussion and risk discussion was which pool to report. Which is the more toxic one? What are the data science behind creating a riskier pool which you will go to report? Because it is not free of cost, it is straight away take 1% of your this thing. Then after having into several kind of deliberation, the industry data and everything, then I said, I'm nothing doing, and report 100% of the cases to CGFMU. 100% of the cases to CGFMU, and because of that decision, whatever happened in 2025, with product 81% of the current outstanding book reported under CGFMU. So that amount of de-risking is possible if you could have played smarter in the time when the time was good. Coming back to reporting everything to CGTSME or CGFMU, is it that straight line? No, it is not that straight. Even in Piramal Capitalist, I am not telling anything secret, but you have to be profitable in the last 3 years. You have to be profitable at least for 2 years, and you have to have a certain rating. So if you are not matching these two criteria, so last year that our whole Piramal application on CGTSB was rejected. So this year, like we have been registering it, and I'll probably, again, same contemplation, which is the pool to be reported. The contemplation goes on, but it will be wiser if you report it to something like CGFMU or CGSME, and that will give you that additional advantage. Who knows, like if something of the nature, like say for example, whatever happened in Karnataka last year, how could you have identified which is the riskier pool, which is not the riskier pool, right? That protects it that way. You have to price your product appropriately, and your cost saving not only comes from the operating expenditure, but it also comes from the credit cost. All of you follow a particular kind of ECL grid. A pool that has been, reported to CGFMU or CGSME, the assumptions of provision for each of the buckets will be very, very different. And from there, straight away 0.5 to 0.6% cost you can save. Additionally, like when such kind of black swan event comes, then at least we'll not have sleepless night. So that's how my take on CGTSME and CGFMU.
Thank you. I think to summarize the panel's discussion, I think broadly there is a huge opportunity to diversify. There is a necessity to diversify. there are transition challenges of building capabilities, whether it's credit underwriting or technology or the team capabilities or asset liability mismatches, but there are solutions as well, whether it is partnerships like co-lending and PC, or whether it is minimizing the risk of a new pilot through CGTME cover. I think there are various ways in which to get into this space. One last question to all the three panelists. I think you have talked about the transition, but the next 5 years, where do you see your organization having a share of non-microfinance loans, specifically to this trend? Where do you see the industry share 5 years time? Your organization and industry share. Not JLG lending at all.
Non-JLG, we would be in next 5 years time mostly like 50% of our book.
What do you say as industry will be?
Industry would be lower than that because Muthoot or a larger organization has so much more freedom. So if the industry could reach around 30%, it would be great.
Shishanta, what would you say?
So before Vandana, what it does, so it's good to know that whole day session is dedicated to one chapter. Unlike the conferences that we had in the past, one of the panel discussion would have been in product diversification, in microfinance. So it's very interesting. So the journey starts from here, I would say. Abhi se shuru hota hai because thanks to Sa-Dhan ki they have arranged, I have not attended or seen any whole day session on this kind of thing, a lot of data point. This kind of education, if it comes among the community, then it populates down to the branches, then the customer and all that. So I'm not throwing a number, I just mentioned 6 crore is the number of customer roughly. 10%, 5%, 5%. 2.5 lakh to 3 lakh average ticket size, it translates to 60,000 to 70,000 crore. Let us aim ki we should reach 1 lakh crore by end of 5th year. Okay, and as Vandana, our portfolio had degrown. That's why my portfolio in secured space is 7%. We will grow to 12 to 15% year on year. So that's the end.
Sirish, at the industry level, what would your estimate be? Next 5 years.
Yeah. No, before I jump into the industry level or our own thing, for the benefit of the larger audience, I would like to take it with a pinch of salt. Microfinance customer graduating to business loan or secured loan. Who decides who will graduate? Does the person on the field, your loan officer, decide this customer has graduated just because 3 cycles of loan has been repaid on time? Or the cash flow of the customer supports those kind of product uptake, and the organization has the competency to evaluate the banking behavior of the customer. So if we take that route, microfinance customer graduating to business loan or a secured loan, then the null hypothesis may prove otherwise. My word of caution on that. While we're a new entrant to the market, like how do I look at building this book? Because because I had the rural function of the pyramidal finance, the way I see is that is 33%. Microfinance will comprise of 33% of the overall book, where typical customer who are deprived of all these products should not be ignored by any stretch of imagination. So that will be 33%. Customer where we can really identify the banking behavior, cash flow can be scientifically assessed. That will again comprise of another 33%. There is an opportunity available, and every time we talked about a missing middle, and that missing middle market is no small. Correct? Then another 33% will be on the secured side. On the secured side, our roadmap is we are releasing on 2 products. One is the loan against property, another is gold. So one typical branch of Piramal will be a distribution center for any kind of financial need that customer is looking for. And who decides? The customer decides. Who dictates the term? The customer dictates the term. That's the philosophy we are working on, and that's how we are trying to move on.
So just for clarification, the question was about non-JLG. So when we mention the percentage, it also includes microfinance. Microfinance as individual.
As individual. Small ticket individual. Okay. So I think very, very different. Thank you for your frank opinions. With that, unless there are any questions,
we can discuss.
Yeah, we can discuss over lunch. So thank you for Sa-Dhan for for this wonderful panel. Very, very relevant as the panelists have identified. Appropriate time, appropriate focus. And I wish thank you all the participants, Krishna, Suresh, and Sushanta, for your wonderful insights. And I hope this discussion has been useful to all of us. Thank you again.
Thank you, sir. Thanks a lot. I'll request Gigi sir to give the token of appreciation to our panelists. I'll also request Ojas to join us on the dais.
Thank you, moderator, for separating your
Sir?
Wait, sir. Sir, wait, sir. Wait. 1 second. Card is there. Card is there. Ready, sir? Sir, look here.
Photograph.
Yeah, ready, sir, ready? Wait. Wait, sir.
Our next session is on micro housing loans. There is three presenters for the discussion. I will now request Lupu to please give the presentation. For your presentation. Now I will introduce the panel. The panel will be moderated by Jagadish Ramadagu, MD and CEO of Pragati FinServes. And the eminent speakers for the panel is Sushanta Tripathi, Executive Head, Chris Financial Limited. Shirish Panda, Business Head, Piramal Finance. Krishna Chandran, Vice President, Muthoot Microfinance. I'll request the speakers and the moderator to join us on the dais.
Ready, sir. Mobile. Ready, sir. Ready. Wait. Okay.
What do you guys think?
Ready, sir.
Now
Ready.
we are breaking for
Look here, sir.
lunch.
Sir. Look. Wait.
Sir?
Ready, sir? Sir, look here. Wait. Okay. Ma'am, wait. Ma'am, look here.
You can stay if you want to start the lunch and be here by 2:45 if possible because we
Ready, ma'am, ready.
Yeah, good afternoon everyone. Thanks for the question. I think the previous panel touched upon the various issues and challenges of product diversification. That was very strategic in nature and very broad based. So I think there was some very important points which came across that whether it's industry is likely to grow at 25-6% industry growth rate, or whether the customers are evolving and there's different needs. So ultimately there is, it's clearly established that product diversification is not just a option, but there's no, it is a mandate for any organization to be continue to grow. So with that, I will not, so we'll stop it. With that, I will go on to the panel. I think we have a very eminent panel here. We have sitting next to me Sushanta Tripathi, Chief Business Officer of our MSME and secured lending of Spandana Spurti. Many years, more than 22 decades of experience in the space, in the rural finance space. We have next to that we have Sirish Chandra Panda, Business Head, Rural Lending of Pyramid Finance. Welcome to the panel. And we have Krishna Chandran, VP Operations of Muthoot Microfinance. Again, another industry veteran. I think all three of them have more than 2 decades of grassroots experience at the rural finance. So it's welcome all of you to the panel. So I will just start. So broadly, the session will be in. I will be asking basically four different rounds, and each round I would expect each of the panelists to put in their comments. Broadly, the questions that we will seek to answer in the first part is where are we today? So I'll ask upon their experience and where we are, and then why should MFIs enter into the secured or unsecured business lending in the first place? That will be the second round. And thirdly, we will ask about execution challenges. What is it that makes this transition difficult? Right? And fourth, we will also talk about how microfinance institutions, small and medium, can scale responsibly and properly. So if you look at it, the theme of the panel is very, very practitioner's view. It's not theoretical, it's not conceptual. It is very the realities of what we face. And therefore, I think with this very experienced panel, I think we'll have a very relevant discussion. I think if I were to just make a quick opening statement, I think the last few decades, the microfinance institutions have created a huge set of base of customers, millions of customers, a very strong repayment culture, a very loyal and disciplined team, and a strong repayment culture along with customer trust. So the question is, can this trusted borrower base and our own strength on the ground, can we translate that into more meaningful products which are evolving with the needs of the time? Whether it's gold or whether it is a micro lab or whether it is business loans, how do we move? What is driving that shift? And therefore, what are the opportunities that exist? And how do we manage those execution challenges? That's the broad theme of that. So with that, I will start first with I will have a question, common question to all the panelists. Broadly, I would expect you to share very briefly with all of us in the audience what your current business lending, business loan strategy is. I will start with Krishna Chandran at the end. The Krishna is from Muthoot. I think Muthoot has a very strong brand DNA which is very well known in the gold space. And I think Muthoot Microfinance, of course, is into a lot of rural lending space. So coming from such a background, what are you thinking about the business loan space and what is your experience there and how do you translate that trust into the unsecured or the secured business lending?
Thank you, sir. Good afternoon, everyone. I take this opportunity to thank Sa-Dhan for inviting Muthoot Microfinance to this panel. Muthoot Microfinance, we have an AUM of more than 40,000 crore. We have an AUM of more than 40,000 crore, and out of which more than 20% now represent unsecured business loan, which is one tool we are looking at it aggressively. We have grown this product in the last 10 months only. Now the AUM is around 2,800 crore, and the book is behaving very good so far, but still early days to comment. There are learnings, and as you mentioned, sir, we are looking at we looked at the data from the scrub, etc., and so that if we are at 14,000 crore, we have, our customers have around 30,000 crore of loan, non-MFI loans with others. And from there we identified, okay, which all are the areas our customer segment are taking loan from outside, and then we zeroed into all these products. And of course gold is prominent, but our panel is already there in that space. And we are looking at capturing that loan. Whatever our customer requires, we expect us to be ready through direct or through partnerships to provide that to the customers. And with that aim, we started this unsecured business loan, and there is also a small growing pool of lab, MSME lab product also. And gold loan, of course, we are aiming to grow that with partnerships. So that is where, as a company, we stand now.
Basically, what it's saying is they have very smartly used the data to identify from their customer segment who are the customers who are potential for other products and focused and targeted products. That's what I pick up from it. Moving on to Sushanta. Sushanta, I think you have one of the largest deep rural senior general distribution as Spandana Purti, more than 1,200 branches, if I'm right. So, are you seeing some natural demand coming from the existing MFA customers? What is your view, and how do you trace your journey into the business loan space?
Yeah, thank you very much, Jagdish and Sa-Dhan. So, before that, let me delve into because I represent Chris Finance Limited, which is a 100% subsidiary of Spandana. So it's both are almost same company. We were a different company. Now it is going to merge with Spandana. So that's one part. So how differently we started this business? I take care of this, which is largely into unsecured business loan and micro lab. Spandana as a parent company is purely microfinance. So we had this luxury, I would say, we had a different company, NBFC. So before this regulation came, 60-40, that was not there, 85-15, then 75-25, to including us, very few people were delving into other than the microfinance, because qualifying asset program was there. So we thought this is an opportunity, let us start something in the CRIS, which is an NBFC. So 2.5 years back only, we started the micro lab product from the scratch. And here the idea was a little different. Deliberately, we didn't touch any single customer of Spandana. This is very little different. So what we thought, okay, we have a catchment Spandana customer base, somewhere down the line we will do that. We, from the day one, we understood that this micro lab segment is entirely different than the microfinance. Any microfinance company, if you go, their DNA is microfinance. Unsecured 50,000, it has gone to 1 lakh level. Micro lab, I will explain during the course of the discussion, very, very complex. It's not simply complex, it's complex, I would say. Okay. For the kind of people we are sitting here. Okay. Because let me give you some numbers. Okay. So last 2.5 years, I have been a throughout year microfinance player. 17 years I have done microfinance starting from 2005 till now. I started and Spandana gave me this opportunity to start something from scratch. So I was not knowing how this happens. So I recruited people, understood the market around the last 2.5 years. We could reach 90 fresh branches we opened. Totally different than the what. So if you want to do, whether we do it in a serious manner, and then convert this company in future maybe HFC and something like that. So the portfolio that we could create is 340 crore, 350 crore. Very small if you see. But I can realize the way microfinance move fast, it is different. So the learning is you should have patience and you will get good result. Portfolio quality wise, customer segment wise, the way it happens, entirely different that we will discuss. Now that we are talking to okay with this 60-40 and all that, our strategy changes a little bit. So far we have not targeted the Spandana customer. Once the merger completes maybe in 3 to 6 months time, the network that we have, 1,200 odd branches, through them, taking this learning into picture, we will take it to those customers. It may not be the customer, microfinance customer will come to our fold and they take the micro lab the way we do. But what I see is the villages where the people are operating, not only Spandana, everywhere. So look at that catchment area. A village, a branch, 30 km radius, okay, typical microfinance, 2,500 customer, 40, 60, 70 villages, 40, 50 customer in a village, microfinance customer. There maybe 2, 3, 4, 5 customer we can confirm. But what about the remaining customer where my loan officer is going? And I have the expertise, can I tap and meet the unmet demand that we are talking about, 25 lakh crores, XYZ and all that. So the strategy shifts towards pure play micro lab, not tapping to the segment, to now getting into this thing because we have the benefit of the network.
Very interesting. They've started completely away from the microfinance network, separate team, and then they're now trying to bring that learning back into the main company. I think a very key point that he has mentioned, patience is key. It's not easy, all of us being microfinance practitioners, it's not very easy to move away from microfinance into a different segment. I think the key takeaway from what you're saying, Shanta, is patience is the key. With that, we'll move to Sirish Panda. Sirish comes from Piramal Finance. He's been on the other side, so microfinance, he's been with Arohan, he's been with multiple years with microfinance. I think now you've moved to a much more diversified NBFC leading Piramal Finance rural initiative. So you also have a microfinance book, I think a very large business loan book as well. So it would be very interesting to hear from you what your approach to this would be. What you advise specifically to microfinance practitioners?
See, as a financial service player, Piramal is a new entrant to the market. That way.
Sir, then down.
Am I audible now? Yeah. The new entrant to market. So, beat up genesis of Piramal, and Piramal was known for its pharmaceuticals. And in 2018, like by acquisition of Abbott, by selling of Abbott pharmaceuticals, it had a significant amount of liquidity. And from there, we started doing real estate funding. And in 2021, again the acquisition of DHFL, that created experiment and expertise to get into the secure lending space. So unlike microfinance, the core DNA of the group is from the secure side and more of housing finance and a lab. So after that, after acquisition of DHFL, the growth engine was placed in its right place. The institution started going on both secured and unsecured. In 2022, we started experimenting with microfinance, obviously through the chosen lesser riskier segment through partnership and VC model. and then started slowly diversifying into our own branch network, which is now I think about 200 branches through direct and 200 branches through a partnership. That's the context from where we are looking at it right now. And why today we rebranded the microfinance business unit as the rural finance unit, rural lending unit. The way we see, and as a very core strategy of the group, we want to position ourselves as a Bharat-focused NBFC. While there are, we are in top 10 NBFCs or more than 1 lakh asset under management, we have to position ourselves as a pure Bharat-focused NBFC. And Bharat lives in the villages. And that's where our rural lending strategy is taking shape and momentum. And when we evaluated different opportunities within the microfinance, what was striking to us was microfinance has been interchangeably called as inclusive finance, impact finance, microfinance, so on and so forth. So when we asked ourselves the question, is it really inclusive? Like when we found out that at its peak, microfinance reached about 4,38,000 crore, or 14 crore unique accounts, 14 crore accounts and 11 crore unique account, more than 8 crore households will cover. See, like, is the choice is with the customer? Does the customer gets an opportunity to dictate down in terms of the tenure, rate, and flexibility? Unless these three things are in the hands of the customer, considering that in a compact geography covering 40,000 households or 2 lakh population, giving microfinance to everybody addresses the needs of the financial inclusion, I'll say no. The flexibility has to be with the customer, and what product and services customer will choose, that would determine whether we are impact finance or we can call ourselves inclusive finance. And that's where we are trying to not only grow in the microfinance space, we will definitely grow in the microfinance space. There is a segment available for that, but we'll also do secured business loan and secured business loan, which is basically LAP. That's the company strategy where we are in right now.
Very interesting. You mentioned that you started getting into the microfinance space through VCs and partnerships, and then you slowly set up your own branches. That was your model of getting into the space.
That's right.
Very interesting. So with that, I think broadly we've sort of looked at what is the experience of each of the panelists in the lending space. I will move to the next round, which is I will expect the panelists to broadly talk about the opportunity. I mean, basically the question is, why should an MFI at this point of time enter into unsecured business? It's just because of the statement that was on the previous panel that the CAGR is likely to be only what Professor Sriram and panel indicated, that it's likely to be slow growth industries, and the only reason? Or is it that because the customers are evolving, we are seeing Kirana stores are upgrading, we are seeing the tailors are upgrading, I've seen the store's presentation, vendors are moving from street side vending into shops, mainstreaming, households are becoming better from thatched roof to slabs. So I think the requirements of the customers also are changing from the typical 30 to 50,000 to maybe 3 to 10 lakh ticket size, along with the of course, I think the point was made in the previous panel that it is not every customer who is evolving. A certain portion of the customers are evolving. Whether it's 10% or 15% or 20% is a question for the statisticians and the data analysts to identify. But broadly, a certain portion of the customers are evolving. So with that, I will ask the panelists to specifically answer depending on the issue, because we have here in the audience both small MFIs, medium-sized MFIs, as well as larger MFIs. So we would like to answer from the perspective of the audience. For example, I'll start with Krishna Chandran. From a small MFI's perspective, if I have 100 crore, 200 crore sort of a microfinance organization, what would be the biggest barrier for us to enter into this space? Is it going to be capital, or is it talent, or is it technology? Can you talk from the perspective of a small microfinance operation?
So from perspective of a smaller MFI, I've had the opportunity to work with multiple smaller MFIs also. So talent, or in this age technology, all these could be brought in if we have the capital. For a smaller MFI, the largest challenge would be to have capital to venture into these new businesses which they do not have that much experience of. Either capital or say longer term patient debt. So if they get this, then it would be that much more easier for them to evolve and tap or capture the market that is available within their customer segment itself. Having said that, how they could overcome also could be through partnership that many with the panels also, and as well as OJs, they've all mentioned this. So that is one route I would really recommend a smaller players to look into, so that they will tap into this opportunity, irrespective of the capital constraints.
Very interesting. I think what it's really saying is capital or partnership. Either bring in capital or bring in partners. That's a very interesting way to put it. So we'll move to Sushanta. Sushanta, I think you have done a pilot stage. You started from scratch, built a 400 crore portfolio in this space. So if you were to move from a pilot stage to full-blown expansion, what would be the learnings? What would be the capabilities that you think become critical?
Yeah, so before that, just I'll add on the opportunity, but then I'll come to this. I don't see the opportunities only because this 60-40 regulation came. If that is the case, when 85-15 were there, people could have done 2-3% of non-qualifying. When 75-25 were there, people would have done 5%, keeping aside other cash and other things. So again, I go back to that DNA. We are used to some setup, and we continue to do. Why? Because that's a cookie cutter model. You just go do some kind of activity in the village and get the market sell. The very, very important thing, what is the opportunity for any MFI as of now is, again I go back to that catchment. Go to the village and understand what is the need of that customer. I'm not talking about the microfinance customer only. The other people residing very close to the microfinance customer or the microfinance customer. Suppose marriage, some event, something happens in the family. It's not a 50,000, 1 lakh or 2 lakh. They need 3 lakh, 4 lakh, 5 lakh rupees. 80% of the people are rural. And I'm sure everybody will agree that 90% of the customer or more than that would be having the own house. Because we microfinance, we consider one of the parameters if own house hai, so that is a little better. Own house is there, rural is there, and they need for various purpose. That is the opportunity. It's not that what is the opportunity that is being created by the company, what is there underlying. Who is tapping the market? Local money lender. Microfinance are not talking. If they need a higher ticket type loan, that they go and keep the gold or something, and they get the money at the higher rate, 3% per month, 4%, something like that. So if I have the branch network, I have the everything. Only thing that the MFI lack is expertise and the patience. Microfinance में patience की जरूरत नहीं है. Correct? So I open a branch, I know कि 8 to 12 months it will be breaking even. But this will take time. But that will yield result in a long run because the loan tenure, everything is higher. So opportunity is that part. And then for a company mid-size and all that, wherever you go, this is the time, whether this is the right time or wrong time, yes, time was always there, but this is the right time to start with a small activity, not explode. I would not say people should consider everything as a pilot for next 1 year. Maybe we don't know 5 years how the things will shape up, but that customer, we have to start thinking in a different way. Okay, there is another thing which can be offered to you. can you bring in one more two? So that the penetration in that villages increases. From the 40 customer, microfinance customer, I can become 60, 70, something like that. Then my efficiency increases, and I can have the better say in the that geography. So this is the time I think everybody should start small scale. Not think about the big rapid, what will happen, 20% share, 30% share. Dennis mentioned that they have 18% already share. So they're in a much ahead of the curve. But every one of us, if you start small, that will be the
No, very interesting. I think what's core takeaway that take from what you're saying is start small, don't postpone, do small pilots, learn, continue doing your main business, but very, very important that you start dipping your feet in and understand some of these other segments, whether it's unsecured business loans or gold or whatever other category you think you're in. So thank you, Sushant. So I'll move to Shishir. Shishir, you are part of a very diversified NBFC, almost 85,000 crore AUM, if I'm right?
No, we crossed 1 lakh crore.
You crossed 1 lakh crore, right? So if I am an NBFC, a small or a medium-sized NBFC, I am operating in a market where you also are likely to come in and operate, right? The advantages I have a local presence, I have a local branch, I have customer trust and relationships. Now, how would you bring in, would you have any advantages compared to a player operating in this segment? Because I have asked this question from the perspective of, because in the microfinance space, even a small organization can compete against even the largest microfinance organization. Like if there's a 30,000 crore microfinance organization, the BFIL or Great Taxes, any of them, even a 100 crore organization can give an equivalently competing offering to the customer and build the portfolio, right? So is there any difference in this in the larger ticket segment like the unsecured or business loan segment?
So taking also Susanta's point to a large extent, while we talk a lot about diversification of the portfolio, was whether the microfinance institutions were by design had the competency to serve secured loan segment. So majority of the they were working on a very thin capital base of 15 to 20-25%, and then the other part of that is like one was the capital structure, the term loan structure of 2 years term loans. Those were by design, that was like that. Jumping into the bandwagon of like, everybody from the microfinance segment can do a secured loan, having that patience in mind, without thinking of attracting long-term capital, may become challenging. Having that context in mind, coming back to your question, is that who is having that cutting-edge advantage? So the large institutions are having the cutting-edge advantage, or the smaller institutions are having the cutting-edge advantage? Yes, both of them are having some cutting-edge advantage. When I'm talking about the rural landscape, the cutting-edge advantage with small and medium microfinance players are their local network, connections with the local market, also the captive field force, the cost structure, manpower cost structure and all operating cost structure. They work on a very lean cost structure that way. What the larger player, banks and large NBFC brings in is their technological muscles, governance, deeper pocket, larger capital base, cost of capital. These are some of the intrinsic competencies which the larger institutions bring in. The question is whether marriage is possible between the larger entities who can leverage their strengths of governance, technology, capital to the local market. Yes, we are working, we are actually working with some of the synergies that is possible. The institutions are actually microfinance institutions as of now. starting our, we're starting a co-lending partnership model with some of the institutions. And when we are talking about co-lending institutions, the entry could be, by doing microfinance to start with, evolve to individual enterprise loan, where we'll build the competency with the smaller players, like how to assess income. Today, in the microfinance context, whether seeing an ABB or account aggregator model is not their competency. We'll have to build that competency around it then, before we take them in our journey, because by core we are a secure lending player, because that will do that eventually. But definitely, it is we're starting today, gradually evolve together, and take advantage of their local knowledge, learning, and make them grow in the same space again.
I think broadly what I'm saying is, I think both have their own advantages. A partnership could really work well. I think very aptly put. So I'll move to the next. I think broadly we have sort of concluded that I think the panelists and the previous panel also, that it is imperative to diversify. Customers are evolving. JLG as a product may not grow at a very fast rate. So, but what really are the execution challenges, right? In the sense, like, the question is this transition easy or is it going to be difficult, right? What are the challenges? I think broadly in the previous presentation I identified 3-4 challenges. One of them was that credit writing, underwriting is going to be extremely key. And I think the presentation also highlighted that the technology or the operations intensive nature of non-JLG. JLG, of course, every one of us are very familiar with, but what sort of upgrades are required to technology, and what sort of operational, the collateral management, etc. What sort of changes are required? What sort of learning curve is required? And I think the third, I think some of it Sirish has already touched upon, the asset liability mismatch and the unit economics. How does it work for us? So we'll request the panelists to take each of these challenges, and I'll start with Sushanta. I will request you to touch upon in JLG. The repayment behavior and all is driven by, it's a very simple underwriting model based on process and based on community relationships, etc. So how does it change in business loans? How does the data underwriting model change in business loan? And what sort of assessment model have you seen work?
Yeah, so this is the crux. Entirely different, as I was mentioning. JLG, very simple. I would say the feet on the street, the loan officer who goes to the field, he doesn't have to do any underwriting. He's not an underwriter. He has to do only one underwriting, see the face of the borrower, whether she's there or not, whether he has been explained. Underwriting is taken care by CIBIL and all those people. That's why lots of bureau check and these data points. It's a simple, guardrails are defined by the SROs. Put it in the system, it throws you, there is something called pre-approved loan, everybody knows. He goes to the mobile, it shows, isko dena hai loan. It doesn't apply mine. Okay, is there? Now when we come to business loan or the secured loan, in secured loan and the individual unsecured loan, the only difference is collateral. Otherwise the assessment methodology is same. The time and energy spent by each of the credit manager, the loan officer's job is just to get the lead or the login, what we say. That is humongous. You will be surprised to know, one customer, if you are dispersing 5 to 7 lakh to 10 lakh, it takes 1 hour, minimum 1 hour to do that PD, field visit, and do the all kinds of check. He has to go meet the customer, meet the household, go to the business premises. If it is salaried, he will make a telecall to the school headmaster or somebody, or wherever he is working. If he is a cash salary, non-cash salary, and number of things are there. So in this forum, it will be very difficult to explain. But 2 things just I want to say. For example, a cattle, micro lab is where I am talking. Variety of purpose the loan is given. It's not business loan. It is daily wage of also people give, cash salary, bank salary, dairy, everything. If I go and then I witness this thing, when the credit underwriter was underwriting, he saw 7 cattle. So he put it, there is a grid given, 7 into 2,500 is the per cattle, and he delivered something. He was coming out, then I asked, how many of them are milching? That everything you cannot teach to the credit manager, because it varies from place to place, person to person. There are thousands of variety of activity. You cannot prepare template for everything and put it in the system, because scenario will be different. So if the 5 milching cattle are there, they will be giving only you the revenue to take care of the immediate installment. So that is one example. And account statement, account aggregator, all those things that we talked about in the morning. I don't think that works here, because a lot of transactions are cash also. So account it will not reflect. Why we take account statement? Only to see if there any immediate loan is availed, which is not reflected in the bureau, because people report in a delay also in retail, unlike microfinance. So those surrogates, those triangulation, it's a very, very complex, I would say. So the challenge comes when we say, no, this is the microfinance field officer. I will ask him to do the leave, and I'll ask him to do the underwrite the case. It will be difficult. Even though it is difficult, we can teach him A, B, C, D, everything. He has to apply his mind. Every case is a judgmental case, I would say. There it becomes very difficult. This is one part of the secured business loan and the unsecured business loan. The complexity starts when it is a mortgage, a collateral. So if you go to the village, a property will be there, 3-4 people will be staying in that. You have to take everybody in the loan structure. One applicant, 3-4 people, brother, sister. If it is not, it is a inherited property. Everybody has to be there. Everybody's CIBIL has to be done. Anywhere something is lacking, you need to take a call. If somebody is staying in Bihar, you are doing a loan in Telangana, and his brother is staying in Bihar, you have to take NOC. I have given the NOC, okay, you can fund it. So the complexity starts with there, and the chain document, all those things. The time, energy spent, not only 4 or 5 people are there. One is the loan officer who gets the loan. Second is the credit manager who does all this activity. There is a legal person, there is a technical person, and the final approval. That's why in the beginning I said it's a patience game, but it has very, very good result. Believe me, 7% of the portfolio of Spandana is secure. If I include this Chris Financial, definitely people should aim. In the country, 6 crore odd customers are there. 6 crore customer. Let us, for example, the next 5 years, that will not grow, remain same. If 7 or 10% of the customer comes to the fold of the micro lakh or unsecured business loan, the number 2.5 lakh, 3 lakh, if you add it will go to 1.5 lakh, 1.6 lakh crore, which can be built up in next 3, 4, 5 years. But that cases, that intention, that delivery mechanism has to be in the place.
So, does it look simple but doable? And I think very specialized skills need to be developed. There cannot be simple. The current microfinance operational structure may itself not be sufficient to handle underwriting. That's what you're saying. So when you're talking about product diversification to business loans, I think what's coming out very clearly is you need to build a separate stack of skills, separate team if required to do the underwriting, and that's what the key message I will take away with. And it's a very patient game. That's additional. So I will go to Krishna Chandra. Krishna, I think he touched upon the challenges of evaluating a property, assessing a property. I think we talked about digital collection as being very important for the non-microfinance models. We talked about end-use monitoring in the previous presentation as very critical. So how important are all these in terms of what are the changes in technology or technology capabilities and the operations model vis-a-vis microfinance?
Sushant sir aptly put about the underwriting difficulties, because the same team was done for microfinance might not have the capability to underwrite properly the other kind of loans. That is a skill which any of the institution who would like to venture into would have to build on their own. It's a patient game. Muthoot, I would be speaking more from our experience. Muthoot luckily had developed a separate credit team, separate channel a few years back. And they had also experimented. Muthoot as an organization experiments a lot with products as well as technology. And we had a separate credit underwriting team who were underwriting other products, which we had capitalized when we looked at it aggressively to grow our unsecured business book. So, from a technology aspect, as I had mentioned earlier also, now getting a technology tool to do this for you or manage your loan book, etc., would not be that much of a challenge. There are plenty of such players available in the market. One challenge would be to marry that software with your existing legacy software and get a 360 view of the customer. So suddenly you are having an entirely new business loan or entire lab product, etc. How is it behaving? The collection team could be also, collection channel could be also slightly different from your microfinance. So as a entity or at the branch level, are they knowing how these loans are behaving? That 360-degree view, if you have a legacy system and the legacy system might not be supporting this new other kind of products, and then marrying that the other new system is a technology challenge. Otherwise, technology is amply available in the market. Now, then account aggregator, I have a slightly different view because account aggregator, again, technology-wise it is very easy, but it gives you lot of hints how this customer is has behaved in the past. Also, we could use that as a monitoring tool along with your regular credit bureau scrub. This is an additional monitoring tool where you get a lot of inputs how that customer is going to behave with others. Of course, most probably Sushant sir had mentioned that from an income assessment kind of view, that I completely agree. All the income will not reflect that, but at least the liabilities, the bouncers, etc. would be reflecting, and that could act as a warning signal, early warning signal for you to step in and be a bit more aggressive with respect to the collection from that particular customer. So that's our learning.
Very interesting. So what you're really saying is, I think a much more closer view of the portfolio would be required, and customer behavior would be, monitoring and customer behavior is very important to ensure the loans don't go into any delinquency. And then I'll move on to Sirish. Sirish, I think, I think one of the biggest challenges that I see for this is, typically the microfinance liability profile is of 2 years, 3 years. Whereas most of the business loans, I think what we saw operating in the market is 4 to 5 years, 4 to 7 years at times tenure. Given that there will be an asset liability mismatch in this case, what really, how do we go about resolving that? Number two, I think what sort of a scale, what sort of a size, what sort of a portfolio would make sense, given that the presentation had indicated around 3 to 4.5% OPEX and a credit cost of 1.5 to 2.5%. So at what scale would I pilot, if I were to, as an MFI, get a pilot, how would I manage the asset liability mismatch? And how should I look at the unit economics in terms of size of the portfolio, cost of capital, cost of credit and OPEX? Can you touch upon this?
Hello. How much time do we have?
30 minutes.
The other way around, how much time they can listen to us?
No, it depends on how interesting we are going to be. So I'm trying to make it as interesting as possible. So we will take about 30 to 40 minutes max, okay? Yeah. Unless you want to extend, right? Since morning, I will just set the context, maybe for a minute or two. Since morning, we have been talking about the diversification. The conference is talking about diversification, right? Okay. Now, I'll just tell you like my own perspective, right? Okay. You see, this microfinance industry is one of the main grassroots power engines, okay, in really in driving the financial inclusion in India. That's fine, okay. We went from 10,000 crore, I think when the Andhra crisis happened, really 4.5 lakh crore, right? We fell flat, right? We went through the crisis of really demon. We survived. There were only bruises. Then COVID happened, again the external induced. Then 2024 crisis. I'll just give you the stat just to build the narrative, right? You see, in an industry where 20% of the customers are really misbehaving, okay? Either willfully or probably by some kind of really instigation by the stakeholders in the thing, right? Okay, now, there are two cycles in any business. There is one vicious cycle, then the other one is virtuous cycle, right? If the 20% of the customers are misbehaving, right, willfully, so what happens is, okay, one of the other stakeholders in the industry is the employees, right? The employees also start misbehaving. Now I'll tell you, we have built we've lent about 3,000 crores over the last really 3.5 years. Okay, we have followed one of the very, very finest processes in the industry. Like I think a lot of guys have come and seen what we do, because I have the customer verification video for all the customers that we've lent. Okay, we have rejected 20% of the customers after the credit bureau approval. So we applied filter after filter after filter, right? It didn't work. Okay, so I think it's time for us to realize that, okay, no amount of process excellence can really prevent a willful default in an industry where, okay, it's beyond the technicalities. How many of you read the book Only the Paranoid Survive? This book was written by Intel founder Andy Grove 30 years ago. How many of you read? Okay, I'll just give you a quick summary. Maybe 30 seconds. The guy talks about any business goes through some kind of a crisis, okay? If it's not going through a crisis, some crisis is brewing, and then the current crisis that's brewing today will not be a repeat of the last crisis, okay? That's been the journey of really microfinance over the last 10 years in India, right? Okay, now it is time that as industry practitioners, we really take the bull by its horns, as they say, and then realize it, and then start really diversifying. I mean, I will tell you, the 20% of the problem is because of one fundamental problem, because it's a cash-based collection base. How many of you agree with me on this? 20% of the really misbehaving customers are driven because we have to go and collect really customers, okay, every month by cash. If this was really mandated through an UPI or NASH, I think this percentage would have come down significantly. I can really anecdotally prove it to you, but we don't have time, right? So that being said, I think diversification is must, because this is the first way I wanted this. Second, why this particular product? I think the Nupur talked about. Even today, I think empirically, 20% of all the loans taken by the microfinance customers are really directed towards really renovating the house or something like that, right? So we don't have the data. Okay. Now, only MFIs can really crack this segment. Nobody else, because housing finance company, I don't think they have the feet on the street, more kind of really distribution system. They cannot do that. Okay, and then the margin, probably the ticket size is too small, they don't have the wherewithal to really do it. Okay, so because of these two reasons, I think, okay, MFIs, in my view, must diversify the product. I mean, MSME is good, gold loans are good, okay, the other really secure lending is good, but I'm saying it's just a natural extension of whatever that we're doing, because 20% of the loans are being anywhere directed towards, right? So now we have to create this category. I think she talked about globally she has the data, and India she doesn't have the data, right? I think it's time that we create the database, okay, for this particularly natural, I would say strategic adjacency. There are a lot of adjacent products, but this is a very, very strategic adjacency. How many of you agree with me on this thesis, guys? Can you raise your hands, please? Just because it's lunchtime, right? I want to engage with you. I want to engage you as much as possible. How many of you? Okay, now. So now what I'm going to do, this is Amit Sharma, Sa-Dhan. I think they have built probably a little more than 1,000 crore. They have built this this particular product, and they have become one of the pioneers. They have graduated from an MFI into this kind of institution. But I understand, like, it's a small MFI. They are trying to build this vertical, okay, like all of us are trying to do. And then from Habitat for Humanity, they will give his own perspective as to, like, what is his response so far. Do we have the MFIs equipped with the right, really, like, mindset and the system, so to speak, to really graduate, right? So now let me hand it over to Amit Sharma from Sa-Dhan. Yeah, go ahead.
Yeah, good afternoon.
Okay, so maybe, okay, since we have only about 10 minutes for each panel, okay, I would really structure the question like this. What is this? Yeah, what is his experience so far? What is your approach, okay, in really pivoting towards this particular product? That's point number one. Okay, generally you can talk about, and then you can also give a specific, because I want this to be very insightful to the audience. Okay, what kind of product that you pivot, right? What is the ticket size? What kind of the process that you really, like, put in place, right? How did you approach the organizational building, right? What did you do with the technology? And then probably, like, did you face any regulatory issues or anything like that? And then how did you manage the ALM being like, graduating from MFI? Same question to all of you, because since we don't have a lot of time, and then probably we'll engage the audience later on. Yeah, go ahead.
Yeah, good afternoon. So we are a 1,300 crore.
Yeah, good afternoon. So we are a 15,000 crore MFI, and I'm the founder of Sa-Dhan Housing. So I built around 1,400 crores in housing finance. And the first impression which was given to me was 20 lakh customers are in your pocket, and you can actually cross-sell it. But I was very sure that the kind of the loans that we are going to give is to build the house. So first the livelihood has to be there in the place, and then comes the house. So those cherry picking was something which was good when I was forming the company, but that was not a reality. So we built a purely housing finance company, which is a part of our group also. And right now Sa-Dhan is around 25% into the secured lending. Out of which 15% is coming from housing itself. Housing is a pretty tough game right now. When we formed the company, I think there were a lot of spaces for us to do the business. But right now,
how much was the cross-selling you were able to do?
See, cross-selling is something which is, I would say that a mirage kind of a feeling which is given to a housing finance company, because those customers take time for around 5 to 6 cycles to be graduated to take a loan of around 1.5 lakh or 2 lakh rupees. And in microfinance, what we have observed is, so we have a micro housing book of around 200 crores right now, out of 1,500 crores, which is not even 10% of our portfolio. And now what we have observed over a period of time, that most of the loans are for the construction purposes, because we don't do value, what we call as a lifestyle funding there, so they don't buy houses, they already have the houses. So we have to take care of this P+C or the construction kind of loans, and the OpEx is pretty high there. So cross-selling, I can say only in two sense, that one is that because microfinance is rampantly present, so we have the ground knowledge, because ground knowledge is very important, products are just the variants. And secondly, the customers which are graduating from 4 to 5 cycles and are purely based on the assessments which are eligible, may be the captive customers for us. But Sa-Dhan Housing has a separate entity for distribution, for customers, for assessment. So we run it like a parallel company.
Now, what kind of percentage you put for the cost?
So right now we don't even have one, I would say that not even in decimals that we have actually capacity.
Look, this is something that we want to verify. I think you corroborated data where 20% of all the loans from MFI go to this. I'm not sure, why cross-selling is not happening actually.
Go to home improvement.
Yeah, that's what I'm saying.
Because she must be talking about the entire housing loans.
But she's talking about the microfinance being utilized.
Yeah.
Microfinance being utilized.
So at our group level, we have not done that right now, to be very honest, but we are in the process of doing it. But there are a lot of challenges in income assessments. The loan tenures are a little bit high, and that is the crux which we need to follow. So the filtration is very tough. So out of every 100 customers that we get from the group,
at least 90 are getting rejected because of the eligibility, property issues are there. Then identification is a big problem. If you want to talk on the practical aspect, I can give the insight.
No, that's why that'll be useful to them.
Yeah,
actually.
so see, housing is a very good sector. It's a very challenging sector. Just for the consumption of the house, there were 120 housing finance companies which were licensed by NHB. When 2016 we formed the company, and right now only 90 are existing. So most of them have converted into what we call as NBFCs, or some of them have surrendered the license because technically it's a very capital intensive business. And having said that, the current outstanding, as per my understanding, is around 33 lakh crores in housing finance.
Okay.
And one of the gentlemen was saying that we have a leverage of NHB refinance, but I think they are coming from the same category. The NHB refinance is limited only to a certain percentage of the liability profile that we have. So housing finance have a lot of challenges, but at the same time the opportunities are also very good. In the rural side, if I want to talk.
Sorry to interject. What is the product average ticket size?
So average ticket size is around 12 lakhs. So we cater into the semi-urban markets of around 10 to 15 lakhs. And then in the rural for 200 crores, that what we have built up is to 1 to 5 lakh of rupees. But the entire lending happens into tranches because most of the loans are coming into P plus C or C. And that is why the offtake is pretty less, because tranches again have to be given in a year or two depending upon the stage of construction. Micro housing has a lot of challenges, I would say that, because legal title is a very big challenge there. And since this is a very reputed institution, if they can really present the ground realities which is actually curtailing the business, as one is the legal title, and secondly is the identification of properties is a very big problem in the micro housing side. Women ownership, I would say that is more or less propagated. But if you ask me, then in the rural, most of the housing finance registries are in the name of males. And even if we try to do a joint addition into the registries, the cost is very high. So technically it is on paper, if as a co-borrower a female can come. That too also happens in a very less manner.
But you are not giving loan in the name of the men in the house?
No, we give, but since female co-ownership needs to be propagated, because see, my personal experience in rural is microfinance only lends to females, and they are actually quite systematic, and the presumption is that they have a good saving habits and discipline. So we would also like that the asset, if it is created as a pari passu in the name of the female, then the what we call as the repayments can be more serious, but there is a lacuna in that. So legal title is there, then there is a registry title is there, female co-ownership is also a big problem. And my biggest pain, and this is I'm sharing just out of the woods, is, see, we are actually trying to do a financial inclusion, but as per me, we are actually doing a lot of financial exclusion. Why? Because as she rightly said, and that is a target market for us also, 1 to 10 lakhs is a very good market for home loans. But the problem is that these people have a very fragile income. So if you classify them as NPA in 90 days and being a secured loan, a lot of these people are getting actually excluded from the formal credit process. So this is my request, if as a forum you can put it across, that for a secured loan, 120 days NPA recognition is quite a decent norm. In housing finance, the biggest problem right now, what is happening is that the number of customers is not increasing, but the book size is increasing. Why? Because top-up loans are happening, and top-up loans are basically used for business purposes, and a lot of BT is happening. My understanding is, if we really want to go to the hinterlands of India and target the new customers, it is just my personal opinion, I'm not talking from Sa-Dhan behalf, so please don't quote me that way, is we should technically stop the BT. We are taking the entire credit risk. After 2 years, the customers get BT to a fine rate NBFCs or an HFCs and maybe the banks. So foreclosure charges is very important for us to retain the customer and technically to actually have the fruits of the the pains that we have taken for onboarding the customer who was risky on the first proposition. Okay. So BT needs to be stopped. That is a very important. Balance transfer. Balance transfer.
Yeah.
So that is the biggest pain in housing finance companies. So BT needs to be stopped, and I think 1 to 10 lakh of rupees, a mortgage guarantee commission is there, but they only take the guarantee for around 3 to 4 installments, and thereby the cost build up into the loan structure is very high, so people cannot afford it. So I would say that if the government really wants to push the housing in true sense, in purely 1 to 10 lakh segment I'm talking about, not more than that, because there the income capacities are a little bit higher, so they can actually guarantee the loans.
Let's, instead of being broader, I want to zoom in.
You ask me,
No, what I'm trying to say to you is, okay, for the sitting MFIs here, okay, can they venture into micro housing loans? Okay, the answer is yes. What are the product size based on your experience, right? Okay, and you're only given loan to women. You're saying, right? Out of the 1,500 crore, 200 crores. Talk to us about the 200 crore portfolio that you created, right? What are the lessons that you can share with us?
So the benchmark for microfinance for doing housing finances just be in the range of 1 to 5 lakh of rupees.
Okay.
The EMI burden should not be more than 10 to 15,000 of rupees,
okay,
because already they are borrowing from you, 3 lenders. At least have a customer base which is completing 3 to 5 cycles, because we feel that now they are at a position whereby they have a consistent livelihood supported by MFIs.
Okay.
I would say that female borrower is very important. Keep them onto the loan.
Okay.
Without that, we should not do that. And minimum income slabs, what we follow.
Okay, is this interest rate sensitive, this segment?
See, interest is not a problem. I should not say it on front of you.
Can you do as much as what you do with the MFIs?
So it can be in the same range. It's not a problem. Because there the customer don't talk of interest rate, it talks for a lakh per EMI.
Okay.
That's how the home loans also sells there. So interest rate is at a parity.
Okay.
The biggest important thing is please don't do scorecard based lending into housing finance. Take it as a facilitator, but the physical PD of the customer is very, very important. Insist on double income. Cash salary, put a cap of around 20,000 rupees. Okay. And the household income should not be less than 25,000 rupees. These are basic points. And for the consumption of the house, our micro housing finance portfolio has really performed exceedingly well. And we are having an NPA which is less than 1%.
Even in the structural issues.
Even with these structural issues, because I would say the market is pretty big. We can capture a larger market if these structural issues are reformed. But still the current market having all these legal titles and other things are very good.
Okay.
One more important thing, if we really want to, just for the benefit of the MFI, and this is the institution, please present it to the government of India that they should start doing Pradhan Mantri Swamitva Yojana in a very big way. Around 2 lakh crores of business is sitting in the market. If they start doing it, they did it as a pilot. We also finance them, but somehow it has stopped. That is a very big market for housing finance and maybe the loan against property portfolio also. So these are certain things as a microfinance you can do. Microfinance can also be acting into co-lending and BC models. And unfortunately, the small microfinance can be funded by people like us for home loans.
Okay, can I just conclude, summarize, and then I want to give it to you.
I can speak.
Yeah. So just to summarize, okay. And I think you're saying there's no cross-selling opportunity. In my view, I think there's a cross-selling opportunity. Let's verify this, guys, right? Okay.
No, I say the cross-selling opportunity is huge, but these were certain parameters you have to take care while doing housing finance.
And you suggested that, okay, you focus on the product 1 to 5 lakh category. Interest rate is not at all really an issue, right? Okay, and it's considered as a secure product in the minds of the customer, right? Okay. Now, so what was your challenge in scaling it up? The way you would have scaled up microfinance.
See, OPEX is,
with that, I want to turn over to Mani.
See, OPEX is one of the issue. Legal title is second. Saleability of property may also be an issue once the the loan gets NPA. Identification is another big issue. So you have to invest a lot in legal and technical.
Out of the 200 crore portfolio, okay, how much of the assets did you have to liquidate or like not to get your money?
See, right now it is 0.85%. So, but the beauty of the product is that the LTVs, because of the eligibility of income, are not more than 35 to 40%. But the property will be sold only to the local people also, because people from outside are not.
So you follow LTV 50%. Less than
50% it never reaches. In our case, it has never reached because of the eligibility and income restrictions. The property prices are fairly good enough. So if you follow all these principles and don't compromise on the physical PD,
okay.
I think there's a lot of meat which is available there.
All right. Okay. So can you maybe? So with whatever Amit has said, okay, based on his experience of having built 200 crores, right? Okay. How can we encourage the MFIs to learn from some of his own stuff? Because you are a consulting company, right? I think, and I probably after this discussion, I want a lot of MFIs to come and talk to you and engage with you to see what are the learnings that we can take from it and really build this portfolio. So what can you, how do we take this lesson? And I understand you have been working with MFIs. I think Bapu said, how many MFIs you have been working with?
Currently 5 of them actively and more than that.
Okay, so maybe you can take the learnings from him and then also take the learnings from the 5 MFIs and share it with us. What is that?
Yeah, sure. So quickly, first is customer, okay, who's not represented here, but we'll start with that. Okay. The need has been the same. The client has been the same. Graduation has been happening. If we need, even go to 2006-10, pre-Andhra, pre-Malayagam, most of the big NBFC MFIs already wanted to get into housing, either through a housing finance subsidiary or through programs. Like you take Bandhan, Jana, Ujjivan, Equitas, all had some aspect of housing even happening.
Okay.
So why this discussion is happening in this room today, the story has been the same, but it's been missing in the last 15 years because of the regulatory constraints, and now that's been unlocked by 2-3 measures. First is income generating loans was removed in 22. Then qualifying asset came to 75, which was still not attractive, but now 60. More than anything else, there is an explicit direction or inclination from the Reserve Bank saying that try diversify and get into secured. So the need has always been remaining in the market. How or why are we speaking about this in this room is what is more important, because of the timing, which is why this whole diversification becomes important. Like Sa-Dhan went the subsidiary route, have a separate entity now, which is what this story. It's also, we need to be seen in the time axis. Like, would they go for a subsidiary, separate HFC route today in the current regulatory context? Is a separate question which we should be discussing later.
There's no need also, right? With 40% available NQA, non-qualifying assets, there's no need also.
Yeah, so that is what. So current context MFIs, what we have learned also in the, so when we started engaging with MFIs actively was pre-60%.
Okay.
So there, that time we were talking about co-lending, but the clear learning which we have got is the money in housing finance business is happening over multiple years, the income. So it always makes sense for the MFI to hold it on to their books and do it and earn it over the second, third, fourth, fifth year of the loan, because the first year incomes anyway goes in the acquisition cost.
Okay.
So they need to hold it in their books, and that makes sense rather than doing co-lending. So that clearly shifted when 60 happened.
Okay.
Otherwise, we would have still talking about co-lending, which the MFIs.
So that's very encouraging.
So it makes business sense for now the MFIs to do it themselves.
Okay.
But what are the risks and challenges? ALM, capacities of the institutions, and funds being available. So that is where multiple efforts.
I just wanted to go back to what is the typical tenure?
So in the case of our books for 15 lakhs and above, it is around 12 years.
Sub 10 lakhs.
Sub 10 lakhs is around 7 years. 7 to 8 years.
1 to 5 lakh you said, right? What are the difference?
1 to 5 lakhs is around 5 to 6 years. That's how we have done.
You can even go below that, right?
So better is the shorter the tenure, the better is, because what we have observed is that in certain places people even migrate because of the urban migration is happening in a big way. So tenure should be a little bit shorter, but then EMI burden increases.
So again, coming back to the tenure question from the client point of view.
Just one more insight on this. I think an housing finance loan, especially micro housing finance loan, with probably 20-22% interest rate, longer the tenure, I think the interest outgo for the customer is very high. I think it may become a problem later on. So that's why
So
the shorter
I
tenure.
can say for all housing loans, typically get close to half the original tenure.
Okay.
Why we need a longer tenure at the time of origination is to keep the EMI comfortable. They will anyway end up closing the loan in half the tenure. So ideally, especially 1 lakh to 10 lakhs, if you're talking about a 5-year to 10-year at the time of origination, will be a loan which would get closed in 3 to 6 years.
Okay.
So what the MFI needs is that kind of money, which is not as low as 2 years, but slightly greater than that.
Why I'm raising this point is to address the ALM issue, right? Okay. Anyway, probably some of the MFIs are also going to 3-year kind of a tenure loan, right? So you extend it to only 5 years. It's not a big kind of a stretch on the ALM side.
That's the first stretch,
Yeah.
which is what we would recommend to the MFIs.
Exactly.
Again, let's talk about the product. Let's not complicate. Bharat built self-built increment.
Okay.
300 to 800 into 1500 per square feet.
Okay.
We're talking about 4.5 lakhs to 800 into 1.5, 12 lakhs, right? If they're able to bring in 1 lakh, 2 lakhs, 3 lakhs on their own, we are talking about a segment which is what we are highlighting as 1 lakh to 10 lakhs. Pradhan Mantri Awas Yojana or any other subsidy would give another 2 lakhs or 3 lakhs.
Okay.
And hence we are talking about a loan of like 1 lakh to 7 lakhs, 8 lakhs.
Sure.
MFI can cut it off wherever they are comfortable. So if you want to cut it off at 3 lakhs, you can do 1 lakh to 3 lakhs. You want to cut it off at 5 lakhs, you can cut it off at 1 lakh to 5 lakhs. You want to stretch to 6 lakhs to 10 lakhs, that's also a product. But what we need to understand is these three are 3 different products. 1 lakh to 3, 3 to 5, 6 to 5 to 10 are still 3 different products, and which is what with Sa-Dhan support we are trying to impress upon NHB that the quality of security or the degree of security also need not be the same. Today in a HFC cap where he is having a challenge, or most of the AHFCs also we found is it's black or white. Like you have full security or you have nothing, and that's where the whole thing happens. What we are trying to tell NHB is that for up to 3 lakhs or up to 5 lakhs, like if you are able to categorize this as a separate segment, we can have a gray area kind of security, take the security whatever is available, so that there is no willful default, which is the key risk of this segment. Like the client is not just going to stop payment and walk away because there's some payment.
Let's educate the audience a little more on the NHB coming into the play. Is NHB coming into the play? Anyway, like as an MFI, they can do whatever they want to do with 40%, right? Okay?
That's right.
Let's say 10% of their portfolio, they wanted to be in micro housing finance. Let's say probably like 1 to 6 lakhs or 1 to 5 lakh. It depends on the organization appetite and everything, right? So like okay, where does NHB come into
So
this?
we have advanced conversations through Sa-Dhan with NHB as well. We are engaging
I'm asking
with
you,
them.
where does NHB come into
I'll
this?
tell you where. There is a disconnect. MFIs are eligible for interest subsidy scheme under PMAY because it's listed as one of the eligible entities.
Okay.
MFIs are eligible under NCGTC, the credit guarantee program, because they are enlisted as MLI.
Okay.
But MFIs are not eligible for refinance from NHB because it's not listed under eligible categories.
Okay.
So within the Government of India Ministry of Housing realm itself, there is inconsistency where it's allowed in 2 places but not allowed in 1/3 place, which is housing, right, at NHBA. Which is where it becomes important because we need to move the needle there so that it kind of solves one of the problems, which is where we, if you see in Nupur's presentations, we're saying let's start doing it, we are already there.
Okay.
We have an in principle kind of a blessing that they're willing to have a look at it, thanks to Sa-Dhan's effort that they are saying that we can set up a dedicated fund which can go towards this because the government is also seeing Pradhan Mantri Awas Yojana getting funded sufficiently through the financial institutions.
Now, this may take a while. I think, I mean, just again for the purpose of the audience, let's say even me as a company, we want to go, okay, right after this, we want to engage with you. I want to pivot a product 1 to 5 lakhs, right, okay? Probably interest rate, probably between 20, 22, whatever, right, okay? And have a tenure of 5 years, okay, maximum 4 to 6 years, whatever. I mean, there are not many constraints for this.
To start, there are no constraints.
Okay, I mean, I think that's the message I want all of us to really take away from.
One state, which is what we are saying, you don't have to do in all the states where you have presence. Like take your home state, just do reasonably good in certain branches where productivity is good, your asset quality is fine, you are comfortable with the local state laws, do one state.
We are doing MODs for this or what?
Yeah, they do, yes.
They do.
Which is.
Amit, are you doing MOD for this?
No, sir. In every case, MOD is not required because a registered mortgage has a cost associated with this. Okay. So we do a equitable mortgage. So we keep the papers and we do it.
That's
only in
an
the case where the
institution.
boundary is not identified, as a safeguard, we do a commodity or a registered mortgage.
So,
Shwina, okay, can you share your experience? I mean, now he has already done it, okay, so they have shared from a technical aspect, right? I think, have you started it? Where are you on your journey? So you can share your experience with us.
So basically, we've been doing microfinance, micro housing for quite some time, but we've not scaled the micro housing portfolio due to various challenges and limitations. So most of the micro housing portfolio is between 1 to 3 lakhs and mainly focused on renovation, repair and maintenance. It also includes less than 50,000 B-Wash portfolio, which also again is home improvement in one way. So this has been a majority of the housing experience that we've had, and this at any given point of time is somewhere between 3 to 7% of our portfolio. And then pre the Maligan Committee regulations, we did have proper housing portfolio, and then when the regulations changed, we were not able to continue with that portfolio. And again, now recently in partnership with Habitat, we did a proper market study and we again designed products. And now we are also looking at this entire 1 to 10 lakh segment slightly differently, and we have two types of products where one we are looking at up to 2 lakhs.
As of now, how much is the average ticket size now?
So we have both ticket sizes.
1 to 3 you said?
1 to 3 is one category, and then we have about 3. Mostly we try to limit up to 5. But in the larger token size loans, we have a limited exposure. But we are looking to increasing this
up
to 2%.
Up to 5 lakh ticket size, right? What's
Yeah.
the tenure, average tenure?
It's up to 60 months. Overall, any exposure, even up to 10 lakhs, we limit
And
to
again,
60
these are
months.
interest rate sensitive.
Yeah, no, we are offering it at 19%, which is considerably lesser than our other rates.
Alright, yeah, correct.
But in terms of the higher token size, it's not essentially just because of the underwriting or the income or the legal document availability. We are not able to lend in this category as much as we want, mainly because of paucity of funds. With the amount of funds that we raise as a small to medium MFI, more focus is on retaining the existing customer base with lower token size loans so that we can cater to more beneficiaries rather than focusing on higher token size loans for housing. But we do have a huge market segment, captive customer base who have completed up to 10 cycles. And according to their life cycle needs, now housing is the core need that is felt. And we kind of reinitiated this product because we were getting demand from our customer base for this sort of a product. But then again, now we have a ad hoc setup in place to cater to the product because we have good banking professionals in place who take care of the underwriting and the assessments. Though the application is sourced by our existing field officer, the assessment is taken care of in a centralized manner by an expert team. But when we go to scale this product, there are two things that are very important. One is access to funds specifically for this purpose, because most of the funds that we access comes with a mandate saying, agri and allied or income generating activities. So there is very less room for us to actually service this demand that is available. And then secondly, we need to build a specific vertical for secure lending. We already have a micro loan which caters to slightly higher token size, over 3 lakhs we do. So all this can be clubbed together in a secured vertical, and we will be able to scale the business. And in terms of the capabilities that the field officer requires, I feel that technology can play a very significant role here, because there are advanced AI-based and data-based underwriting options that are available right now. So basically, the field officer just needs to act in terms of capturing the data that is required, and then
can you share one or two tools just for the benefit of the audience?
We've partnered with a new service provider. We are transitioning, and they have this predictive system in place, where they can, the service provider is called N7 Banking. So they can take in all the parameters, and they can give you an assessment. So this is how things are. So if we can access enough capital, we will be able to build a very strong portfolio, both in the in all 3 categories: 1 to 3, 3 to 5, and 5 to 10.
Right. Thank you very much. If you
One point I might add, which I missed, but then most of the people in the room also already know it, but then we have to bring it to the forefront, especially in the context of this conversation in housing. The household which we defined for the purpose of microfinance is that one lady rearing goats and cow, right? Like, that's how we have positioned this category and segment. The reality we know is different. There is a spouse who has an income which is something, as many cycles which they talk about, 5, 6, 7, 8, 10 cycles. The sons would also be contributing either in situ in the place where they are, or they've migrated, they're contributing back to the household, and that is a substantial proportion of the family and the income. So when we look at the borrowing unit itself from that one lady to the household, when we diversify into a product like housing, housing is always looked at it as a household, right? Like everyone contributes to the repayment.
Correct.
So this difference in how we look at it itself will help institutions do much more loans even to the existing client bracket as such. So that is the key thing. Why it becomes important to discuss now is, so far the issue was, how do we classify the same person as 3 lakhs qualifying on one place and more than 3 lakhs in another loan within the same institution? While he was saying like none of or hardly any Sa-Dhan micro customers are in Sa-Dhan housing finance, be rest assured most of the Sa-Dhan micro customers will be housing loan customers elsewhere. And that is true for most of the institutions. The loan need is there, the loans are there in the market, that matchmaking would be happening. This change in criteria of really moving, and for that matter they will even foreclose the microfinance loan to avail the housing loan, and it's also going to happen. The question is, do we want to do it ourselves for our own clients and continue the relationship, or allow the customer to go out and then come back in another form? That is the only thing which we need to see.
Okay, thank you. I think, one of the reasons for the diversification is the RBI has really moved the NQA from 25% only 40%, right? Okay, non-qualifying is not talking about. I think in my view, Gigi sir, it is not a concession they're giving us. I think it is a mandate they have understood. Actually, this pure MFI play is going to be cyclical, crisis prone. I mean, the whole industry between COVID and then the 2024 and 2025 crisis, you lost about 1.5 lakh crore. That's huge. That's humongous, right? Okay. RBI is very well aware of this because they're nudging us to really go and diversify our product portfolio. So we don't have to go through the cycle again and again. Okay. So that's what it is, guys. So now, I mean, we are 2:20. I just wanted to make it interesting. That's why I kept interjecting, so we get exactly what we wanted from the panelists, right? Any questions that you have, probably like 2 or 3 questions we can take, and if you have, then probably they can continue and answer us. If you don't have any questions, probably I can ask them for the last round. What do you guys have? Any questions, please? Anybody? I think, see, what I gather from the panelists so far, right? Okay, two practitioners of one really consulting company, there are no constraints. No constraints actually. We can go and really build this product, okay, from 1 to 5 lakh. Our regulatory latitude is there. Funding, of course, any funding will be there. Even in terms of the ALM mismatch, it's not a big stretch. It's not, okay, from 2 years you're going to really 15 years. No, that's not. You're doubling it actually, right? I think 20-30% of your really funding can always have the little bit of higher really ALM thing, right? So I think that's it. In my view, there are no constraints for us to really take this product and probably make it one of the mainstream products, okay? Because there's a clear strategic adjacency, okay, for the MFI customers. I mean, even MSME is not an adjacency actually. Microfinancing product, okay, 1 to 5 lakh is a clear adjacent product for the MFI customers. You have any questions, please? Okay.
Just one question.
Yeah.
What percentage of your lending is for housing?
So, in terms of proper housing, this micro housing over 5 lakhs, that will be less than 1%. But the other for renovation, for wash, and for home improvement, that will be some range between 3 to 7%. It varies year to year, somewhere between 3 to 7% based on portfolio availability.
And do you also get repeat requests for the loans for the housing purpose?
Yeah, over a period of time, it happens. First, they will take 50,000 for some small renovation. Then later, they will take 1 lakh loan for maybe building an additional room or things like that.
How is the portfolio behaving?
Yeah, this portfolio behaves fine in general because it's for some sort of asset building. Similar to wash, the movement is good in this
It's 200 crore, is at about 0.85%. So that's bigger.
See, just to add
different to what she's been doing there.
More or less like micro.
Just to add on to what he was saying is, see why we build only 200 crores in spite of belonging to a very large group was that I really never wanted to rush the things. So for 5 years we have tested various cycles including COVID. So now we have actually understood the nuisance which may happen in this kind of market and what kind of exposures and restrictions or credit policies that we really need to take care of. So that is the essence because of which we build up very slowly, and now is the time, excusing this event risk which is happening right now, that we are going to scale it up to a very large scale. Our IT automation is fantastic because we have an in-house technology and the integration is fantastic. We have state-of-art AI models, but I still say banda or nanda. तो AI models वो कंप्यूटर पे ठीक है, लेकिन अगर विलेज में जाके देखा नहीं कि बंदा क्या कर रहा है. No sir, I always take honestly speaking, if I were to go back to my old era, because now we have again gone to thumbs, कि मतलब बैंक्स में पहले बहुत अपनापन होता था, NPS कम होते थे क्योंकि लोग ब्रांच में आते थे, लोग जानते थे एक दूसरे को और फंडिंग उस हिसाब से होती थी. अभी सब digital, or I'm not against digital, but what I'm saying is this is a business of the people, so be with the people. Otherwise, the default ratios will be very high. These score models are good, but none of them trust me. We even did it in Sa-Dhan. We hired basically a psychologist, and we did some 4 paintings to analyze that what is the customer behavior. So we rejected a lot of loans based on that photographs that she identified. And then we analyzed that those were the loans which were best performing in the other MFIs. But the ones we approved were having a lot of problems. So these are facilitating tools, but don't get the human touch out of this business. It's very, very important. These are my learnings. And now these 200 crores, I think in the next span of around a year or so, we are going to build up to 1,000 crores.
Right.
And that's how we are going to build up.
Yeah. So I think my reason for asking was they have certain, I know that they have expertise in building up this store. They have gone up to a level of 200 crores. Here it's a proper microfinance, and they getting it right, and the delinquency is not showing up. It makes a very amazing difference. Okay, good.
Well, that could be because of the connect which he's talking about.
Yeah,
So
that's the only thing. That's the only thing. The need. Yeah. The need is there. Like, we don't have to do it in all the branches, like fixed locations. That's the key thing. security, take whatever paper is there, there is no willful default. In end-use housing, like repairs, renovations, extensions, housing constructions, completion, water and sanitation, it's all self-occupied residential house, they are very much there. They would want to get the paper back as soon as possible. So that is the key thing, which is also a temptation. The question never came, so I will also ask that question itself. Like it's very tempting to do loan against property because everything else is almost the same, right? But then it's an altogether different product. Here is a product where the customer wants and has a need housing, is more or less like unwillingly giving that paper and taking the loan and wants to get that paper back as soon as possible. This is housing loan, end-use housing. Loan against property, I want to grow my business, I want more working capital, I don't have means, and hence I'm going to give my property papers and take a loan. So from credit ideology point of view, it comes from two different directions, though process-wise it looks the same. It will say, oh, first and final disbursement, easy, everyone requires LAP. So we have to look at it two different ways, but then that's what is from the risk point of view.
So you're saying this is much more safer?
Yes, end-use housing is much more safer when compared to a LAP, though everything else remains the same. And a LAP looks easier also because you get more clients, better profitability. That is one. Questions which did not come. As was already discussed in the morning, like board level commitment to diversify into housing loan. There is no right or wrong answer. If you get that, that's the first requirement. Once you are there, 2 to 5 years commitment, that's required. People issues will come up, like in the sense you are in a business where rejections are not heard of, and here we are going to kind of start rejecting loans. So that's going to be a challenge which needs to be dealt with. One of the easier solutions pre this topic would have been like have a separate vertical, separate team and all. But the risk which we are seeing is that your microfinance portfolio is not going to grow in as much pace, which means we are going to have people, but productivity is going to start dipping. So we need to be smart about how we deal with human resources between our existing business and this, which is going to be a challenge. Systems are not like very easy to transition. Like it could be as simple as systems not able to handle more than one disbursement. Because you've all along done like single disbursement, first and final, where IT systems may not be ready to do second disbursement, interest calculation until final disbursement happens. So that is something which we will have to be conscious upfront. And then the other risk or the question which keeps coming up is document storage. And the other issue is on variable rates. While rate is not a problem at the time of origination, the challenge which he's saying like 2 years. So today the problem is I don't get a loan. It's not about 24 versus 18. Okay. Today I don't get any loan or 30%, 48%. So for me 24 is fine. After 2 years, I have HFCs and banks lining up for 50%, right? So this 24 beyond the point is not sustainable. We can start with that, which is where ability to offer variable rates become important, and many systems today, IT systems are not conducive to offer variable rates. So those are some of the things which we need to be prepared upfront. If we are getting into housing, there are solutions, but we need to be conscious and get into that.
Thank you.
Sir, my only take is when you go on the ground, most of the people don't even know how much money they require. So please don't compromise on the credit people. Don't keep 1 lakh or 2 lakh inexperienced credit people. Don't get the credit done from sales. That is the biggest learning that I have learned, and maybe the thumb rule for us to get this quality book in rural. So these are important things on the practical side, and rest the list is endless. I can keep on speaking. And in microfinance itself, create a separate vertical in software segregation, so that you know all these things.
Yeah, it has to be a separate business.
Data has proven beyond point. Housing finance NPA is around 100% less than what we left. So this is
all right, guys. Hope it was insightful to you guys. Hope the panelists did a good job. Thank you very much. Thank you.
Thank you, sir. Thank you, the panelists. I request Jagdish sir to give the.
I had product and research at Pharma. apologies, I have a hard stop at 3:45. I otherwise had carried a presentation with some insights around gold loan for you guys. But because of the time, it might get tricky. So we will start with the panel. During the conversation, if I can fill you up with certain nuances around gold loan, I'll fill in, okay? And just in case we are getting done on time, then we will try to squeeze in the presentation as well. So, do you want to introduce yourselves and then we can start with the panel, please?
Yeah, good evening everyone. Myself, Swapna Sarif. I'm the product head for Best Microfinance Limited.
Yeah, hi. Good afternoon. My name is Karthik. I co-head the financial sector rating manager. I've been there for 15 years.
Yeah, hi. Good afternoon to you all. I'm Raghu here, Raghu Pandit. I'm part of the Lillian Group. I take care of the vehicle financing in India. That's two-wheeler and car loans. I've been in the organization for the last 3.5 years. Right? Thank you, gentlemen. So, the thing about fireside chat is that I've not done it much, but when I started, I thought the idea is to make it fiery and throw a lot of curveballs on the panelists. It is much later I realized that it is supposed to be a casual chat of sorts.
So originally it was like that. Originally what you said is right.
So, but still, we have a combination of it. We keep it light. And the way I have designed the questions is such that, if it is a fireside chat in the real sense, you can take the creative liberty and the liberty to have your own doubts cleared in the process. Okay. Now, with gold loans, there has been such a frenzy around gold loan, and I, as a bureau, have been observing it for the last 1 to 1.5 years. I'll give you a couple of insights there. We never used to publish any data, any report covering gold loan, because as an industry and as the nature of the product, logically also, there was no active practice of reviewing the bureau report before lending to customers for gold loan. At least the majority of the industry did not do it. Delinquency was not, a concern. Practically you are lending money against a highly liquid collateral. It is only in the last 1.5 years that NBFCs started, asking us what is happening around gold loan and what is happening around LAP. And it is not our, primary observation that there was something happening around it. But gold loan, though it is in discussion and news so much for last 6 to 8 months, this is a particular product category which has been growing at 35% compounded year on year for the last 3 years at least. Even before that, it was growing faster than any other lending asset product. Last year, what we have seen is it has grown by 50%, primarily led by the value of the underlying asset that has increased. So Swapna, my straight up on this one to you as a practitioner would be the growth has been robust. Okay. Now, if anything grows for any other lending product, whether it is two-wheeler, whether it is home loan, it cannot happen without the health of the. It is actually a reflection of the health of the economy. So if there is demand for two-wheelers, demand for home loans increasing, that means people have aspiration, and that's why they're purchasing these consumer durable products and consumption loans. But with gold loan, it is slightly tricky. Because the end use of it, though in plain sight and in general understanding it is working capital loan, the growth has been phenomenal. Is this all organic? Is it something that, as in the usual conversation, it is all working capital loan? or traditional borrowers have been continuing with it, or there is an undercurrent of financial stress in the economy. Have you thought about it, reflected on this point ever?
Thanks, Vibhul, and thanks to Sa-Dhan for giving me this opportunity. Now, coming to gold, see, gold is, invariably, like you would all know that gold has been there in everybody's closet. The only thing is it is now more coming out, right? And more so because now that there is a rise in the gold prices, so people have realized that they can monetize it. And talking about the undercurrent or stress, I don't believe, see, there may be some pockets where there is a possibility that there are stress in the family so that they want to come up with a gold, pledge it and take loans. But invariably, how it has happened is, now the customers or the people have realized that there is something which they can take out of the idle gold that they are having. And earlier, the understanding was probably gold was the last resort. Like if you fail on all other avenues, then only you can go with a gold to a pawnbroker, place it and take money. But now, almost across all, it's not only in rural areas, but even the middle class and the urban sector also, people are coming out and placing the gold. And most likely, like say, people who are going for new avenues now that in the economy, a lot of entrepreneurs are coming up. So they are realizing that if they are placing this gold and taking some working capital, making money out of it and getting the gold back. So that way, I believe that gold as such has become a more of getting avenue rather than it's a stress kind.
Sure. What I can share there is, in gold loan, last entire financial year, across sector, that is public sector, private sector, NBFCs, the delinquency, early delinquency and late delinquencies both has substantially improved. Especially for NBFCs, last fourth quarter 25, the NPA was at 2%. The same quarter last year of fourth quarter 26, it was around 0.5%. So, definitely the borrower behavior, has shifted towards, more discipline in terms of repayment as well. Raghu, so for MFIs, cross-sell, and as the theme of the conversation is diversifying. Natural diversification is, used car loans, two-wheeler loans, three-wheeler loans. So, what could be the entry barrier that the microfinance industry might face, in the process of diversification? Like earlier today in the morning, very wise things that we have heard, that though there might be government policies, that might support you in doing that, but all these processes and frameworks are pretty nuanced, right? So, even though, somebody might have, the motivation, but, do they really, have the resources? And what are the resources, rather, you think that they will need to cross this chasm?
Brother, again, I also want to thank Sa-Dhan and Gigi. I have come up with a completely different thought process when I came in. It was quite enticing, quite knowledgeable, because I thought I would be talking about something else, but pitch has completely changed now after listening to maturity. Having said that, see, what I have seen is the numbers which were being shared in the initial presentation. It spoke about 719 branches and 719 districts. And some 30,000 odd branches involved. This is phenomenal numbers. Coming from a retail kind of background, I'm just answering to why I feel that this is a very promising place. The most easiest product to be sold in the entire loan fraternity, especially if we talk about the secured side, is the vehicles. Vehicles come in very conveniently. And what beauty about the vehicle also ensures that it is supporting you on the commercial side in case if somebody wants to really generate revenue out of that, and at the same time it is also a luxury. It depends upon the kind of the income levels a particular individual has, and then it actually supports them in that aspect. So what has happened beautifully out here, I mean, if I have to really look into the struggle of the other side, we were only talking about the NBFC, the MFI side. If I were to talk about the NBFCs or the banking, the struggle, what they have been always going through is, they still could not decode the underwriting capabilities when it comes to interiors. They still fail out there dramatically. So having said that, what is beautiful out here, or what is the best thing what I have seen in MFIs is, MFIs have really crystallized that so superiorly. Yeah, there are nuances in that, there are limitations, that's always there for every financer. Be it MFI side or be it on the NBFC side. But what is beautiful out here, where I see the MFIs excelling well, especially when I talk about the rural bit. Rural is a place where it is completely untapped, when we really talk about, because that's a place which is completely deprived, even though most of the thing happens in the secondary finance. Yeah. So now here, because of the kind of customization which MFIs brings in, as in you have that weekly payments, the fortnightly payments, is something which is unheard of, undone in as far as the NBFCs and banks are concerned. They actually don't do it. There is no product at all which is actually designed to actually cater to this. Having said, this becomes a big game changer in the industry itself. Both sides, because thing is, after listening to the last presentation, which I don't know, there is a struggle even in getting a home loan. That means there is a complete lack of liquidity in the market, and that's very difficult. But this can complement in that place, as in this particular product, especially if I talk about a three-wheeler or a smaller commercial vehicle, and also car, used car, which we are referring to. These can work as an income generator, at the same time it can actually fulfill your requirement in terms of the luxury, whatever it is, which you actually fulfill. So that's where the lower incumbent will be actually addressed through this. Why the kind of spread what MFIs has, apart from that the kind of the product ranges, as in the payment facility flexibility there. Only one barrier which I see is, which Vasu sir was actually mentioning, is the learning and development and the cost involved out there. It's immensely high. And I only recommend one thing out there when we are talking about it. The teams, I mean, that's something which I have a difference of opinion from most of the panelists which we were talking earlier. The teams have to be the same, and they have to go through the entire training system, and that's the place where you say, you have to go through COVID life for 2 months, wherein people should be, I mean, even without the business being done, they should be trained thoroughly to understand the product in and out, and then it should be sold. That actually would bring in a lot of diversification in terms of the portfolio of the same guys doing, and that's where the multiplier comes in.
Just a follow-up on that, is there not a strong synergy in that case? I mean, microfinance institutions have such a strong, long-standing relationship with some customers of theirs. These are also customers who have the same, need, for the asset that we are discussing, and you guys are an expert of that. Excuse my ignorance over there, but
self-reliant beyond a point, and there should be a value add which has to happen. The value add, if it has to happen, then possibly the income generator kind of product can come in, and that's where there are a lot of collaborative possibilities. That's something which we need to explore as the two different business partners.
Thank you. So, continuing with auto loan and vehicle loans. So, Karthik, in commercial vehicle and commercial equipment, we know that the yields, the investment yields are better in used commercial vehicle and commercial equipment. However, the operating cost and operating risks are also higher, right? What has been, what does your study suggest in terms of the viability of this, and how does it pan in comparison to, new vehicles, new commercial equipment and vehicles?
Sure. Thank you for having me, Sa-Dhan. The vehicle business is possibly one of the oldest financing business as far as the investors are concerned. So So, I mean, you would see a lot of conventional players with substantial size operating in this space and bringing about a significant amount of knowledge to this segment. This is one of the segments where you have a business and a credit system which is clearly defined. Everybody can follow the same system because the product is the same. The question is how much risk is one is willing to take. So the used vehicle is similarly a very, very defined product. So you have a commercial vehicle which comes out for refinancing in the 5th year, 8th year, 11th year and the 15th year. We don't see anybody getting into the 13th, 15th year of financing, not anymore at least. So we see at least people getting into the 10 years of operations when it comes for refinancing, people get into it. And the yield of the product is very, very congruous to the age at which the vehicle is getting refinanced. So a 10-year-old vehicle could get refinanced at about 18-20% yield, which is very, very similar to what microfinance. I mean, it's not similar, but closer to the microfinance. And again, the product is quite diverse. So within the commercial vehicle, you have the heavies, you have the middle, and the small. So what I see is as a closer, a logical extension for microfinance entities would be to financing into the mid and the small commercial vehicles, which will be in the ticket size of about 1 lakh, 2 lakh, coming into the refinancing part in the 5th to 7th year, and getting to an yield of maybe 20-25%. As you go up higher in the ticket size, the yields tend to come down. So the credit cost is very, very similar to the yield that the product is offering. So 25% yield product will have a 2 to 3% kind of a credit cost, which is very similar to what microfinance industry will have maybe on a long-term basis, around a 3% credit cost. And it is significantly operationally intensive. So if one were to look at it from an operational point of view, you have a 1 crore AUM getting managed by one employee, field level employee in microfinance. You will see all the products which are sub 3 lakh business, whether it is a micro lab or a micro housing, will have a very similar operating structure. So what helps in terms of logical extension for microfinance entities into enter into this kind of a product, where you have a 25% yield, 22% yield, operate with a 5 to 6% kind of an operating cost, over 3% of credit cost, which generate you around 3 to 4% of ROE. The credit cost will be higher. The new vehicles typically have about sub 1% credit cost, depending upon the product. So since you're talking about commercial vehicle, it will be a sub 1% credit cost if it's an MNHCV new vehicle. If it's a used vehicle, the cost will be about 1.5-2%. For the earlier part of refinancing, it will go up to 3% if you're going into the later part of the life of the vehicle, if it comes for refinancing.
Okay. Thank you. Going back to gold loans, one of the hypotheses was that what I started from is, for about 1 year, 1.5 years, there has been so many inward query and curiosity of the entire microfinance industry of what are the trends in terms of scale and performance and geographical spread of the customer cohorts. And I don't look at this data on a daily basis, but for this session, when I started extracting the data and looking at it, my hypothesis was that there would be multiple new demand players, supply players, who would have entered the space from the NBFC MFI space. To my surprise, I did not see that. I saw 4 active lenders, NBFC MFIs, who are actively lending for gold. Now, for sure, this is not matching with the curiosity and the desire for NBFC MFIs to get into it. So now, what do you think are the entry barriers that these institutions are facing? And do you think that they will get over them? What is your understanding and what is your view on that?
See, if you talk of entry barriers, there is a challenge for, in fact, the new entrants. For example, if there are established NBFC players like Muthoot or Manappuram, they have a network in place, they have branches in place, And for a typical gold branch to be established, you have to have initial capital cost, which I have my doubts that if every MFI can afford to have that or gradual transition, they need to give a serious thought to it if at all they are going to have considerable amount of money put in for gold loan. Because the main entry barrier, as I said, for any physical infrastructure to be put in, you have to have a surveillance camera, you have to have walls, you have to have all other machines to assess gold. And apart from that, another challenge which the MFI will face is, see, the people on the street or the feet on street team of the microfinance team, companies, they may not be trained in the gold loan as a product. And probably you may train some, but I don't think everybody can be trained. Like if at all you need to assay gold as a product, you have to have an independent person. So you have to invest in human capital as well. So again, as I said, there are established market players. So the only advantage MFI may have is they have deep rural presence as a customer base. So my understanding is, instead of going all out or in entire area, they may choose specific pockets where they can look at, okay, this is an area where I have a potential or I have got my seasoned customers, and do as a pilot, and then after that they can grow from there.
Sure. Raghu, for the common knowledge is that there is substantial stress on the micro segment repayments. Now, do you see any trickle-down effect of this into auto loan industry or two-wheeler industry? What has been your observation around that?
This was a point which I was actually talking at that time also. Micro segment, when it's commercialized, your inflation, your inflation aspect actually will your pricing actually change accordingly. Yeah. So now what happens is, we have been facing this kind of problems across. So there is a disruption that would actually come in, and that there would be a certain amount of hiccups in the initial stage where this concept would actually take a hit. But on a longer term, there would be inflation set returns, so that actually would be actually corrected. So I don't foresee, for that reason, logically, this impacting the overall, on a longer run, impacting the overall life cycle of the repayment of the customer.
I'll just add. Within the microfinance space, if you see the overlap with any product segment in the retail, within the two-wheeler. So we saw two-wheeler going through some level of stress last year. We saw some new tractor segment also going through stress to an extent last year. So these two segments is the one which we saw some level of seeping through of stress because of microfinance, because there are overlapping borrowers there. We also started seeing some stress in the used vehicle space where there is a good amount of overlap which comes with the microfinance part, because the household of the first-time user, first-time buyer in any commercial vehicle will necessarily or have an overlap with the microfinance. So you could see some of these happening in the last year, but you'll have to see how much it ultimately crystallizes into a final course.
Sure. We can continue with you, Karthik. So, as I was earlier talking about that, we have seen a 50% growth of gold loan in the last financial year. If we just do a back of the envelope calculation of what is the extent of the underlying asset which might be there in the vaults, the calculation that I casually did was anywhere between 600 to 700 tons of gold, right? But now there are 2 or 3 other numbers that keep flying around. That somebody says that the amount of household gold that India has is around 34,000 tons, 30,000 tons, 34,000 tons. This is a fraction of that. Some people say that it is 1/10 of the opportunity is 10 times or 15 times of what we are currently seeing. So, do you think that this trajectory of growth, with both the things, so one is the hypothesis and the data indicates that it is directly correlated to the underlying value of the gold, right? Now the underlying value of the gold, whether it is going to go up 50%, 100% year on year for the next 10 years, not going to happen, right? But will the growth, but there could be other drivers to the growth. Do you think that this growth will continue, slow down, dip? What is your thoughts on that?
So the growth that we saw last year essentially was a price-driven growth. When we look at an AUM of any product growing, there are two things that can contribute to it. One is the number of loan of the borrower, and the other is the ticket size of a typical loan. So the number of borrowers have grown by a meager, very low single digit, 1 or 2%, while the ticket size or the loan amount has grown by almost 70-80%. So an average ticket size of an NBFC, which was about 1 lakh, today it's about 2 lakh. So essentially, it is a price-based growth, and of course there are reasons to it. One, people have been using it as a working capital limit. As I was mentioning, it's essentially a working capital loan, which has been taken by a borrower in the anticipation that he can roll over. Now the rollover is available at a higher price. So you can easily roll over including the interest and continue to have that loan as long as the price goes up. And that's why you're not seeing any number of borrowers increasing. Of course, we do see that there are new borrowers coming in, but that's a fraction of the cohort of borrowers that we started the year. So between the start of April 25 to March 26, the growth of the number of borrowers or the outstanding borrowers have been 1 or 2%. While there could be a churn, there's certainly a churn that could have happened because X, Y, Z who were there as a borrower in the past, they are not there towards the end. But the total cohort of borrowers have remained the same, which indicates that it's a continuous usage of money with very limited money going back to the system. But at the end of the day, the gold loan has been devised in that manner. It's a loan which has been assessed in a few minutes and offered, and it's ultimately driven by the fact that I have the collateral in place and I can recover against that collateral. So it's a completely collateral-based lending. Of course, that's going to change a bit with the new regulations.
Is it true that the microfinance faced a stress and many borrowers were out of the microfinance fold? So they also found gold loan is a better option for them to get the loan. Is any such data you have, both of you? I think you are.
So, sir, the data that I looked at from the cohort of microfinance borrowers, which is around give or take 7 crore borrowers. If we look at what is their gold loan exposure, that is around 27,000 to 28,000 crores. That's the number we saw.
Number of accounts? Or number of borrowers?
This is not number of borrowers. This is the exposure. The exposure of 18 lakh crore of gold loan that we have in the country.
Of which 27,000?
Of which 27,000 crores is what we are seeing in the portfolios of these 7 crore borrowers.
Is there a spurt in the growth in the last 1 year because of that interest?
I have not looked at a trend. I think I looked at the point in time data for this one.
I have one input over here. Well, there is a spurt, but then not through the MFI. The spurt has been there.
Not through the MFI?
Yeah. So, because again, the challenges which you were mentioning in terms of having the world, having the entire infrastructure, all those aspects come into play. Otherwise, either it is a partnership based or it's there has been a spurt because people were looking for an alternative. So that aspect has been.
So maybe I'll rephrase this question. How many of the MF borrowers are in gold loan borrowing database as well? And is there a change or shift or increase in the last 1 year? That seems to be the question.
Yeah.
The answer has to be in numbers.
Yes.
If we get into this whole value, it does not help beyond.
Yeah, so, okay, thank you. I mean, you kind of pushed me to think more. So I think the number of loans, I don't have the number of borrowers still, because, but I think the number of loans is 19 lakh something, and of which 9 lakh loans have been disbursed to this microfinance cohort. The number of loans that has been disbursed by microfinance institutions itself is around 9 lakhs. So it is around 45 to 47% of the gold loan demand of the microfinance customers, these 7 crore customers, has been met by microfinance institutions. However, as I earlier confirmed, that these are just 4 of them. And within that 4, 2 might be having around 70-80% of the share.
Well, to add to what Karthik and Vipul said, see, if I don't have exactly the industry number, but we're talking from the perspective of a MFI, which is also doing gold. So we have seen some of our customers. In fact, our field team, when we see, there is a bureau check and we find that for some reason the customer is not getting eligible, but customer requests her if at all there is any other alternative. So we encourage them, if they have a gold at hand, then they can put that and take money. So that way, yes, there is a like change in the customer's behavior whenever they are also realizing that they have some idle gold lying at their home which they can utilize, and till they get eligible for the next MFI loan, they can use it from the gold loan.
I mean, I'll give a logical maybe answer. I don't have the numbers offhand. The MFI sector saw almost a 15-20% decline in between March of 24 to December 25. So that means that roughly about of the 6 crore of borrowers, we have lost about 1.2, give or take. But we have not seen a similar increase in the gold loan borrowers. So that is a indication, and again, the ticket sizes that the gold loans have seen are much higher than what the microfinance borrowers are. So you would see an overlap, but you would not see a direct overlap. Also because of the fact that the borrower could be a male, because they have to go and pledge the gold at the branches, and you would have the KYC of the husband rather than the wife. So when you look at the household debt, you would see 3 loans. If it's a microfinance borrower, they will have a microfinance loan, KCC loan, gold loan, and two-wheeler. So that overlap would be about 20-25%. That's a broad understanding that we have.
Please carry on. I'm sorry.
Yeah. So, but to add to this, number of borrowers is something that we can extract.
Yeah, if you can give that trend,
queries, these things can be.
The last 2 years trend, if you can give that.
We can surely do that. So we'll end this with you. Post the.
Since he is talking only about the 4 companies of the total so many microfinance, but the trend will not give any clear picture.
No, he has CRIF has got data.
I know gold loan. I'm telling.
No, he has data.
I know, but only 4 companies are doing 4 MFIs. Major.
No, I'm not talking about MFI only. I'm talking about the gold loan with the
Okay, got it.
Growth in the gold loan.
Yeah, we can do both. I mean, the overall industry comprehensive numbers also can be shared for sure. So the post the government reforms and policy changes, what are the changes? What is the impact of it that you are observing, and what are the changes that you had to implement post that?
Yeah. So after these new regulations, there are for us, like as I said, we have been governed by our parent company Muthoot, who are already established NBFC gold loan market player. So we have been following some of the systems and processes. So as such, if you see, we didn't go much of change, because the moment we started, it was directed to us that anytime there may be some change in the regulatory thing, so we have to be prepared. So one important thing is that security, from security angle, we have to make that there is a 7-layer security which we follow. So that is what we are stressing upon. And the second is the LTV part, which now has again reduced to 85. So that is something which then again you have to reassess. Wherever already we had some gold, we have to go back to the customer, then tell them to come with the additional amount which they have to add on. Other than that, what I foresee is this may be a challenge for the new players or those MFIs who don't have any parent backing of any gold loan company, and in the run for or the excitement of cashing on the gold loan market, they have to be more careful now, because now the rules are being more stringent and there will be more of audits. So that is what something which, if any MFI who is keen to come into the gold market, it would be better if they can come in coordination or in alignment with any of the existing players rather than going all alone.
Just a question to follow up there. Do you also have to have separate branches, and do they have to have a strong room and boards and all for this?
Yes. Our gold loan branches are completely different from our regular branches, and they have, as sir you have said, they have the strong rooms, they have walls, and there's a completely different team. So, we don't have both gold loans and microfinance at the same branch. Maybe down the line we may think of, but as of now, as I said, since we have been governed by Muthoot, so that is a clear directive. The way Muthoot is operating a pure gold loan branch, that is the same way venture gold loan branches are being operated.
Thank you, gentlemen. That was the end of our session. We can open up for questions. Even I can take if there is one from the bureau point of view.
Sorry, in between we also got into it.
It's not a question but a request to bureaus. Whenever you put out data, most of the data is put out on the value terms, which makes sense. Finance, value, percentage, this percentage is this book. But when we talk about inclusion, product diversification, especially the microfinance language, if you can put out numbers data, which is like number of borrowers, percentage of number of borrowers on portfolio buckets, it would be better for us to analyze, because at this end of the product diversification, we need to get a sense of numbers. And that is what
I think it's a fair expectation. No, it's not about requesting. This is the bureaus are also governed under the same regulator, but there is a technical challenge with that, and that's the reason why none of the bureaus do it, is because of the technical reason and nothing else. And that is that borrowers, when they are in the database, they are fragmented. So if we tell you the number of borrowers, and there are reports which are published at borrower level as well, we do share it with the SROs as well, the number of borrowers that we have. The challenge with that is not the accurate number. The accurate number could be give or take 20% of it. And depends upon how the data is architectured in the database. But it could be give or take 20%, some other bureau might have it 10%, but that is also not the reflection of the quality of the standards with which the data has been saved in the databases. That is why most of our reports, rather all our reports, we publish at a value and volume terms. So there is a lot that can be interpreted through that. And as again coming back to the number of borrowers, there are reports that we are publishing within microfinance. The number of borrowers, I in this conversation said that there are 7 crore borrowers. As I said, the number could be give or take 20% of it. 20% lesser, not more. Because as I said, when it is fragmented, when we make an inquiry on the database, sometimes fragmented data comes together as one. So, and that 20% could be 10% also, right, depending upon the bureau. And that's the reason, sir. There is no other reason for it. Sure. I think we're done. And you have a question?
I'm from Madurai, Mahilchi Foundation. எனக்கு கொஞ்சம் தமிழ் ஓகேயா இருக்கும், நான் தமிழில் பேசுகிறேன். நான் செக்ஷன் 8 ரெப்ரசென்ட் பண்ணி வந்திருக்கேன். நாங்கள் ஒரு 30 கம்பெனிஸ் வந்து செக்ஷன் 8 வந்து ஒரு அசோசியேஷன் ஃபார்ம் பண்ணியிருக்கோம். ஸோ நாங்கள் எல்லாம் ஒரு எத்தனை கம்பெனிஸ் வந்திருக்கோம்? ஸோ கிட்டத்தட்ட கிரிஃப்ல இருந்து டெர்மினேட் ஆகி இட்ஸ் பீன் 1 year ஐ திங்க் ஸோ. ஸோ லாஸ்ட் மீட்டிங்லையும் நான் கேட்டிருந்தேன், கிரிப்ஸோடைய எங்களோட ஸ்டேட்டஸ் என்ன அப்படின்னு சொல்லி கேட்டிருந்தேன். Sa-Dhan.
See, basically what they are.
Sir, she is asking that as a Section 8 companies, they are not
Section 8
member
and foundation.
of CICs anymore because there is a rule they cannot be give data. So how that it's 1 year they are not being able to take the report and also give the data.
I think we will have to comply with the regulator, and it is driven by.
We have taken up with RBI. We have been.
Yeah, so whenever we get clarity from them, we will have to comply by it. We do not have, our own independent, view on, whether we can accept data, store it in the databases, and even engage for that matter.
In fact, you have been doing it till 2024.
Yes.
But then RBI stopped it.
Yes.
RBI only stopped it, saying that you can't take.
I am aware of that. Yeah. So I've been part of these audits as well, and that's the reason I'm saying that when we get the direction from there, we will comply.
So what we suggested to RBI is that either it allow the Section 8 to continue as it was, otherwise allow them to convert into NBFCs.
Okay, fine. நிறைய NBFC இங்க இருக்கீங்க. நான் ஒரு சின்ன ஒரு ரெக்வஸ்ட் வைக்கிறோம். நாங்கள் வந்து கோல்டு வந்து ஆல்ரெடி ப்ராடக்ட் டைவர்சிஃபிகேஷனுக்குள்ளே போயிட்டோம். ஸோ எங்களுக்கு வந்து ஒரு 30 கம்பெனிஸ் வந்து ஓவர் 300 crores மேலே நாங்கள் வச்சுருக்கோம் போர்ட்ஃபோலியோ. ஸோ வி ஃபார்ம் அன் அசோசியேஷன். நாங்கள் அசோசியேஷன் வந்து ரெஜிஸ்டர் பண்ணிட்டு இருக்கோம். ஸோ எங்களுக்கு பிசி ஏதாவது சப்போர்ட் பண்ண முடியுமா? ஏன்னா எங்களுடைய கோல்டை வந்து நாங்கள் லாக்கரில் வைக்கிறதுக்கு அகெயின் நாங்கள் போய் பேங்க்ல எங்கேயாவது பிளட்ஜ் பண்ணுறோம். ஸோ அப்போ என்பிஎஃப்சி எங்களுக்கு சப்போர்ட் பண்ணால் எங்களுடைய கோல்டை வந்து எங்களோட கம்பெனி நேம்ல வந்து நீங்க பிசி மாடல்ல பண்ணீங்கன்னா எங்களுக்கு கொஞ்சம் சப்போர்ட்டிவா இருக்கும்.
Anand, you will tell.
He understood the question.
So we searching on some companies for that BC model for gold. Is there any possible?
Is it possible?
Gold loan.
Non-NBFCs to partner. I don't foresee that being a challenge, but then.
Can a outsourced agency do?
That again we have to see.
No, I doubt.
BC model, what happens is you have to do. That's possibility is there, but the only thing, that's what I mean. Like DSA is doing it. It's a similar fashion. Ultimately, it would be like a DSA sourcing the business for you, and it actually comes into your branch, and the entire formality and process is completed.
So only something like
lead generation kind of thing.
It's a lead generation.
Lead generation.
Referral or lead.
So on the face of it, it would look like a lead generation. Subsequently, the BC, because it has to be end-to-end monitored, and that's where the revenue comes in for the micro MFI. So that possibly can be looked into, but then it's not explored.
Possible is a interest rate or it's not a. Is it possible or not?
That's what I'm saying. Possibility should be there ideally because it's.
We'll have to see, madam. We have to examine and see.
Because we just searching for DC model. Already we do that DC for KCC in federal.
So there's no restriction, which I don't foresee any restriction.
No. I'm doing now.
But the BC model is already.
Okay.
BC model was a restriction
Okay.
But then there is a possibility that can be done. I think so. I mean,
For gold.
Yeah. Explore funded partner. I don't think that anybody has tried out so far. So that's while I'm not from the gold loan side.
எங்களோட டேட்டா எல்லாம் அப்படியே இருக்கு. கிரிப்டோல அப்படியே எங்களோட ஹிஸ்டரி மட்டும் தான் இருக்கு. அகைன் எங்களோட டேட்டா உள்ள வரணும். அட்லீஸ்ட் கோல்ட் மூலமானாலும் NBFC கிட்ட வந்து எங்க டேட்டா வந்ததுன்னா ஓகே இருக்கும்.
ஆமா, அந்த காம்ப்ரமைஸ் ஆக கூடாது. புரியுது. அது டேட்டா உங்களுக்கு தான் இருக்கணும்.
இல்ல அந்த கிரிப்டோட ப்ராப்ளம் வந்து ப்ராடக்ட் டைவர்சிஃபிகேஷன்க்குள்ள நாங்க வரோம். அப்ப ஓகே அகைன் வந்து இப்ப எங்களோட கோல்டு வந்து அப்படியே எங்களோட லாக்கர்ல இருக்கிறதுக்கு இல்லாத ஒரு நேஷனலைஸ் பேங்க்ல இருக்கும்போது அதே கிவ் சம் ரெஸ்ட்ரிக்ஷன். இவ்வளவுதான் வந்து ஃபிளெக்ஸ் பண்ண முடியும் அப்படின்றது வந்து இண்டிவிஜுவலுக்கு எங்களால பண்ண முடியாது.
Sure.
So again.
Sure. But can I pause you? I think you should. This is. It sounds like it is an important conversation for you. Please continue with this conversation. I have a hard stop. I have to leave. I think, gentlemen, thank you. Thank you for your inputs. Very insightful. Sir, thank you for giving me this opportunity. It has been a privilege. Thank you, everyone. Have a
good evening. Thank you.
Vipul, we have a small token of appreciation from you as well, and there is a small presentation. Gigi sir, if you can give it to Vipul and other panelists. So after the felicitation, there is a small presentation from Karthik on vehicle loans. So we'll continue with that.
Sir, look here, sir. Look here, sir. Okay. Sir, please. Okay. Look here, sir. Okay.
The speakers for the answers.
Okay.
Hi, good evening again.
You can use it.
Hope I'm audible.
Yeah.
So I have a brief presentation. I'll try to keep it as short as possible since it's been a timeline. So since this discussion was about product diversification from an MFI point of view, so we thought we'll showcase some of the learnings and understandings that we have of vehicle financing by MFIs. So there are two broad categories, if I have to put it in terms of our observations. One is the movement towards the used vehicle in the overall NBFC space, where there is a tangible shift that we can see over the years on account of better yields, better risk-adjusted returns and so on. Second is in terms of the financial performance, which has remained stable, notwithstanding the movement towards the used vehicle category. So these are the two broad themes. I'll try to cover it over the next 5-10 minutes. So moving on, just to give a high picture in terms of our expectation on sales. Last year was an extremely strong year. Essentially, the second half after the GST rationalization, we saw a big spurt in sales in the second half, and that created a problem to an extent for this year because there was too much of pre-buying and it created a very large base. So the growth numbers in terms of absolute percentages might look slightly muted, but in terms of numbers it will still be a higher number than last year, which is an encouraging sign from a financing point of view. So most of the growth will be driven by replacement demand and the continuing benefit of GST rationalization, which will flow through. We saw some segments, we saw pre-buying last year, especially in tractor, in the anticipation for tighter regulations, which will imply, from this year onward, but that got changed towards the end of the year. So it's now staggered over 27 and 28. So notwithstanding all of those, the broader segments is that we would see higher volumes than last year. But 2-3 things which one needs to be cognizant about is the external environment and the consequent impact on our domestic market, especially from an inflation point of view and ability to purchase. So moving on, this is the cohort of the overall NBFC assets under management. We coming from a risk point of view, look everything from a balance sheet perspective and see what is the total assets and what it can generate as a return and what can it cost as a risk for the person who holds those assets. So as you can see, vehicle and home loans, these are the two conventional and old products within the NBFC space, and they account for almost 50%. And we'll see that the vehicle, to an extent, will touch the 11 lakh crore in terms of AUM, assets under management. And banks do have a very similar quantum now. They are at about 12 lakh crore. The only composition will be different. I'll try to touch upon it in the next slide. This slide essentially talks about the share of vehicle financing in the overall NBFC space and how the new and used vehicle categorization has moved. We could very clearly see that the share of used vehicle is steadily going up. It is not showing out in terms of AUM because the ticket sizes of a used vehicle is typically 1/3 or half of a new vehicle. So in terms of volume, this number would be twice of what we see today. Within the category, CVs account for the major chunk, again driven by the ticket size. Passenger car is the expanding segment within the space, while two-wheeler and tractor are the segments where we see some level of stabilization. So I said I'll touch upon what the banking numbers look like. Of the 11 lakh crore which we see today in the NBFC space, majority is vehicle. In the banking sector, it is the opposite. Majority will be, rather not opposite, it will be more of the passenger vehicle segment where they have a significantly higher amount of share. So this number which we see is about 43% of the 11 lakh crore is about 4 lakh crore of CV. This number will be very similar from a banking point of view. But from a passenger segment, NBFCs account for 30% and 70% is contributed by banks. So 7 lakh crore is the AUM which banks finance in the passenger vehicle space. So some emerging trends. So this is the share of the key asset segments: commercial vehicle, passenger vehicle, and two-wheeler. Two-wheeler is where NBFCs have a significant lion's share. So they account for almost 65% of the space, and that is because of the gruel that goes into it from a collection point of view and from the origination perspective, because it's a completely different segment vis-a-vis a branch-based model which is applicable to any other asset segment. This is more of a dealer-based, individual-based origination, and in most entities, this system runs completely separately from a typical vehicle financing. It is completely digital, or it works in a completely different IT system altogether. So this is a more easier segment to penetrate in from an MFI point of view. It is because it's more adjacent to the target borrower segment that MFIs typically cater to. So the tangible shift which we talked about between the new and used vehicle, we could see in all asset segments, and more predominantly in tractor and passenger vehicle of late. This is one point which one needs to look at it in a slightly different flavor, because when we are looking at a used vehicle financing, it happens in two manners. One is a purchase of the vehicle. The second is a loan against an existing vehicle. The first one is a genuine transaction, which is essentially an income generating proposition, while the latter could be a consumption loan taken against a vehicle. So while there are established practices in terms of insurance financing and so on, which we typically see in commercial vehicles and other aspects, but we don't see that too much in passenger vehicle, and that is where, because it's the use is typically consumption or very limited commercial use. So this loan going up in the tractor and passenger, one has to see it in the context of where is the end use of these loans, whether it is for a purchase of a vehicle or just a loan against an existing vehicle. Wanted to show some deepening trends on some of the key asset segments, commercial vehicle, passenger vehicle, and show the difference between how it has tracked for a used and a new vehicle for some of the key asset segments. So used vehicles typically would have a higher DPD because they yield higher returns, and they typically have a higher credit cost too. But you see that an opposite happening in the tractor space, because of late tractor in the new segment saw some stress. We saw some improvement in the used tractor of late with new entrants coming into the space. this money typically goes in from an agriculture end use perspective. So this is a new phenomenon that we saw where used tractors started performing better than the new tractor. And we saw an uptick, marginal uptick across most of the segments, barring the used tractor. Write-offs in this space is lower than the NBFC average. Provisions are very similar to the overall NBFC average. So this slide actually showcases the P&L ROA tree of a typical NBFC, which is a confluence of vehicle, home loans, lab, microfinance, and so on, vis-a-vis a typical vehicle loans. As you would see, the NIMs are very similar, OPEX is lower, credit cost very similar, and that translates to a number where your ROA is very similar to the overall sector ROA. The overall sector ROA to an extent is governed by the fact that there are unsecured loans where the ROAs are much higher, and there are home loans where the ROAs will be much lower than these averages that you see. So vehicle segment is a segment which is closely tracking the overall NBFC performance as a whole. There are no divergences that you typically see. Entities typically higher, better leveraged because these entities are also vintaged entities. They have been operational for a long period of time, operate at a slightly higher leverage. So last slide from my end, this the sector will grow at very close to the overall average, slightly lower than that number though. But the overall average is again driven by the fact that there are home loans which grow at 10-12%, there are consumption loans which grow at 20%. So the 16 to 80% that you see is an average of all of those numbers put together. But the fact that the vehicle finances are growing very close to the overall industry average and returning very similar kind of returns for the players in the space indicates the fact that this segment is a harbinger of the overall NBFC space, and if one is tracking this segment, this is a possible reflection because vehicle is a large segment in the overall NBFC space, and it covers a very large borrower base which has overlaps with other asset segments, microfinance maybe in the used vehicle space, and also from a home loans and etc. at the higher end of the borrowers within the space. So this segment is a segment which is a reflection, if I have to say, of the overall NBFC on how the trends are and how they will perform going forward. So this was the last slide from my end. Thank you.
Officially close today's conclave. I would like to thank everyone who has joined us today, and also the senior management in Sa-Dhan who has guided us to organize this conclave. Not only Sa-Dhan, I would also like to thank Deepti from Yutadhi, who is the knowledge partner for today's event.
You should.
Yes, I'll request Deepti to come on the stage and request Gigi sir to just felicitate you, Deepti, from Sa-Dhan side to Yutadhi.
I think you can also say a bit about you.
So I've been, associated with the Indian financial services systems from I would say public policy angle. I've been a researcher for about 15 years. Most of my time has been associated with this organization called Dwara Research, where I left as deputy head of strategy. I've just recently set up Yutadhi about a year back. And it's been an honor to come in as knowledge partner for the Sa-Dhan event. We have, throughout all these years, we have closely monitored microfinance regulations, their impact on consumers, indebtedness, levels of over-indebtedness. We have studied it from various angles, from the household finance angle, obtaining evidence from the ground, going and playing it back to regulators. And therefore, I think this is a great, I think, pivotal point in the evolution of microfinance in India, where we are now starting about, where we are now thinking about the household as a whole and what are the other kinds of products that we can consider for them. Layer on top of the existing amazing network of branches and touch points and customers have already been served. So look forward to the progress for the sector itself. Thank you.
Thank you.
Sir, look here, sir. Turn a little bit. Turn this way. Okay, fine. Wait. Okay.
I thank all the participants and also the eminent speaker who joined us on the stage today. We'll circulate all the PPTs with all the participants along with the proceeding reports and recording of the event.